Good morning everyone, this is your tutor CPA and today we are going to look at financial reporting. We are going to be resuming our series on financial reporting, that is CPA paper 8 level 2. Today we are going to be looking at the overview of the syllabus, and we are going to be looking at some items that are within the scope of financial reporting as far as CPA level 2 is concerned. So without wasting more time, let's kick off. I urge all of you to subscribe to the channel and be able to share, comment, and let also others have a benefit of what you are going to be receiving. So the first slide is all about the elements of financial statements. And the reason why we are talking about these elements of financial statement is not because we just want to talk about them, but they are really important, because you need to know what are some of the elements that we have within our financial statements. We have to distinguish between elements and the components. Elements, we are talking about we are not talking about the components. The components of financial statements, those are the income statement, or what we call the profit or loss and other comprehensive income, the balance sheet or the statement of financial position, and and the cash flow statements. Those are mostly three components. But when you are talking about the elements, we are talking about the items that are forming up those statements we are talking about. So these are defined according to the revised framework, that is the revised conceptual framework of March 2018. So these definitions are of March 2018 as they were revised within the conceptual framework. So the first element of financial statements, we are going to categorize them as elements that are within the statement of financial position, that is the balance sheet, or the items that show the financial position of an organization. One, we have the assets. When you look at the assets, within the definition of assets, you will see mainly there are three items that you need to focus on whenever you are defining an asset as per the revision that was made. One, you have to look at the present economic resource. Secondly is they are supposed to be controlled by an entity. And thirdly, they must be as a result of past event, or we must have acquired them in the previous periods. Actually, when you are talking about the assets, we look at the assets. Not all assets are going to be helpful to us. When we talk about the assets, we are looking at those assets that can be able to bring value or to add value to the organization. And that's what we call the present economic resource. From your economics, you know how an economic resource is something that can bring something on the organization. So these are assets that we have within the organization, but they are able to add something or to add value to the organization. They may be in terms of they are used in the production process, they are used to earn some money to the organization, as we are going to be seeing them. So we are saying assets, those are present economic resource controlled by an entity as a result of past event. You can't say I have an asset and you have not yet even acquired it. So you must have acquired it. That's what we are talking about. It must be as a result of past event. It is a present economic resource controlled by an entity as a result of past event. Secondly, let's talk about the liabilities. Remember, these one we categorize them in terms of the financial position. You know, our balance sheet starts with the equity equal to assets minus liabilities. So when we look at those three components, those are the ones that are making up the balance sheet. The second one is a liability. A liability, it's an obligation, or someone must be demanding, or the company is supposed to transfer certain amount of money to the person that is owing, that is demanding the organization. So when you are talking about the liabilities, we are looking at the present. It must be a present obligation. You can't be having the obligation which you have already settled already, and you call it a liability. It must be a present obligation. Secondly, the entity must also transfer an economic resource it must be that liability must be quantified to the extent that upon clearing that obligation, the company is going to transfer certain amount. It may not be necessarily money, but something that can be valued. And lastly, it must be as a result of past event. So those are the three items that are making up our definition. We are saying that the present obligation of an entity to transfer an economic resource as a result of past event. That's what we call a liability. It's an obligation whereby we are supposed to transfer a certain amount of money. It may be money, it may be other resources, so as to settle it, but it must have occurred in the previous periods. The last one, as far as the elements of financial position or the balance sheet are concerned, we have the equity. Equity is where we find the financing component in the organization, where we find the share we've contributed, the profit, the trend earnings we have been making for the years, and all that makes up the equity. And we are saying to get your equity, it's, remember when these shareholders, they are giving you money, they give you money, you purchase assets. When you purchase those assets, you may purchase them on either credit or you pay by money, but the money you've got it from the shareholders. So that's what we are talking about, the equity. The equity, it is the residual interest. We have to also look at it in the residual interest. Here we consider also three items. We consider the residual interest, what remains there in assets. The residual interest, then it's supposed to be in assets of the entity. Then when you have deducted all the liabilities. In other words, it's what remains after settling all the liabilities. You know, we settle all our liabilities using the assets we have. What has remained there is what we are going to be distributing either to shareholders and others if at all the business is going to wind up. So it is a residual interest in the assets of an entity after deducting all the liabilities. And here we have a formula: equity equal to assets minus liabilities. So what remains there is what we call the equity. So let's look at the elements that are relating to the financial position. The financial performance of an organization. That's the elements that are within the income statement or profit and loss and other comprehensive incomes. One of them we have is incomes. Those are the things we find in the income statement of any organization, and we are defining these items according to the conceptual framework that was revised in March 2018. So if you are using the old version, I know there are other ways you can define this, but we are going as per the standard. And we are saying incomes, these are increase in assets. We have increase in assets. When assets are increasing in value, we call it income. When liabilities are reducing, we call them income also. For instance, you can talk about if let's say you are buying goods on credit and you are getting discounts, that trade discount, we call it as income. That's why we record trade receivable as in terms of the other incomes as in regards for the financial statements. Because when the goods are supposed to be for 10 million and you end up paying 2 million, it means that, you end up paying, let's say 8, that 2 million will be the trade receivable, the discount received, and it will be as an income in the income statement. So when liabilities are decreasing, we call it income. We are saying that these are increase in assets or decrease in liabilities that lead to an increase in the equity. You know, when the incomes are increasing, it means that income is going to increase our net profit that we are supposed to be taken to the equity section within the balance sheet. So when we put there a net profit which is high, it means we are going to be increasing our equity. So that's what we mean by these increases in assets or decrease in liabilities. They can lead to an increase in equity other than the contribution from equity participants. Contribution from equity participants may be when the shareholders are increasing their share capital, or when the company is selling more shares. When you see that one is not called equity. It's not called incomes. It's part of the equity section. So we are saying that these incomes, they must be they must be increasing the equity, but as a result of increasing assets or decreasing liabilities, but not the contribution from equity participants. The other one is expenses. You know, expenses, those are the ones we less from the gross profit, sorry, the gross income or the gross profit of the organization to get the net profit. So expenses are defined as decrease in assets when assets are reducing in value. It's like you had an asset of 10 million, but it has been valued at, let's say, 8 million. That decrease is what we call an expense. It's a loss or a decrease in assets. Let's say when you're talking about the depreciation reduces the cost of the asset. If it reduces the cost of the asset, we take it as an expense because assets are reducing in value. That's what we call decrease in assets or increase in liabilities. If, let's say, you had given, let's say, provision for, let's say, bad debts, and you find that with time that provision is keeping on increasing, that increase in provision for bad debts is also treated as, remember, the other one is a liability because you're expecting some people not to pay you. They are increasing. If they are increasing, we treat it as an expense. So increase in liabilities is also an expense, but those ones, they must lead to a reduction in equity other than the distribution to equity participants. Distribution to equity participants, we are talking about the dividends. Dividends are not expenses. We don't treat them like expenses because when you're paying dividends, you are just apportioning the profit. Dividends comes after you have already got the profit. You can't pay dividends on gross profit. You pay dividends on net profit, meaning that dividend cannot be treated as an expense because it comes after you have already deducted all the expenses. So that's why we are in the definition of the expenses, we are saying there must be an increase in liabilities or decrease in assets that reduce. Remember, when you're talking about reducing the equity, this net profit we are taking to the equity section is reduced by these expenses. In other words, it's like we are reducing the equity part of that balance sheet section by these expenses we are incurring. Hope you can be able to get more on that. If you feel you're not contented, you can rewatch the video and be able to understand what we are talking about. So those are basically what we are talking about, the elements. I wanted to first make clear that at least these ones are very understood, because we are going to use these same items. If, let's say, we are talking about assets, we try to talk about the current assets, we talk about the non-current assets in their respective standards, as we are going to be seeing. Because when we are talking about the non-current assets, we have a standard for that. There are so many standards that are related to the non-current assets, the tangible one and the non-tangible, the intangible ones. So there are many standards as we are going to be seeing them, but at least you first get these clearly. Okay, we can proceed to the next one and we look at the measurement of those elements. How do we measure those elements we are talking about? If, let's say, we are acquiring an asset, how are we going to assign the values on those assets? If, let's say, you have acquired an asset today, which value are you going to attach to that? Those are the things we are going to be looking. How are those assets we are talking about, how are they measured, or how are they assigned values? Those are the things we are going to be looking at when we talk about the measurement of elements of financial statements. One, we have the historical cost. Historical cost is, as the word says, it's something, it occurred sometime back. So it's in history. So we are talking about the historical cost as it's a past cost or something that we had incurred already, but can be used to measure some of those items we are going to be talking about. So when we try to look at how are assets measured using the historical cost, of course, when you're buying an asset, at that point when you have purchased it, if, let's say, you have bought an asset of, let's say, 10 million, that 10 million is actually what we have, and that's the value that we are going to be taking in the balance sheet, because we don't have any value that we can assign to that other than the one you have actually paid. So when we are talking about the historical cost, is the cost that we have already incurred. So we are saying that if you are assigning these values in the bank statement, let's say because assets are going to be in the balance sheet, which value are we going to use? We are going to use the price that we paid when we are acquiring those assets, or the an amount we have paid at the acquisition date. We are saying assets are recorded at the price paid at the acquisition date, or the amount paid to acquire those assets. If they are liabilities, how are we going to record the liability? If I sell goods on credit to you today, that's going to be bringing a liability, but which value am I going to assign to that when I go to my balance sheet, when I'm taking some of the liabilities? Which value am I going to attach to that liability? We are saying liabilities, they are recorded at the an amount that we are required to settle that obligation. If, let's say, you've incurred a liability of, let's say, 10 million, you've bought goods on credit and they were worth, let's say, 10 million. That 10 million is straight away the figure we are going to be using when we are doing the balance sheet at that point of acquisition, or when we are recording that in our financial statements. The other measurement base, actually these measurements, they are called measurement bases. The other one is current cost, or the fair value. The fair value, as the word is, the other one is, it is the opposite of historical. If something is not in history, it must be current, something that is prevailing at that very time in a given at a given date. So assets are recorded at the prevailing market price at a given date. We are going to be seeing this, how we can be able to treat these assets using the fair value. We can try to, let's say you bought that asset at 10 million, and right now it's amount that can be got from the market. If at all you are to put it on the market, you get this amount. That's what we are meaning. The amount we can get at the prevailing moment, or at the prevailing date when you are supposed to, let's say you are supposed to settle the obligation. Someone may give you 10 million and that person is demanding you 10 million, but by the time you come back to pay, you may just say, you know what, according to the situation that is prevailing at this time, just pay me 9 million. Or, since I gave you the money and as per now the inflation is high, you can give me, let's say, 11 million, and you give me that 1 million as to cater for this inflation and all that. So when you're talking about the prevailing market price is determined by forces of demand and supply. There are so many factors that are within the market that can lead to either the prices going to be high or going to be low. So the current cost is what is prevailing at a given date. So assets are recorded at the prevailing market price at a given date. When we are talking about the liabilities, they are recorded at the amount required to settle the obligation. Currently, what we can pay now, someone, as I illustrated, we said someone can give you 10 million today and says in 2 months' time, you pay me 9, depending on what is prevailing in the market. You may find that the situation is hard. Someone cannot be able to get the whole of the money you are demanding the person. You can say, no, pay me this. Or you may find the situation is very worse. The inflation is high, and if someone gives you the money you gave to that person, you may find they're giving you less. So to cater for that, you bargain on the currently what is prevailing on the market. The third one is realizable, or what you can realize from a certain transaction, or what you can get. It is realizable or settlement value. Realizable is for asset, then settlement is for liabilities. When you're talking about the realizable, it is the amount expected from the asset with less the cost to sell. This is mainly with the goods, or these people who are, let's say, acquiring contracts. You may find that for you to get a contract, the contract, let's say itself is, let's say, 10 million. And you find that to get that contract done, you're supposed to incur certain expenditures, like paying commission to brokers and all that. We less that cost. But that one is in terms of, when you're talking about the realizable, most of the times it is what we are supposed to be, we are supposed to be selling. If, let's say, we are selling goods of, let's say, 10 million, and to sell those goods we need to pay, let's say, marketeers or the sales agents so that we can be able to get those goods sold. We less that cost we are paying to them. It's an income to them, but it is an expense to us. You will get what the market is going to give you. If let's say in the market they are giving you 10 million, but you have incurred on top of that 10 million you have got, the person who got for you, the person who is going to give you 10 million, you have paid something, you less that one off. That's what we call not necessarily the money you're supposed to fetch from the market, but what you have actually received after removing what you have incurred to receive that money. This is mostly with assets. You know, when we are talking about the assets, even if they may be current, whether they are inventory, you have stock, let's say stock of 10 million, and you're selling it at 15 million, but on top of selling it, you less the cost of 10 million, but that profit you have got, you have also incurred certain expenses to make sure that at least those goods are sold. So when you're talking about this, the settlement value is actually basing on the liabilities, because we can't be settled. You can't be talking about settlement and you expect to be receiving money. It's you, let's say the company is paying out, and we are saying liabilities are measured at an amount that is required to settle the obligation in the normal course of business. It is, if let's say you are supposed to pay 10 million, it is that in the normal. But if things go the other way around, you may find that you are not paying exactly what is supposed to be paid. So here we are talking about the amount that we are required to settle, or the amount that is required to settle the obligation in the normal course of business, if everything is moving well. The fourth one is the modified historical cost. It's a modified, meaning we are changing the historical cost. Modified means we may be modifying it positively, or it may be in a negative way. It is a modified historical cost, means assets. This is mainly about assets. We are saying assets are measured at the revalued amount or the estimated market price instead of their historical cost. As I said earlier, that when let's say you have acquired an asset at 10 million, you may find that currently, if you are to revalue that asset now, you may find that that asset is not going to fetch the same amount that you have paid to acquire them. If let's say you paid 10 million, you may find that at the time of revaluing, you find that the asset has, let's say, increased in value and it's now costing 15 million or 20 million. And you may find it is even otherwise. You may find that the asset you acquired at 10 million is now valued at 8 million or 5 million. So we are saying assets are measured at the revalued amount or estimated market price instead of their historical cost. So when you're taking these figures to the balance sheet, you don't take the historical cost, but you take the modified cost. If let's say it has been revalued at 15 million, when you're recording your financial statements, you take the 20 million that has been revalued, if at all you are using the modified historical cost or the revaluation model. Then lastly, in terms of the models, there is the present value. The present value, you can call it the value in use. If let's say the asset is not sold and we are going to be using that asset for a given period of time of its useful life, of course its economic useful life, you find that that asset is going to be bringing in cash flows. We are going to be getting certain amount of money from that asset. If it is a liability, you are going to be paying a certain amount of money in the future. If you are settling, if let's say you have got a loan, you are going to be paying interest, but that interest is going to be paid in the future. So what if you want to look at the present value, we discount those cash flows that we are going to be receiving from the assets, or that future obligation or future payment we are going to be making on a certain period in the future. We discount it and we get its present worth. Actually, what we are trying to look at, if let's say an asset you bought at 10 million, you are expecting for it to be there for the next 5 years, and you find that that asset can bring to you cash flows of, let's say, 30 million, or it will bring you 5 million for the 5 years, or it will bring you 6, depending on the capability of the asset. You discount those cash flow that you are supposed to receive from that asset for the period you are going to use it to you define their present worth. And how do we get that? We get the To get the present value, we use the discounting factor. The discounting factor is 1 over 1 plus x power n, or someone can call it 1 plus r power negative n, but it is the same. That is the discounting factor. We multiply by those cash flows. We may accumulate them if, let's say, we are receiving those 10 million annually for the, let's say, for the next 5 years. Every year you're receiving 5 million. But if you're receiving 5 million for the next 5 years, it doesn't mean that it will be 5 million times the 5 years to get the money you're expecting. No, that one won't be its present worth now. But we put in the discounting factor to make it giving us the exact value that we are going to be recording by using that discounting factor. If you are not using the discounting factor, we are going to be using an annuity factor. The difference between an annuity and the discounting factor is that for a discounting for all of it, we are discounting the cash flows. But the logic here is when you are discounting cash flows, they may be uniform or they may be uneven. There are those cash flows that we are going to be receiving, let's say, 5 million every year for the next 5 years or 10 years. And you find that there are other cash flows you are going to be receiving. This year you receive 5 million, next year you receive 2 million, the other year you receive 10. Then when the cash flows are uneven, we use the discounting factor. But when the cash flows are uniform, we are receiving 5 million every year for 10 years, we can use an annuity factor. And to get our annuity factor, here we are not going to be using tables, but I want you guys to get to be familiar with the formula so that you can be able to compute each and everything using the formula without following those things of it is 1 minus 1 plus r into bracket to power negative n. This is over r. That is our annuity factor. Then we multiply by the future value, that cumulative amount you are going to be receiving. If you are receiving 5 million, then it will be that 5 million times the discounting factor for the number of years. This R is going to be our discount rate. Then this N is the economic useful life of the asset, or it will be the obligation. How long are you going to be taking to be submitting a certain amount of money to an organization? If, let's say, it is in terms of a loan, paying a loan, that's basically the measurement basis we are going to be using. The reason why we brought out this is that when you are looking at certain standards, let's say standards for assets, we are going to be requiring to know which value is going to be assigned at a given point. It may be at an initial recognition or at an initial stage, or it may be at the reporting. We may want the figure that we are going to be using at the acquisition date when you are acquiring the asset, or at the reporting date. As you know, our financial assessments are made annually. That's why we are calling the reporting date, but we are going to be seeing those ones when we start to discuss about some of the standards. We are going to be seeing. Actually, we are going to be basing on them, and we are going to use this information a lot. If at all you have not understood, make sure you rewatch the video and be able to understand it. Because if you fail to get these right, you may fail to get other concepts. Because we are going to be referring to all this information in the preceding videos. So we can take a simple simulation to be able to understand at least what we have got. It is going to be rotating about the measurement basis, but when at this point we are putting in the value, you will be able to appreciate what are the items we are going to be talking about. If you talk about the historical cost, how are we going to assign these values initially or at the acquisition date? So let's take, this is about the measurement basis. Called it simulation 1, and says ABC Limited bought a machine with a useful life of 10 years on 1st January 2018, meaning this is the acquisition date, what we have incurred, what we have actually incurred at the time of acquiring. This is when the asset was acquired, meaning this is the acquisition date, and it was we paid 60 million as our cost we incurred at the acquisition. And they are saying that the market value of the machinery or the machine on 31st December 2021, meaning this is at the end of the year. If the year is starting 1st January 2018, it means it is ending 31st December 2018. And we are saying the market value was 40 million. And we proceed, it says that for disposal purposes, the machine had to be dismantled and transported to the buyer's premises at 4 million. These are costs we are talking about. The item was sold. Disposal meaning selling off. The asset was sold. But if we are to sell it, we have to incur certain cost. We dismantle the item and we transport it. Maybe this machine was plucked somewhere, or it was constructed somewhere, and they are removing it from where they put it, and they are transporting it to the person who has bought it. And the cost they incurred was 4 million. They are saying that the machine is expected to generate cash flows of 10 million. This is what you are seeing with their cash flows of 10 million per annum, meaning we are receiving 10 million, but they told us the useful life was 10 years. But remember, from by this time up to the time they are talking about, there are some years which have gone. That's why they are saying we are going to be receiving this 10 million per annum in the remaining 7 years, meaning we had already spent the 3 years of the asset, of the useful life of the asset. Then they have given us the discounting factor as 10% per annum. Then we have the required is saying determine the value of the machinery on 31st December 2020. Remember, the asset was bought on 1st January 2018, but they want us to make reporting at the time of 31st December 2012. Of course, you know, when you acquire an asset, there are depreciation, impairment, and all of that, as we are going to be looking at them, because each of those items have their specific standards that are talking about them. So they are saying we determine the value, which value are we going to attach on the item as of 31st December 2020 using 1. Historical cost, current cost, realizable value, and then the present value. These are the things we've been talking about here. We said the historical cost is the cost we are going to pay to acquire the asset. Because here we are talking about the machine, this is an asset. So what we are going to incur at the acquisition period, or at acquisition date. The current value, what is its value right now? Realizable value, what we can get from the asset after lessing off the expenses we have incurred to get that money. Then the modified historical cost is the revaluation. We have revalued the asset. We had bought the asset long time, and now we are revaluing the asset. What will be the value? Then the present value, what are the expected future cash flows that are coming in, and we discount those cash flows to their present worth, and that's it. So that's all basically we are going to be looking at when we are doing this question. So I can go into Excel here, and we'll be able to insert here an Excel sheet, so that we'll be able to do that item. We make it white because I don't want to move out from the screen, since we are going to be using the same question. Okay, we can start right away, and we say this is our simulation. Maybe to increase it so that people can be able to see the whole screen. So basically it can move. So you can use this. I think it will be, this is ABC. This is ABC Limited. And we are going to look at, I put some answers. If you try to look at here, I put some answers, but we are going to see how those answers are coming in. As we said, the value, they said the cost as at 1st January 2018 was 60 million. But remember, this asset is what this is the amount that we've actually used to get the asset. But we are reporting the reporting date reporting date is 31st December 2020. So if you have acquired this asset and we are using the historical cost, we are saying this is Roman 1 and we are getting the historical cost. We say that our historical cost is that assets are recorded at the time they were at that amount that we acquired those assets. We acquired them on 1st, but remember from 1st January 2018 it was for 60 million. It can be in Ugandan shillings or in dollars, whichever. So I've not put the units, but you can be able to put whichever country you are watching in from. So the 60 million, remember from 1st 2018 to 31st December 2020, there are how many years that are there. So we need to find how many years are there. You may find that we have from 1st, that is 2018, 2019, then the 2020. 2020 is inclusive because it is at the end, meaning there are 3 years. There are 3 years which are there. So what are we trying to look at? We have, when you have the assets, you know from your financial accounting that assets reduced in the value. It can't be the same 60 million because of the depreciation and all that. We have to spread the cost to its useful life. So we define the depreciation. Permit me to use DPN to represent, let me write it, depreciation. And to get our depreciation, we say the formula for getting depreciation is, it is cost minus the salvage value or the scrap value or the residual value from our financial accounting. Then this one will divide by the useful life. If you are not given the residual value, you just take it to be 0. So this will give us, it will be the cost which was 60 million. We just put 60 million minus residual value which is 0. We can just divide this, divide by the useful life. They had given us the useful life. Can I put here the useful life was given to us? The useful life was 10 years. It is 10 years. So when you get this, we divide by 10, meaning the depreciation we are going to be getting here, it is for only 1 year, but remember we want for 3 years. So it will be that this very figure multiplied by 3. These are the 3 years. We put 3 years. Whatever you will get, it will give us 18 million. And this 18 million is the depreciation for the whole 3 years. This depreciation is for the whole 3 years. But remember this whole 3 years, for us what we are looking for, we want the carrying amount. What is going to be its carrying amount? The carrying amount is got by getting the cost minus the depreciation or accumulated depreciation. Remember, depreciation is for 1 year, but accumulated depreciation, it means the depreciation for 1 year is 6 million. 6 times 3, because it is 60 divided by 10, which gives you 6 million. That's for 1 year. But we want for 3 years. We multiply 3 times 6, we get 18 million. So our cost was 60 million. Then when you less the 18 million accumulated depreciation, you will be able to get 42 million. And this is how we got the answer you are seeing here. This is how we got this 42 million. It is basically from that computation that you are seeing here, that 42 million. So that 42 million was there. This is what you are going to be recording in the balance sheet. If they are telling you the balance sheet extract, you get this figure as, we can say, the extract here. You get the where there are assets, you say machine, its cost was this 60 million, accumulated depreciation of this, then the net book value. Of course, the carrying amount is the net book value. I know you guys are used to the net book value, but here we are talking about the carrying amount. But carrying amount in this sense is the same as the net book value, or this is basically what will be there when we are using the historical cost. That is the value we are going to be using when we are reporting for historical cost. This is what you basically you've been doing in your financial accounting when you are handling the depreciation and all that other items. Then our part 2 says they want the current market value. When you look at this question, it says the current market value, but in the question they told us that the current market value was given to us. This is basically, actually this one was supposed to be 2020. This question, this one was supposed to be 2020. This one was supposed to be 2020 because it's the current market price. This is supposed to be 2020, not 2018. It was given to us as 40 million. So this one was okay, you just get it in the question. Hope you can be able to adjust that, or I can change it from here. And I see this one was supposed to be 2020. Supposed to be 2020. So we can proceed and make sure we will complete the question. Our Roman 2 was talking about Roman 2 was, we've got it, it was 40 million, it was given to us in the question. Then we look at the Roman 3. The Roman 3, which was the realizable value. I said the realizable is for assets, then settlement is for liabilities. That's why here they are asking for realizable. What we said with the realizable is that it's our estimated selling price minus the cost to sell, or the costs we are incurring to sell those assets. And here they gave us in the question, they are saying that for disposal purposes, the machine had to be dismantled and transported to the buyer's premises at 4 million. But remember, they gave us the cost, the market value. Market value is what we are estimating to get from the market. So if we are given the estimated market price, the market price was 40 million, and the selling, they have given us the transport and the dismantling cost, which we call the cost to sell, which were 4 million. They were 4 million. So to get our realizable value, we said it will be, this will be equaling to the estimated market price minus cost to sell. Cost to sell. When you get this minus this, of course you'll be getting our realizable value, and the value here is going to be 36 million. It will be this minus this, which will give us 36 million, and this is going to be our realizable value. When you check from here, I gave it to you as 36 million. Then we can go to our last one, which is talking about the Roman 4, is talking about the present value. And our present value, we said it is equaling to the future value multiply by the discounting factor. And we say that our the discount factor is 1 divided by 1 plus r to power n. And this n, these are number of years, but they told us, as per this time, they had given us the machine is expected, this one I also repeated it, you can remove that one. The machine is expected to generate cash flows of 10 million per annum in the remaining 7 years, meaning our n is going to be 7 years. Our cash flows, we are going to be receiving 10 million. The discounting factor is 10%, so we have all the information. We can just fill in here and we get all that what we need. Our n is 7 years. Our cash flows or future cash flow, what we are expecting to get in the future. Future cash flow is 10 million, but remember we are getting this 10 million we are not getting it at once, for the remaining 7 years. So our useful life is, we got it, and we got our discounting factor. As 10%. So we can do that one from here. There are two methods I said. We can use the discounting factor or we use the annuity. And we said, but we use annuity only and only when the cash flows are uniform. We are receiving 10 million every year. But if the cash flows were varying, we use the discounting. Let me show you method 1. So method 1, we are using the discounting factor, and we get them, these are number of years. We put there our n, number of years. We said we are receiving cash flows for the last 7 years. 1, 2, 3, 4, 5, 6, 7. We're receiving for the 7 years. Then we have the cash flow, or that future cash flow. The cash flow is we are receiving 10 million every year for the 7 years. This one we are working in millions. I can put those, let me put all the zeros. One, two, 1, 2. I hope they are 10 million. Yeah, that's 10 million. Then we will get our discount factor. It is called R, which is 10%. Then we get our present value. We said it is 1, this one we can use Excel, it is 1 divided by, put it in the bracket, it is 1 plus our 10. When you convert it to decimal, it will be 0.1 plus 0.1, it is to power. Now this n, our n here is 1, it will be to power 1. When you press enter, you will be getting that. But you can reduce them to 3 decimals. Reduce them to 3, maintain the 3. Sorry, remember, let me just put this. We can lock this one because let me put the 10% here, so that we'll be able to do it using Excel, not doing it manually. Instead of putting this 10%, I put the exact figure. I put this. Then I lock this one, meaning the other one they are going to be changing. I think you know how to do those things in Excel. When this value, it means when I put in these dollar signs, it means this 10% is going to be fixed, not changing, but only this outer part which is going to be changing. That's why I put in the dollar sign. But if you don't put in the dollar sign, you will not get the same answer. Hope you can be able to get those ones. That's Excel. I'm not teaching Excel. It is equal. Then to get the present value, we said we get the future cash flows, we multiply by the discount factor. So it is going to be this multiply by this. Then we can, to get those figures, then we get the totals. Actually, this total is going to be our present worth. Total can equal sign sum. The sum in this. So these are going to be our figures. I can put in let me put in the separators so that the work looks a bit fine. These ones I have to remove the separators. This is a bit of Excel and its own ways. So these are the figures. So this is going to be our present value. Total present value is going to be this, and that's the answer they were looking for. This is the answer. So we can use the method 2, where we are talking about using, this is method 2, and this method 2 we are going to be using our annuity factor. There are those tables, but those ones we learn them in financial management, but here I'm not teaching financial management. You learn how to use, actually I did some videos, you can cross check from there, and you know how to do those ones using the annuity factors, and you get the differences from there. So remember, we said if the cash flows are going to be coming uniformly, or they are going to be even, coming in equal installments for a certain period of time, we just get those installments, which is 10 million. After getting those ones, then we get our annuity factor. Actually, to get that annuity factor, you can even sum up this. When you sum up this, let me teach you something here. Cosine sum. I'll verify to you this. This answer you are seeing here is exactly what is going to be our annuity factor. This one, but we'll get it in the annuity factor. We'll get it in using the annuity formula. We say the annuity formula is 1 minus, let me just put them in Excel. Let me put it here. Annuity factor is equaling to 1 minus, open the bracket, 1 plus r, close the bracket, to power, it's a negative n. But the whole of this one is in the bracket. The whole of that is divided by r. Divided by r. That's the formula. That's what we are going to be using to put in our formula here. This is going to be our annuity factor. There is going to be cosine our, we can first open the bracket. We say 1 minus, open another bracket. It is 1 plus our 10%. Let me just use this, or you can type it there. Then it's close that bracket. It is power negative 7. Then you close that bracket. We divide by this. When you press enter, it will give you exactly this figure you're seeing here. That's what I've been talking about. What it means is that this annuity factor is what we can get for the whole of those periods. It is the accumulation of all those periods that are remaining of the useful life of the asset, which were 7 years. That's why this one is summing up to this. So if you get this times this, you'll be able to get this. It is equal sign. To get our present value, it will be this. We multiply by this. So let's by this. It will be giving us the same answer. This is our present value. And when you check here, we said it is 4.86 million. That's what we've been talking about. So those are the figures. I hope you guys can be able. Let me remove. You can remove the grid lines, and you'll be able to see it clearly. Hope you can be able to see. Hope you can be able to see all of that. That's the working for the things we wanted. This is our realizable value. This is our cost using that, and this is our those two methods. And I hope you can be able to learn something out of that. So thank you for watching, and the next one we are going to be looking at is going to be something new, and we are going to be seeing how to do all that. It's going to be something new. And try to change the color if you can't see it well. At least from there you can be able to see it. So those are the things we are going out. That's how we are going to be seeing them. But the next one we are going to look at is we are going to start our IS 16, that is PPE, in the next video. But hope you guys have enjoyed this, and I want you guys to subscribe so that we'll be able to learn more, because more is coming. It's just a matter of subscribing to the channel and share the videos. You can comment, you can make any suggestions. I welcome all of that, so that we'll be able to understand and we do our CPA with ease. Thank you for watching, and until we meet again the next session, that is going to be about the IS 16, that is property, plant and equipment. Thank you. Okay, good afternoon viewers. We are going to resume our series on financial reporting, and as promised you that we are going to kick off with our IS 16. We are going to be starting our standards, and the last video had looked at how we can be able to define the elements of financial statements as well as the revised conceptual framework of March 2018 concerned. And we looked at how items are going to be measured, how we assign values to different assets and liabilities and other elements of financial statements. And we said we distinguish the financial statements from, the elements of financial statements from the components. The components of financial statements, we say those are the mainly three: cash flows, balance sheet, and profit and loss, or in the income statement or statement of comprehensive income. So that's how basically we went as far as they are concerned. We looked at the measurement basis. We said can be measured at cost, historical cost, current cost, realizable or settlement value, modified cost, present value, and others as we explained. So when we introduce this topic, this first standard of our financial reporting, that is IS 16 property. IS, when we talk about IS, it is International Accounting Standard. So don't get scared when I talk about IS, because most of you guys are used of the other financial accounting terms, but this is the general name that has been given to these assets as we are going to be looking at them. property, plant and equipment, as we are going to be looking at them. But before I take you to any further, as far as, because when you see property, plant and equipment, those are non-current assets. Let's first understand something before we start to go deeper into the PPE. I'm going to be abbreviating it with PPE. Hope you can be able to cooperate with me with that word. I want you to first understand that there are so many standards that are dealing with with assets, especially non-current assets. So when we are talking about these non-current assets, what I want you to make sure or be able to identify in whichever asset they are talking about in the question, be able to identify the nature of the asset, be able to identify the purpose of the asset. Those two items, they are very critical in determining which standard are you going to be using to account for any non-current asset that has been given to you. So when you are talking about these non-current assets, we have them in terms of the tangible assets and intangible assets. As far as the intangible assets are concerned, they have a separate standard that accounts for intangible assets, and that is IAS 38, intangible assets. But today our main focus, since we are talking about property, plant and equipment, that is a tangible asset. The intangible ones, we know them: goodwill, trademarks, brand name, all that you know from there, or as we are going to learn them when we go to that standard of IAS 38. But I wanted you to get the concept. These non-current assets, they are supposed to be for more than one accounting period. I hope that one you know from financial accounting. If they are more than one accounting period is 12-month period. That's a 1 year. So we say they are grouped into the tangible and the intangible assets, and we said the intangible assets are accounted for under IAS 38. Then these tangible ones, you have also to identify, don't forget the purpose. I said the purpose and the nature of the asset is very important in determining which type or which kind of standard you are going to use to account for that property or asset. If it is a current asset, it is accounted for under IAS 2, that is inventory. If it is inventory, if it's what, we are going to be seeing them, but just know as far as assets are concerned, they are categorically classified in different segments, and each segment has its own standard that handles it. So when we talk about these tangible assets, we have sorted the intangible. Hope you can't get confused from there. The tangible assets, you have also to know what is the nature of that tangible asset. Secondly, you have to know what is the purpose of that asset. If the organization has that asset, it uses that asset for what? The tangible assets, they are also grouped into two as far as their purposes are concerned. The tangible assets that are used in the organization, that they are used within the organization for production purposes or supply of goods and services, and to a smaller extent rental to others. To a smaller extent, those are the ones that we group into PPE, property, plant and equipment, and that is the scope of where the IAS 16 stops. Then there are those assets that are held within the organization. They are tangible, but they are being given out mainly for earning rental income, or they are being set aside for capital accumulation. If, let's say, you have bought land, capital accumulation will mean you've left there for it to increase in value. If you buy land, let's say in a nearly developing area, and you leave it for 10 years, you'll find that if you buy it 10 million, you'll find in the next 5 years it will be around 50 million or 100 million, depending on the market conditions that are and the growing rate within that area. So if it is for market appreciation, if it is for rental, mainly rental to others to earn rental income, then those ones are grouped into investment assets. And those investment assets are treated under a different standard, and that is IS 40, which handles those investment property, as we are going to be seeing when we reach at that standard. Then for these assets that are used by the business, maybe in the production process to produce more goods, or to supply the goods and services. If the company is in services, it is used to maybe to deliver the service to other people, or to a smaller extent is used to earn rental. It does some production, and if you can, an example you can use maybe a crane. If the company has a crane for lifting these heavy items within the factory, it can be used out to get some rental, then it comes back for business. We shall look at that when we specifically trying to separate. After understanding these PPE and investment property, you get to know which one is which one and which one falls in which side after handling those two concepts. But basically, PPE is mainly for non-current assets which are tangible in nature, and they are being used to generate income to the business. And generating that revenue we are talking about, in terms of the income, we are talking about it is used in the day-to-day operations of the business. But there are other assets which are accounted for under different standards, like the biological assets. Those ones, they are not under PPE. They are also having their separate standard that handles them. There are these financial instruments, shares and bonds and all that other instruments as we know them. That's accounted for in another IFRS 9 standard. So this one, when you talk about PPE, before you read anything, just know it is mainly for those assets that are used to earn revenue in the business, and they are used in the production and supply of goods and services, or they are used for administrative purposes. It may be a building that has been constructed, but the company uses that building as its head office or branch or whatever. That's what we are talking about. It is mainly used by the organization to earn rental income, and it is going to be used for more than one accounting period. That's more than 1 year. That's how basically I can give you a brief review about the non-current assets. So having understood that, then let's push to this specific standard of IS 16, that is property, plant and equipment. And the other thing you may also need to know is that if a certain item is accounted for under different standard, it cannot be accounted for under another standard at the same time. Each item is treated differently depending on where it belongs. So please take note of that. So we can try to look at certain, before we reach to the main issue, we can look at what are some of the terminologies that are used within these standards. We can talk about the cost, and we said in the other previous video, we said that the cost is the actual expenditure you have incurred to acquire the asset. But this one we are mainly talking about assets, so you are not going to hear me talking about liabilities. Here we are talking about assets. The actual cost you've incurred or expenditure you've incurred to acquire the asset, that's what we call cost, as far as this is concerned. Then we have a residual value. A residual value is something that remains at the end of the useful life of the asset, what you can get from that It is called a scrap value previously in your accounting, but here we call it residual value, and it's what remains at the end of the useful life of the asset. Then we can talk about the useful life of the asset. That is the lifespan of the asset. If you buy the asset has to be there for a certain period of time. It is not like land that doesn't depreciate in value, that it will be there for forever. This one has a useful life. You may buy it, and even if the asset doesn't get spoiled, you may find that it becomes outdated. It cannot be worked anymore, be used for making work. You can talk about the computers. We have i-Core 3, i-Core what, Pentium what. Those ones that they are already outdated. Even if you still have it, but there are certain things which you can't do with them, even if you want to. So at the end of the day, we give it a useful life. Factors you depend on to determine the useful life, those ones you can read on your own. But maybe to give you a few, you can say that this asset, according to the activities I put it in, if let's say it is a laptop, you put it in the office all the time. You don't carry it to, let's say, in the field and all that. It cannot get like spoiled very fast. You can give it some useful life. So that's basically what I can talk about, the useful life of the asset. Secondly, we can talk about the value in use, or the entity specific value. The entity specific value, or the value in use, it's what we are expecting to get from the asset we have acquired. If let's say it is PPE, an item of PPE, and we have acquired it, what are we expecting to get for the period it is going to be with us? Those are the ones we look at, and we put in the time value for money. We try to look at the timing of those inflows. How are they coming? Then we try to discount them to make them present. So we are going to be looking at most of those things. Then the other one, we can talk about the carrying amount. The carrying amount, most of you are used about the net book value, but that's basically the same. It is cost minus the accumulated depreciation and the accumulated impairment losses. Impairment losses, we shall talk about it. It's also a different standard, but what I can tell you is that impairment is just the loss in value. We have bought the asset today at 10 million, but in 2 years' time, it's the amount you can get from it is, let's say, 2 million. That's basically impairment. That difference is what we call impairment. So that's basically what I can briefly describe before we dive into the specifics of the standard, because here the notes I made, they are not very broad. I picked the things that you need for you to pass the exam. So before we conclude with all this, we can talk about certain items that we are going to be following. We have to define what PPE is. We get the recognition, measurement, as we looked at them in the previous video. Those are the ones we are going to be looking at, and we see how we can be able to appreciate all that. How are we doing the initial measurement at acquisition data? What are we doing then? As we are going to look at them. So definition wise, property, plant and equipment refers to tangible assets. So that's the nature. The nature, they are tangible assets held by an entity for use in the production or supply of goods and services. Now the use comes in. It is used in the production or supply of goods and services, or for rental to others, but this rental to others is to a smaller extent. Most of the times it is used within the production, but once in a while it is being given out to earn some small rental income, or it is used for administrative purposes. We have constructed our house, and we have made that house to be our head office, period. That's administrative purposes, and are held for more than one accounting period. We said the other tangible assets held by an entity for use in the production or supply of goods and services, or for rental to others to a smaller extent, or for administrative purposes, and are held for more than one accounting period. So we'll try to look at the recognition. Recognition, basically we are just looking at how are we incorporating the PPE into our financial statements. What are the conditions that we are supposed to fulfill before we record any item of PPE into our financials? I said when I talk about financial statements, we mean the balance sheet, income statement, and the cash flows, basically. But there are other consolidated ones and whatever, as we are going to be looking at them in the due course. But we have certain criterias. If, let's say, we are saying we are supposed to include the PPE into our financials, then what will be the criteria for us to, or what are some of the conditions that we are supposed to fulfill before we say that we have an item of PPE? One, we are saying it's probable that future economic benefits associated with the asset will flow to the entity. I put them in blue because they are very important. It's probable that future economic benefits associated with the asset will flow to the entity. If you have any item, even if it is a tangible asset and it is used in the production, but it doesn't generate any income, it's not part, because it doesn't satisfy the recognition criteria. Then the other criteria is that the cost of the asset can be measured reliably. If you can't determine the cost of that PPE, then what are you going to put in which figure are you going to be recognizing? Remember, when you are preparing financial statements from our financial accounting, is that we only record monetary items that can be attached a value. Those are the ones we incorporate in our financial statements. So that's basically, there are two scenarios. If you satisfy those ones, then you recognize those assets. But upon recognition of those assets, then that we have decided that this asset is going to bring us something to the entity, or some money, some cash flows to the entity, and its cost we can determine it. Then which cost are we going to assign to that item? That's what we are going to be looking at in the next slide. That is the measurement. We are going to be looking at the measurement of PPE, property, plant, and equipment. I said I'm going to be using PPE. Hope you can be able to cooperate with me. And we are saying that we have two measurement criterias. These measurement criterias, they are very important because they tell us which base or measurement base are we going to use to recognize these assets. And we are saying that PPE, we have the initial measurement, and we are saying the initial measurement is the measurement at the acquisition, when you are just acquiring the asset. What figure are you recording in the statements? That figure you are recording is what we call the cost at the initial, that is the initial measurement. And we are saying this is the cost this is the time at the time of the acquisition of the asset. And the standard says that PPE is initially measured at cost. We measure items of PPE at cost initially when you have just acquired them. Of course, that's obvious. When you acquire any asset, the amount you have paid to acquire that asset is actually what we are going to be recording, because we are not going to be having any information that we are going to record. It's only that amount that we are going to be recording in our financials. But when we talk about cost, the word cost is very broad. It doesn't necessarily mean that it is only the purchase price of the asset. There are other costs that are supposed to be capitalized, if I can call it that way. there are other costs that are supposed to be added to the asset. If, let's say, can give you a short example, if you buy inventory, and if, let's say, the cost of the stock is 10 million, and you are incurring transport cost of 2 million, that transport cost of 2 million is supposed to be part of the cost of the stock, because we are looking at what are the expenses you have incurred to bringing that those assets you are purchasing to their useful state. Actually, that's what we are supposed to incorporate in the cost. If you are purchasing the item from abroad and you're bringing that item to Uganda, and let's say it's supposed to be starting operating at any given date in time, then the cost of purchasing that item is inclusive within the cost. Even the transport we are incurring from overseas to Uganda, where the item is going to be operating from, those costs we are supposed to accumulate them, or we capitalize them to get the total cost we've incurred. Then there are also other costs. If the asset reaches here, it doesn't mean that that asset is going to start functioning. An example, if, let's say, you buy a new laptop, you may find that the software which is there is you may need someone to at least to reoperate the machine so that you can be able to use it. If, let's say, you are buying a car, and you may find that you'll get a mechanic who can just try to drive in and see what is missing within the asset and how the asset is operating. So those costs you are incurring to that person, they are supposed to be capitalized, or they are supposed to be included within the total cost. So basically, what I'm talking about is that we are incurring those costs that are inevitable, and when we don't incur them, the asset is not going to operate. We are supposed to capitalize them, and we add them to the price we've paid to acquire those goods, and we'll be able to get the total initial cost. I've highlighted some of them, but there are very many items that are associated with the asset. But what you have to understand is that if you see that asset, if that cost is not incurred, the asset will not operate. That cost is supposed to be essential, or is supposed to be a relevant cash flow, which is supposed to be added back. That's basically how we can differentiate them. What we are saying, we are going to be looking at the components of the initial cost. Initial cost, we have the purchase price, that is the price you are paying for the item. But remember, there are certain instances where you are going to be paying the asset, to be purchasing the asset, but they give you a discount. If you are purchasing the asset, the cost of the asset is 11 million, but someone says pay 10 million, and you take the asset, if at all you are paying all of the money. That discount you are receiving is supposed to be less, because obviously it's not supposed to be included, because that's not what you actually paid. The purchase price was supposed to be 11 million, but you actually paid 10 million, and they gave you the asset, and they are not demanding you. So it means we are recording the 10 million, not the 11 million. If there are other rebates, you may purchase the items and they say you pay 11 million, but after taking the item, after paying all the money, we are going to refund you back the 1 million. Those rebates, you less them. Meaning, what we are taking is the net purchase. Net purchase means we have raised the discounts. So on that price, because that's actually what you have paid. But remember, where you are purchasing those items is not that person to incur the rest of the cost until the asset is at your premises. You are going to incur. They give you the asset, and you see how you can import it, if at all it has been from overseas. You find that there are other import duties and other non-refundable taxes, mainly direct taxes, which are incurred when you are, let's say, importing the item from overseas. That one is supposed to be part of the asset. They are either import or direct taxes. Then the other one is we are supposed to incorporate in any cost we've incurred, but it is directly attributed to the asset in its useful life. If you are incurring that cost, but that cost is directly related to the acquisition of that asset or bringing that asset into its useful state, then it's supposed to be, because if at all you're acquiring an asset and it is not going to function, then it doesn't make any sense for you not to incur other costs so that the asset can start operating. So these other costs that are directly attributable to the operation of the asset, they are very many, but they are going to be very tricky, but I've highlighted some of them. We have the site preparation, installation, testing. Then we have the professional fees, like if it is a land, you're going to get some documentation and all that. So you may need lawyers and whatever, accountants, or all depending on the item you're purchasing. Then this last one, the initial estimates of the dismantling asset and restoring the site. That one is a bit separate. It is not very tricky, but the tricky one is getting those costs that we've incurred, but they are directly attributed to the operation of the asset. So when you have known that, then we have this last one, the initial. This initial one is the one that is not very tricky, because someone can be able to remember this. But this initial estimate cost is that if, let's say, you've been operating, let's talk about these people who are doing the mining operations. After you have been given the mining area or the contract area for that, where you're going to do your either mining or drilling oil or that petroleum and whatever. So the cost you are incurring, because when you're going to be doing mining, you are going to be digging underground to be able to look for those minerals you have explored. So these costs you are going to incur in the future if all the operation, your contract is done and you have got whatever you had paid for, but the land is still like you have disorganized the land. Then the cost of maintaining the land to the state that is exactly how we found it before starting your mining activities is what we call that cost you are going to incur in the future, but it is relating to the maintaining of the environment. If, let's say, you are disorganized the environment and you are going to make sure you reorganize the way you found that surface. If you are in mining, that cost we are going to incur, we are supposed to incorporate that cost into the initial cost, because that cost is going to be, at the end of the day, you are going to pay it, even if it is going to be paid in the future. But we try to discount it. We bring in the time value of money. We look at what will be the present worth of that cost. Make sure when you are getting this item, if you find it in the question, you discount it, because it is going to be in the future. You are not going to incur that cost now. You are incurring that cost in the future. So if you are to incur that cost in the future, but you are accounting for it now, you have to discount it and you get its present worth. After getting its present worth, then you can be able to incorporate it into the total initial cost. So when you get all that and you add them up, you will be able to get the total initial cost. That's what we are going to be using to initially record our PPE. Hope you can be able to get that, and we can proceed. Of course, we said for initial measurement we measure them at cost, but we've seen all the components that we are supposed to be included, that are supposed to be included in our cost. So we can look at the first one, we were the initial measurement, that is at the time of acquisition. Then we can look at subsequent measurement, and this subsequent measurement is the reporting date, or at the end of the year. What figure are you going to take? Are you still going to maintain the cost, or you are going to use a different figure? We said in our first video on this financial reporting that there are other measurement bases that we use. So if you have recognized the asset initially, and you have recognized the PPE at cost, then what will be the subsequent measurement, or at the date of reporting? You have acquired the asset, let's say today, but when the year ends, which asset are you going, which value are you going to assign to that asset? Because remember, there are some items of depreciation and impairment losses. So there are two, when you are looking at the subsequent measurement, or at the reporting date, or at the end of the year, there are two models that we use to account for PPE at subsequent, or at the end of the year. So we are saying that one, we can account for those assets at using cost model. A cost model is more of using the historical cost. Is more of a historical cost, whereby these items of PPE, they are carried at cost, less accumulated depreciation and accumulated impairment losses. Because if you have bought the asset, let's say on 1st January 2022, by the end of 31st December 2022, that asset will, we assume that it is going to be reducing the value in terms of this depreciation and the impairment that may happen along the way, because you don't know what will happen. Depreciating these assets is more or less of spreading the cost of the asset to its useful life. If you are spreading the cost of that asset to its useful life, it means every year it is going to be reducing in value. That's basically what cost model is all about. We carry those items of PPE at cost, less accumulated depreciation and accumulated impairment loss. We said impairment loss is just a reduction in the value of the asset, but we are going to look at it in details as we proceed. Then the second module is about the revaluation. It is a revaluation model. Evaluation, we said it is the estimated marketing price. We get what will be recovered from the asset at the point of revaluation. If at least, if let's say you bought the asset at 10 million and now you take it to the market, or you go for revaluation, and you find that the asset which was bought at 10 million, it has reduced either to 8 million or it has increased to 10 million to 15 million, you get either a loss or a gain on revaluation, as we are going to be looking at them. But here we are saying that the items, if you are going to be using the revaluation model, we are saying the assets are carried at the revalued amount less any subsequent accumulated depreciation and the subsequent accumulated impairment losses. So when you less those ones, you are able to get the carrying amount using the revaluation model. So when you carry these assets at using the revaluation model, we are going to be requested to make or to determine the depreciation of that revalued asset, because the asset, if this asset was initially bought at, let's say, 10 million and it is now at 15 million, the depreciation is going to be different. The depreciation of the cost that has been revalued at 15 million is different from that of 10 million, which was the cost. And even the useful life of the asset that was acquired at cost is different to that useful life of the revaluation, because after revaluation comes after you have already purchased the item and it has been there for some time. So you may have to redefine what will be the useful life, because by the time you go for revaluation, you will first of all know the cost, its estimated market cost, and you will also know what is the estimated useful life, the remaining useful life of the asset. Those are the two things we revalue. We revalue the cost, the item, and we revalue also its remaining useful life. You may find it doesn't mean that if you bought the asset at 10 million and you estimated that its useful life will be 10 years. It may happen that at the point of revaluation, you may find that you had expected, if let's say you do the revaluation at, let's say, after 3 years, and in the normal case it would have remained with the 7 years, but you may find when you do the revaluation, you may find that the asset can even last for more than 10 years. Of course, you will be having a different depreciation, so we need to determine the depreciation of the revalued asset. And we are saying, when we are determining, it is the same formula of determining the usual way we determine the depreciation, but only that here we are using the remaining useful life. We are not using the old useful life of the asset, but we are using the revalued useful life of the asset. It is the revalued amount minus the residual value over the remaining useful life. There is a scenario which happens that the depreciation you created at initially will be different from that of the depreciation that you have got after revaluation, which will give rise to either excess. You may find that the depreciation is high or it is low, and we shall see how we can be able to treat those ones. Okay, let's try to look at the items of revaluation, and we try to look at how we can be able to account for the revaluation gains and losses. We said that when you are doing the revaluation, the asset is either going to be having a higher value compared to what it had before, and it may be more or less the other side, or it may be less than what its carrying amount is at the time of revaluation. So it may create either a revaluation gain or a revaluation loss. So let's try to look at how are we accounting for those revaluation losses and gains. We are saying accounting for revaluation or revaluation gains or losses. We are saying that when an asset is revalued, there will be a gain or loss on revaluation, and we are saying to get the gain or loss, we get the valued amount less the carrying amount. We say the carrying amount, it is the net book value of the asset at the reporting date or at the time of revaluation. What will be the carrying amount of the asset at the time of revaluation? Remember, this asset we are revaluing, we bought it sometime. So by the time we bought it, we estimated the useful life, we estimated the cost. So we also determined its depreciation. So when we revalue the asset, we first of all, by the time it took us to do the revaluation, there are some depreciation which has been accumulated. So you get that cost minus the accumulated depreciation to get our carrying amount. That's how we get the carrying amount, which we are going to be using to compare with the revalued amount. We see whether there is a gain or a loss on revaluation. So how do we account for a revaluation gain? We are saying that revaluation gain, this arises when the revalued amount exceeds the previous carrying amount or net book value of the asset. We said if we revalue upwards, it means there is a gain. That gain comes after comparing the revalued amount and the previous carrying amount, not the cost of the asset. It is carrying amount, because by the time we do the revaluation, there is depreciation which has already occurred. As we said from initial measurement, we say the initial measurement, we measure them at cost, but subsequently we less the accumulated depreciation and impairment losses that may happen. So when there is a revaluation gain, we say that we take that. Remember, these revaluation gains and these revaluation losses, they are not actually realized. In actual sense, we have not actually incurred those losses, but it's just that we've revalued the asset and we've got a more or less a high figure, but we have not actually sold the asset. The asset is still with us, but what we only did is to get its current market value. So since they are unrealized, we don't take them to the income statement or profit and loss account, but we take them to OCI, that is other comprehensive income. The other person may say that we create a revaluation surplus. At the end of the day, that revaluation surplus is supposed to be taken to the balance sheet under equity section. That revaluation surplus. Remember, in the normal business transactions, revaluation gains and revaluation losses, they are not supposed to be taken to the profit and loss, because they are not actually realized, they are not actually real. We've just made them. So let's try to first look at the revaluation again, then I will explain that component later, how we treat those things. We said the revaluation gain happens if the revalued amount is higher than the carrying amount. It means the assets are now increasing in value. And we said when the assets are increasing in value, that's income. That's why here we are crediting the OCI, that is the other comprehensive income. Then the entries, the double entry will be, we debit our PPE or our land or building, whatever item it is, because it is increasing in value. So if it is reducing in the value, let me first handle the revaluation loss before I go to this NB. There is a simulation. Let me first talk about the accounting for revaluation losses. These losses, they arise as a result of the carrying amount being more than the revalued amount, or where the revalued amount is less than the carrying amount. From there, we have a revaluation loss. But this revaluation loss, we can't create a revaluation loss account, no. But we take that item to the profit and loss. It's like when we take that item to profit and loss as an expense. In the normal business, we are saying that is not how it's supposed to be. But if we are doing the revaluation for the first time, and we have the assets are reducing, we have a revaluation loss, we don't create a revaluation loss account. If it is for the first time of evaluation and you have a loss, we don't create it. What we only do, we take it to the income statement. By taking it to the income statement, it means, remember, the revaluation surplus is taken to other comprehensive income, or we can take it direct to the equity. But this one, when you include it in the profit and loss as an expense, it means it's going to reduce even the equity. How is it going to reduce the equity? Because the net profit we are going to be carrying to the equity section is going to be less by that figure. What that means is that when we do other revaluations in the preceding revaluation and we get a gain, if at all we had made a loss, if let's say we have made a loss today and we have done our revaluation and we've made a loss and we've taken that to the profit and loss, it means we have understated our equity section gain. what happens is that if it is not if it is the second time when you have the first time you had a revaluation loss, but the second time you are having a revaluation gain, it means that that revaluation gain we've got from that second revaluation is supposed to first offset the previous revaluation loss we incurred, because in the normal course of business that revaluation loss is not supposed to be taken to the profit and loss account because it is not actually realized. That is the implication. So what we do, if today we have got a loss of 10 million and the next revaluation we get a revaluation gain of 15 million, what happens is that we first of all get that revaluation gain of 15 million. We first remove the 10 million to offset the other revaluation loss we took to the income statement. How do we do that? We credit the income statement. By crediting income statement with the same 10 million, it means you are removing the other figure you included last time, because by this time you are recording it not as an expense but as an income by crediting the income statement. Remember, we had debited it with the loss, but here you debit it with the reversal of the loss. But now what will happen is that the asset will have, if on the second revaluation it had the whole 15, we shall increase the asset by that 15 million. Because remember, by all means, what we are taking to the balance sheet must be the revalued amount, not the carrying amount, the previous carrying amount. So we shall increase the asset account by 15 million, but we credit profit and loss in regards for reverse of the revaluation loss of 10 million. Then the balance of 5 million is what we shall be taken to the OCI as the 5 million. So this 5 million, we will be crediting the OCI with the 5 million. We credit profit and loss. So it is even the reverse is true for the other. If at all in the first year you had got a gain, but in the preceding revaluation you are getting a loss, that loss first is supposed to reduce the gain we got previously, and the balance is what we shall take to the profit and loss. Hope you can be able to get that. That's what this NB was all about. This is how this, however, is talking about what I have actually explained. And this NB, that's what it was talking about. Here we are saying that NB, the revaluation gain, will however be taken to the profit and loss to the extent that it reverses a previous revaluation loss. Remember, we said the valuation gain, they are not supposed to be taken to the profit and loss. They only go there when they are reversing the loss that we took there. And any balance is what will be taken to the profit, to the statement of other comprehensive income. Other person can say the balance will be taken to the revaluation surplus, but all it means the same thing, so long as you get the concept. That's why here you are saying we credit the OCI with other, that is the other comprehensive income, the balance, meaning the balance. Then we credit the profit and loss account by the previous revaluation loss. Then you have to debit the asset. This one is will be having the whole revaluation gain because the assets will be increasing in value. It is the same thing which is here. That if previously, this one says, however, the loss will be taken to the OCI. Remember, this loss is not supposed to be in the OCI. It's supposed to be in the income statement. But it will only be taken there to the extent that it reverses the previous gain, and any balance will be taken to the profit and loss account as a loss or as an expense. That's why here you are saying we are debiting the OCI. Remember, this OCI is not supposed to be debited. It is only debited because this is income, other comprehensive income. It is only debited when we are reversing the loss rule. Then we of course we credit the PPE because it is falling in value. Then we debit the balance is what we shall be taking to the profit and loss. So I have a simulation here. There is a simulation which I was just jumping here. but I needed to first explain that before we do that simulation. There is a simulation on revaluation, accounting for revaluation gains and losses. I gave you these figures. There are two simulations, and this one is another simulation. Okay, let me first explain this before we do any computation. We said that this excess depreciation, how we talked about this excess depreciation, they arise as a result of the first. Remember, we said these elements of PPE, they are initially measured at cost, and they are subsequently, or they are reported when you have deducted the accumulated depreciation and accumulated impairment losses. But what will happen is that there is that depreciation that happens before you revalue. You may find that the depreciation before revaluation was 10 million, and after revaluing, because the revaluation amount has changed from what we had before, it means even the useful life has changed. It means we are going to be having a revaluation that is a bit high or low, depending on the figure we've got. But if we get it when it is high, then that excess depreciation is supposed to be treated as an income, and it is taken to the retained earnings. We are saying that this arises when the depreciation after revaluation is higher than the depreciation before revaluing the asset. For example, depreciation before revaluation of 10 million and depreciation after revaluation of 15 million, then we have excess depreciation of 5 million. And we are saying an entity may, this is optional, you may do it that way or you may leave it, because at the end of the day, we had accounted for those revaluation losses and gains. So this is optional. And we are saying the entity may make a transfer of the excess depreciation from the revaluation reserve to the retained earnings. That's what I told you, that's what I've been talking about, that revaluation surplus is taken to the equity component. In the names of retained earnings, you may put it under retained earnings, or you take it directly as retained revaluation reserve. But it's mainly recorded within, because since it is from within the normal operations, it's supposed to be taken as retained earnings. So that's how basically we can talk about this PPE. I hope you've got a clear picture on what we cover under that. So the next slide is all about these simulations, which I've just skipped because it's now seems to be time. But in the next video, we are going to be talking about an illustration. We'll do all those computations and we'll be able to understand each and everything. So thank you for watching. I urge you guys to subscribe and be able to click the notification icon so that you'll be able to get whichever video I'm going to be posting, and you'll be able to learn, because this is a foundation of accounting, mainly accounting and finance, where we are able to learn everything at our own pace. So let's meet in the next video. Thank you. Good evening, viewers. Today we are going to proceed with our computations, and in the first video of IS 16, that is PPE, we spoke about and we did some numbers on when you have a revaluation loss in the first place, and later on the asset is revalued at a later date, and we saw how we can be able to reverse the previous loss using the current gain we've got. But in this circumstance, we are going to look at a scenario whereby we have begun with a gain, and in the next year we've got a loss. How are we going to be accounting for that? Without wasting more time, let's kick off and we'll see what we can do in the shortest time possible. That's basically Let's try to go into Excel and see what we can be able to do as far as this is concerned. And we are looking at how we can start. So as the Excel loads, we have a question says ABC Limited acquired land in 2018, which originally cost 40 million, meaning the cost of the land was 40 million in 2018. But now in 2019, we are seeing that the land was revalued to 45 million. And in 2021, the same land was revalued for 36 million. We used the previous question, but we just amended the figures to help you follow up easily on what we are doing so that you can be able to understand. Because I know when you understand these principles, that's why I'm using basic examples so that when you understand this, you can't be able to fail to have these things done when we are solving more questions as they are going to be coming in. Remember our last video on IS 16 is going to be on how are we going to be accounting for the an asset of PPE at initial recognition. Then we try to look at certain items and we see how we can accumulate them up, and we see how we can be having. So for today, let's continue with what we are going to be looking at. It's a simulation 3. If you have the notes, you could be able to follow up. Okay, I can maximize this, have something. Okay, I think that one's enough. It can help us. Okay, that one will be enough. We said it is ABC Limited. ABC Limited. And the question says, how are we going to be? The question says required show how the land will be accounted for in 2019 and 2020. I put for these solutions so that when you're doing them alone, you'll be able to follow up and you have something that can guide you as when you're doing these numbers. That's basically what we are going to be doing. And we said whenever we are starting any question, we start with summarizing the information that has been given to us. And we've seen that the cost in 2019 was, the cost as far as 2019 is concerned, it was, let me try to make this, it was 40 million and it was revalued to 45 million. It was revalued to 45 million. Now this was made in 2019. Then we try to look at the evaluation that was done. Then it also revalued that this was made in 2020, and the cost was 36 million. So those are the things, those are basically the items that we have. So we go to try to see how we can be able to determine, maybe we can bring in a formula, because what we are looking at is accounting for gains and losses. And if you didn't get well of how we do, how we define the revaluation gains, you can be able to watch our previous videos and be able to understand what those are meaning. So revaluation gain, said a gain or loss, these things cannot occur at the same time. An asset can't be revalued at upwards and at the same time revalued downwards. No. We said it's going to be the revalued amount, we less the carrying amount. Here we are lessing the carrying amount of the asset at the date of evaluation. So having seen that, we can try to look at, because they told us we are going to be showing how we are going to account for these gains and loss for the above transactions in 2019 and 2020. So we got 2019, we said we had a revaluation gain. Sorry, we had a revaluation. Evaluation was 2019 was 45 million. Then the carrying amount, since this is still the same, a non-depreciable asset, the carrying amount will remain the same. The carrying amount for 2019. Some questions you may find that the carrying amount, but they have given the carrying amount of the asset at 2018. So you make sure you convert it up to 2019, which is 40 million. So now here we are seeing that the revalued amount is higher than the carrying amount. So we have a revaluation gain. A revaluation gain, which will be the difference. It will be equal to the 45 million with less the 40 million. And this will be giving us 5 million as the gain. That's the gain we had in 2019. Maybe I can make this one a bit so that you know that these are hard-coded figures. These are the figures in the question. Okay. Now we try to look at, they told us we look at how we are going to be accounting for these items. I told you if you can't make these notices, you write what you are doing, that this, like if let's say you have got the end result as a gain, you tell the examiner what the implication of what you've got. Meaning we have got the gain, you can say that the gain of 5 million will be taken to the other comprehensive incomes in the profit and loss, and the asset will also be carried at the valued amount. But if you have any way you can put a double entry, it makes more sense. It gives someone more explanation, because when you bring these debiting and crediting, at least you are trying to explain something. We said if we get a gain, what we do, we debit. Since the asset again means, again has two implications. One, it increases our other incomes, and at the same time it increases the value of the asset. Remember we said when assets are increasing, that's an income. When assets are reducing, that's a liability. We are recognizing an expense. That's basically from the definition of the elements of financial statements. We explained those ones, and if you see you are not understanding, please go back and try to memorize those so that you can be able to catch up. So one of the things we are getting, that the land is going to be increasing in value, but it is going to be increasing by 5 million. Remember, initially it was 40 million. So it is going to be, when we debit, it means we are adding to the 40 million to make 45, which is the valued amount. So we are going to be crediting our OCI. Permit me to use OCI, but it means other comprehensive incomes in terms of the revaluation gain. But here I want you to get something. It is something I want you to get from here. We said, and this I did not talk about it in the previous video. We said that when the asset has a revaluation loss, we don't create a revaluation loss account. But what we only do, we take that figure, the profit and loss. But for a revaluation gain, when it happens, what we do, we can create a revaluation reserve or a revaluation gain account. And this figure of 5 million will be taken as a revaluation reserve in the balance sheet. So I'm going to show you how we do that. But this revaluation gain is supposed to be taken to the balance sheet as a revaluation reserve. Because what you do, of course, you credit. We are taking now this figure to the, we are going to be adding it to our retained earnings at the end of the day. Because putting it in the OCI, it means OCI comes after when you have determined the profit for the year. That's where we have other incomes. We shall see those ones when we are preparing these income statements. But what you have to understand is that these OCI, other comprehensive incomes, it means those are incomes that that were there, but they were not as a result of these operating activities. They're not the day-to-day operating activities of the company. Those are the incomes we put there. The revaluation gain, because in the normal situation, you're not supposed to be having these revaluation gains and what? And losses. That's why they are taken to the balance sheet under equity. So I'll show you how we take this. Anyway, we can do, because that's basically what we are supposed to do. Then maybe we can do the statements. Can do the statement of finance. Let me say financial position. Sorry, financial performance. Let me use the exact profit or loss and other comprehensive income for the year 2019. And we come to other, remember we don't have depreciation, so we are going to go to other incomes. But these other incomes is not that other income that reflects after gross profit. This one comes after the net profit. That's where it is supposed to be. Other comprehensive income. Or we could call it OCI, because I've been using OCI. Let me maintain the OCI. And we put evaluation gain of 5 million. Valuation gain of, that's basically what we have to put in our financial, the profit and loss account. Then we try to look at the statement of financial position. This is the balance sheet. Financial position as at the end, as at 2019. Just stop there. As at 2019. We said we are going to be taking the value of the asset at, we said we are going to be taking the valued amount as our, said we are going to be taking under non-current assets, and we put our land, or we can put PPE, because this is the general name that was given to these non-current assets that are used in business. As you know from what we define what an item of PPE is. Okay. When we take these figures, now we are seeing that we are going to be having the value. Now we said we are taking the valued amount, even if it is the lowest, we take it, which is 45 million. Meaning that when we go to other incomes or equity section, can put where we say financed by, but this one we can say equity. Equity section, we said we put the evaluation reserve. We normally call it evaluation reserve. We put those incomes that are, that's why we incorporate all the figures, evaluation reserve. because it may not be one asset. You find that all the figures you are going to be accumulating them there, which is 5 million. And that's how basically what you were supposed to do for that land in 2019. Even this financial position may make it a bit so that you can be able to differentiate. So we go into 2020 and we see what are we going to be taking. Remember this asset, this amount that is reflecting at the end of the year, it will be the amount that will be there at the beginning of next year, because it is the one that is at the close of the year. So we try to look at what we have and we see what we can get. They told us the land was revalued in 2020 and the amount was 36 million. It means there, this one we had 45, but at the end of the 2020, we are seeing we have 36 million. So it means we had a loss. So we go to the revaluation amount or the revalued amount. The valued amount, we are seeing that the valued amount is 36 million. That's what they are telling us in 2020. But the carrying amount, since we don't have depreciation, the carrying amount we are seeing it is 45 million. It's not 40 because we ended in 2019. So when we are going to be having a revaluation loss, which is going to be got after deducting the 36 million minus the 45 million. And when we do that, we are able to get a loss of 9 million. And as this 9 million, what we said here is that this figure is going to be reversing the previous gain we had. We can't recognize that we had a loss of 9 million, the whole 9 million, and we take it. We first reduce the 5 million, which was the gain that we had last year, and we take the balance. So what that means, it means we are going to be debiting our land. And the reason why we are debiting our land, because there is something, sorry, we are not debiting the land, we are crediting the land. But remember we said whenever we are doing these entries, we start the debiting entry. We are going now to be debiting our profit and loss. Profit and loss account. And this one is going to be our evaluation loss. Which evaluation loss was, but here we are taking only the excess. It is 9 million minus the 5 million, which is here. It means we are only taking 4 million. And we are going also to debit again the OCI. The OCI, we are saying that this is going to be reversal of gain, the gain we got. And we are reversing only 5 million because that's the gain we had in the previous year. Then we are now crediting the asset because the asset, we are crediting the land because the land is now reducing in value. And it is reducing by the total of 9 million because it reduced from 45 to 36 million, meaning that even when we are taking, when you are taking these figures to the financial position, the value of the land is going to be at 36 million, not at 45. Hope you can be able to get that. But now I want you to again try to look at how are we going to be differentiating these items. Here we are having an element of devaluation gain, sorry, devaluation reserve of 5 million. But here, these 4 million we have here as a devaluation loss, for it is only going to be reflecting in the income statement. We are no longer going to be having the devaluation reserve, because we said whenever it is a loss, we don't create a devaluation. Now this one is for 2019, but we wanted the profit. Let me just copy this. But now here we are popping for 20. This is 2019 now. This is 2020. It's 2020. So we are going to be having under our operating expenses. We are going to be having a valuation loss. Valuation loss, which we have here of 4 million, which was the balance after offsetting the other gain. And that's going to be that, because we don't have depreciation. If depreciation was there, we could put it there. Then maybe we can look at the statement of, let me copy also this one. Statement of financial position, but this one we are looking at 2020. So it's going to be under our non-current assets. This non-current asset, we are going to be having land. Said you can say PPE, but this land is now going to be carried at a revolved amount, which is the 6 million. And we are not going to be having any valuation surplus, because we never had a gain at the end of the year. And that's basically what we do with an asset that has registered a valuation, with an asset that has registered a valuation gain. An asset that has registered a revaluation gain in maybe in the previous year, but this year it is showing a loss. So basically that's what we do. Maybe to remove these, can try to remove these grid lines, and we see these figures well. And that's basically what we were supposed to do for this. Maybe even these double entries, I highlight them because they are very important. Don't ever forget. If you see that you can be able to do this, then you'll be able to put them there, because you'll be earning some marks for them. Thank you for that. Till we meet for the next one, which is going to be from a past paper, and it's going to be looking at some of the items that are going to be depreciable items, and at the end of the day, we were required, or We are supposed to determine the initial cost of an asset at the time of recognizing those assets, as we are going to be seeing in the next video. Thank you. Until we meet again. Evening viewers. This is our last part as far as IS 16 is concerned, PPE. And in this video, we're going to look at one of the past paper number, and we are going to be getting this question from May 2019, question 5A. And the required says we are going to be showing the extracts for the company's financial statements, reflecting the movements for the year using cost model and evaluation model. Basically, what I want you to understand is that when we are looking at IS 16 PPE, we tried to look at how are we going to be measuring the cost. Sorry, how are we going to be measuring the assets of PPE using, first of all, we try to look at initially, what are we recognizing? We said we recognize these elements or items of PPE at cost. That is initially the cost we have incurred. But we went ahead and we said that these costs that we are going to be incurring in purchasing these non-current assets that are going to be used in the business, they are not only the purchase price. We consider so many things, as we saw in the first theoretical aspect that we had, and we looked at the purchase price and other incidental costs that are going to be directly attributed to the asset. Then we looked at the other item of the unavoidable costs of dismantling and restoration of the site after the useful life of the asset. We try to look at some of the exemptions. What are some of the things that are not supposed to be included within the cost of an asset that we are going to recognize initially? And one of them, we looked at the pre-production costs or the startup costs that are incurred to test the asset, whether it can be able to meet the normal production before actually the actual production begins. If you do those pre-testing of the machine, that because by the time you start doing the pre-testing, it means the asset is now already functioning. That one is not supposed to be included. Even their losses, you've done that pre-production and you've sold what you have produced, but you made a loss in that. Those losses are not going to be recognized within here. The other one, the administrative costs that we may incur. We've been training staff on how to handle the item. We've installed in a new machine and people need to be trained. They are relevant costs, but as far as determining the cost of the asset is concerned, they are irrelevant. So they are supposed to be expensed as and when they are incurred. So basically, we try to look at all that, and this question is going to be testing us on that. Or it was actually those people who sat, they were tested on that. What are the things that are supposed to be incorporated in the cost when we are initially recognizing an item of PPE? Then we try to look at, because when you see the question saying and using cost model and evaluation model, it means the question is now looking at the measurement basis, or how are we going to be measuring? Okay, they have given us the method. They are measuring PPE using cost model and evaluation model. But these are more or less the ones at subsequent measurement, or at the reporting date. Which figure are you going to be taking when you're using the cost model? Which figure are you going to be taking to the financials when you're using the evaluation model? That's basically what we are going to be looking at. And that will mark the end of our simulation 4, which will have, at least by the time we'll finish this question, we'll be having some light whereby you can be able to attempt more numbers. Before I forget, there is a trial number. That's a trial number. That's August 2017, question 4C. You can try to look at it. When you have at least gotten some idea from this, we'll be able to have something. That's basically what we can talk about. Let's go through the question and you see what the question is telling us to do. But what I could advise, whenever you've been given a question, first look at the required. By the default, when you look at the required, by the time you read through the question, you know what you want from the question. When you look at the required and you see you can't attempt the number, just ignore and look for another number, because at the end of the day, you may read through and you reach at the required when you can't even interpret, and it will need you again to reread the number, which will be consuming time. So basically, without wasting time, let's try to look at, so we know what we want, we know what cost model is, you know what evaluation model is. Let's try to look at the question in detail and you see what we are going to be having. You're saying the Uganda Minerals Limited is a company engaged in the exploration and evaluation of gold in Uganda. UML acquired machinery on 1st December 2013 at a cost of, it is 1st January, not even December. Let me to use this 1st January 2013 at a cost of 50 million. We have other costs that we've incurred, meaning this 50 million was the purchasing price. If we had trade discounts, we could deduct them, or rebates. We never had one. They're saying other costs incurred to bring the machinery to use included 10 million for site preparation, 5 million installation costs, 8 million professional costs. Then the useful life of the machinery was estimated to be 20 years. It's UML's policy to call out an evaluation of all items of PPE, property, plant and equipment, every 5 years. Then they went ahead and said on 1st January 2018, the same machinery was revalued to 60 million with assessed useful life of 16 years. Then we have the required. They are saying required prepare extracts for UML's financial statements reflecting the above movements for the year ended 31st December 2018 using 1 cost model and 2 evaluation model. That's basically the year they wanted us to prepare these books is 31st December 2018. But when you try to look at the question, you see that they have given you figures of 2013, 2018, and all that. So basically, we said when you are handling a number of these assets, what you have to first find out whether the assets are going to be depreciable assets or they are going to be non-depreciable. Having confirmed that maybe the asset is depreciable, because here we are talking about machinery, they are not land, meaning they are going to be depreciated. So having known that these are depreciable assets, in your minds you start understanding what are some of the the deductions that are going to be charged to an asset, to a depreciable asset. They have given us the useful life, and that's basically the information we have. We can go to Can try to go to Excel and see how we can be able to interpret what we have got, we solve the question. Okay, try to enlarge this and be able to have something that can fill the screen. That can be enough. Okay, it's UML. Then it's better whenever we are dealing with the assets, you make sure that you look at the days, the date we are reporting and the date when these assets were acquired, especially when you're dealing with depreciable assets. So it's ML, but for the year, meaning we are looking for the year ended 31st March, 31st December 2018. So that's basically what we can get from that. Maybe try to highlight a bit. If you try to get the information we have, but they have not, what you have to understand is that they are telling us we are going to be using the cost model, but they have not given us the cost of the asset. So we need to first of all determine the cost of the asset, the initial cost, what they actually paid to acquire that asset. We spoke about the items that are going to be included in determining the initial cost of the machinery. And one of them we said it's going to be the purchase consideration, purchase price, the purchase cost, which was 50 million in the question, 50 million. And we have to add other incidental costs that are directly attributed to the asset. Let me zoom this one a bit. Try to put the 15 million here. Million. And we first add these other costs that are incurred, and we are saying, when you try to look into the question says we incurred other costs to bring the asset to use, meaning all these assets were incurred in bringing the asset to use. If these costs are not incurred, it means we can't operate the asset. So that's basically what you look at. If you see that, you first compare, if at all I'm not incurring this cost, will I be able to have this asset functioning? If the answer is yes, then we are not supposed to include that cost. If that cost is not incurred, the asset will not operate. So it means all those assets are going to be, all those costs are going to be accumulated, and we add back to, or we capitalize them to the purchase price that was paid. And we are saying the other costs include 10 million site preparation, 5 million installation, 8 million professional cost. So we add all that, and we are seeing site preparation. The next one is installation. The last one was professional fees. We are seeing that the professional fees, there were 8 million. Here, 8 million. Installation was 5 million. And site preparation was 10 million. So this one is installation. So when you sum these up, we'll be able to get, we are going to be able to get 23 million. And on this 23 million is what we are going to, when we add this 23 million plus
the other 50 million, which is the purchase consideration, we shall be getting the total initial cost that was paid to acquire the asset at the acquisition date. Initial cost of the machinery, total initial cost of the machinery of the machine is going to be the other one plus this one, which will give us 73 million. And this 73 million is now going to be our cost that we are going to be using when we are dealing with this asset. So that's basically the total initial cost that we incurred in the acquisition of that asset. So having known that, then we can be able, because now if you don't have the cost, then there is nothing you can do. But since we have got the cost, now this is the cost that we incurred on first. Actually, this one we could put, it was on first January 2013. That's when they bought this asset. Like this one bought. So if that was the cost, then we go into what the question wants us to have. Then we are saying that Longman one wanted us to use the cost model and see what we are going to be having at the end of cost model. But this one is at the end, which is 31st December 2018. So which figures are we going to be using, or which figures are we going to assign to this item of PPE at the end of the year 2018? And we said, first of all, this is reporting, so we expect you to do some narration of what actually do we mean by the cost model. What is cost model? Those are the things you are supposed to first narrate. First say that when you are using this cost model, of course, we look at, because when you don't, for a person who doesn't understand, or the person who doesn't have an accounting background, will not understand what cost model is. But when you are, before you actually answer what they want, or before you prepare these financials, you have to first explain what cost model is. You do the computations. After doing the computations, then you can do the extracts later. And we are saying the machine, because now we are accounting for this machine. We are saying that the machine will be measured at cost less accumulated depreciation, since it is a depreciable asset, accumulated depreciation and accumulated impairment loss. And that's basically what cost model means. Cost model means that the machinery are going to be transferred, or they are going to be valued using the cost model. But through the cost model, we are saying that it is the cost minus any accumulated depreciation and accumulated impairment losses that the asset has suffered up to the point when the reporting is going to be done. So you can write something small like that. It will give someone a background of what you're doing, even if the person may not be having an accounting background. So we try to look at, because we said it is going to be the cost with less accumulated depreciation. So this is supposed to be accumulated depreciation. Accumulated depreciation and accumulated impairment losses. They didn't tell us that the asset was impaired. So we are only going, our concern is now on the depreciation. Let's try to look at the annual depreciation, because we've seen the asset was acquired on 1st January 2013, and we are doing our reporting on 31st December 2018. It means there are so many years which have gone, meaning the asset is going to be depreciated. Annual depreciation is going to be equal to, when you are getting the depreciation will be equaling, because here they have not given us, they have just given us the useful life of the asset. They have given us the cost of the asset. That's all we have. We don't have any scrap value. So we use the information we have, and we'll be able to get what we can be able to get. It will be the cost minus, here less any scrap value if it is there. Scrap value or residual value. Then this will divide by the estimated useful life. Estimated useful life of the asset. So we've got our cost. Our cost, we computed it, and it was annual depreciation. Annual depreciation will be equal to 73 million. The total cost we computed here, we divide by the useful life. Useful life, they said it was 20 years. If it is 20 years, then you find what is going to be the annual depreciation. And this will give us 3.65 million. That is the annual depreciation. That is the annual depreciation. But remember, this item was bought on 1st. It was bought on 1st January 2013, and we are reporting on 31st December 2018. It means from 1st January 2013 up to 31st December 2018. That's when we are reporting. So it means the asset has been there from 2013. That's 1 year, because we count on also the 2013 because it was there at the beginning of the year. Meaning that the whole of 2013 it was there, 2014, 2015, 2016, 2017, and 2018. Even 2018 we count it because it is at the end of the year. Meaning the asset was there for 6 years. If the asset was there for 6 years, it means this annual depreciation, the annual depreciation we computed here was only for 1 year. But now we need to get the accumulated depreciation. We are supposed to get the asset would have accumulated from the time it was acquired until the time we are reporting. This will be the annual depreciation of 3.65 million. 3.65 million we multiply by 6 years to get the accumulated depreciation for all those years the asset was there. That's how we get the accumulated depreciation. Then now we need to know the carrying amount, and we said to know the carrying amount of the asset, it is the cost less accumulated depreciation and accumulated impairment losses. Here we are going to be looking for the carrying amount, because carrying amount is what is going to be taken to the balance sheet. Carrying amount is going to be the 73 million, which is the cost, we less the 3.65 million times 6 years. When you do that, you will be remaining with 51.1 million. And this carrying amount is what we are going to be taking to the balance sheet. But this depreciation is now going to be taken to our balance sheet, our statement of financial position as an expense every year. That's basically what they wanted us to prepare. If you have got all those figures, what you can only say is that we prepare these statements and we try to show them what we are going to be taking to the financials at the end of that year. But remember, these people wanted us also to look at the revaluation when we are using the revaluation. Let's first complete this and look at the statement. Statement of financial. Remember, this statement of financial position is we have 3. It is a statement of cash flow, statement of balance sheet, and profit and loss. Let's start with the profit and loss. Profit or loss. Passive income for the year. For the year ended 31st December 2018. This carrying amount is what we are going. Sorry, this one we are only taking the expense, but the expense we are not taking for the whole years. We are only taking for 1 year that they have requested us to do, which is the depreciation for only 1 year. Remember, this depreciation is it is going to be accruing every year. The 3.6 is going to be there every year on a straight line until the useful life of the asset. So for us, we shall be taking only the 3.65 million. And we look at the statement of financial position. Financial position as at 31st December 2018. And we look at, this is going to be under PPE. We can say machine or machinery. The other person just say PPE, and you put the carrying amount of 51.5 million. And you are done. Those are the extracts they wanted. From there, you get your, it was allocated 6 marks, but I know some of the marks were for determination of these figures. What happens here is that if you fail to know which costs are supposed to be part of this asset, it means you are going to get everything wrong, because you will be computing all the depreciation on a wrong figure, and at the end of the day, you will be getting wrong answers. So if you don't know what is supposed to be included on the initial recognition of the asset, please, you better not attempt the number, because you will be computing everything that will not give anything. And that's basically what number 1 wanted us to do. Then we can try to look at Roman number 2, which was suggesting for. This one is talking about the evaluation model. Say these are the measurement bases that we use when we are accounting for these assets substantially. 18. Even here, what we are looking at, one, we are looking at the depreciation we are going to take to the statement of financial position, and we are also looking at the carrying amount of the asset at the date of reporting. That's what we are looking at. But if you try to to go through into this question, the question says, now this is where we are starting with the revaluation. They are saying it's UML's policy to carry out a revaluation of all items of PPE every 5 years, meaning every 5 years they do a revaluation. But we said with the revaluation, there are scenarios that may happen. One, we may have the value of the asset going to be less than the carrying amount of the asset, or it will be the opposite. The other thing is that it doesn't mean that if the useful life of the asset was supposed to be 20 years, it should be the same useful life when they carry out the revaluation. Because what revaluation does is that they even try to look at what is the remaining useful life of the asset after they have done the revaluation. So it doesn't necessarily mean that you are going to be having the same useful life at the time of evaluation, because these estimated useful lives, they're just estimates. Someone can overstate or someone can understate. Doesn't mean that it's supposed to be equal or supposed to be more or less. Anything can happen, because you may say that the asset is going to last maybe for 20 years, and you find out that the asset cannot even reach 5 years. It happens. And if it can't reach there, then it means even the amount you are going to be getting as the recoverable amount will not be exactly the same, depending on when you have kept maybe other factors constant. That's basically what you can look at, because they are saying they did the revaluation on 1st January 2018. But in our question, we are making the reporting at the end of the year, meaning from 1st January 2018 to 31st December 2018, that is 1 year. For them, they did the revaluation 1 year before the reporting. So now we are reporting when we have gone 1 year ahead. So it means what this statement means is that if they have done the revaluation on 1st January 2018, and they have given us the revalued amount of 60 million and the useful life of 16 years, what you want to know is that what is the carrying amount of the asset from the date it was acquired until the date it was revalued. So when we know those two values, the carrying amount from the date the asset was acquired up to when the asset was bought or was revalued, then we can know that either the asset has been affected by either a gain or a loss on revaluation. That's basically what we look at. No, we don't compare the cost, but here we are comparing the carrying amount of the asset. In the previous videos, we've been looking at the cost of land because we said land cannot be depreciated, but this asset now is a depreciable asset. So if it is depreciable, it means by the time it reaches, or by the time they did the revaluation, the asset has suffered some depreciation. So we are supposed to first deduct the depreciation and we get the carrying amount of that asset at the same date when the revaluation took place. When we get that, then we can be able to compare and see whether the asset has been revalued or we compare to find out whether the asset has had a gain or it has been revalued downwards. So that's basically what you can look at. But remember, the date when they did the revaluation is not at the same date we are reporting. So after knowing whether there is a gain or a loss on revaluation, we should go ahead and calculate the carrying amount of the asset at the date when this question was, at the date when they were doing the reporting, because they reported on 31st December 2018, but they did the revaluation on 1st January 2018. So our first task is to look at what is going to be the carrying amount at the date this asset was revalued. That's basically what we are going to look at. And when we get to know that, then we can be able to do the other one with ease. Okay. But as we said, this is a reporting paper. We need to first do give some explanations of the things we are doing. So we may define some of the things that we said. When we go to the revaluation, we said these assets are going to be carried. The asset, we say the machinery, because it was stated, the machinery will be carried at the revalued amount. Valued amount less any accumulated depreciation accumulated impairment loss. That's basically what evaluation means, or the evaluation model means. And when you have given that, you can be able to go ahead and do the analysis of the debts. First of all, we need to analyze the debts, because the asset was bought from 1st January 2013, and they did the revaluation on 1st January 2018. So how many years are there from the date the asset was bought to the period when they did the revaluation? We start with the 2013 because it was at the start of the year. It was 2013, 2014, 2015, 2016, 2017. We don't count 2018 because 2018 is at 1st January, meaning it wasn't a full year. So we have only 5 years, meaning this asset was revalued after 5 years. So now we need to know the carrying amount of the asset from the date it was acquired. We need to know that. Remember from our previous example, we said that the cost of the asset was 70 million. The annual depreciation, we computed it, which was 3.65. But this time around, we are not multiplying by 6, we are multiplying by 5, because they are 5 years. The evaluation took place after 5 years. So what will be the carrying amount of the asset from the date the asset was acquired to the date when the revaluation took place? It is going to be 54.75 million. The other person could say to get this carrying amount using this, because the one we did up here was for 6 years, meaning that if you want to go backwards by 1 year, you just add back depreciation. You could just add back, you say that the depreciation, this 5.51.1, then you add back plus the 3.65, because that is the depreciation for 1 year. You will still get the same answer, which is 54.75. But it's better you go in this way so that you don't get confused. So that's basically what we do to get the carrying amount of the asset. Now this carrying amount is at the same date when the revaluation took place. So when you have got that, then we say the revalued amount now, they say they revalued that asset at, the revalued amount is now equaling to 60 million. That's what they gave us in the question. So when you look at that, then we try to compare. We said to get a gain or loss, we get the revalued amount minus the carrying amount. So when you see that this is 54.75 million, but this one, the revalued amount was 60 million, it means we had a gain, meaning we have a revaluation gain, and that revaluation gain is coming from the 60 million minus the 54.75 million, which will give us 5.25 million. and this is a gain. So when we have got a gain, what do? We do the double entry, because when you get a chance of making these double entries, please go ahead and do them, because these are the ones that are helping you to explain more, or to give the person who's viewing more clarity on certain items, because we are reporting some of these guys who don't even have any accounting background. We said we go ahead and debit the machinery, because now the machinery is going to be increasing in value. It is increasing by that devaluation gain. So it is machinery or the other person could say PPE, because that's the general name, PPE, and we are saying it is 5.25 million. And now we are taking this figure to OCI, meaning we are going to be creating OCI in terms of the evaluation gain. The evaluation gain of 5.25 million. That's basically the double entry that you would have made from that point. But remember, these values, they are at 1st January 2018. So the figures we want now, we want figures that we are going to be using. We want figures that we are going to be using as at, let me just put at the end of the year. End of the year. End of the year. 31st December 2018. Those are the figures we are looking for. And these ones, we are going to get them through computing. Now we are going to be computing depreciation. And this depreciation is going to be the depreciation that has came in as a result of the evaluation. And the reason why we are going to be computing another depreciation is because these assets now from that date of 1st January 2018, it's no longer going to be carried at the previous amount. It's going to be carried at the revalued amount, of which the revalued amount is now higher, which is 60 million. Meaning that even the depreciation is also going to be high. So we compute a different depreciation. Remember, if these years we had, maybe the asset was revalued on 1st January 2018, but the reporting was maybe towards 2019, we could compute for 2 years. But since it is only a duration of 1 year, we are only computing the depreciation of the revalued amount for only 1 year. So we compute the annual depreciation. Opportunity to use short form. And this annual depreciation is now going to be taking the revalued amount. It's going to be the revalued amount. We are not taking the cost, because now there has been a change in the value of the asset. Less the scrap value, then we divide everything by the remaining. Here we are taking the remaining useful life of the asset. A person may be wondering that if this asset was, even if they had said here that the remaining useful life, because they told us the remaining useful life was 16 years. But remember, in another sentence they said that the the company does the revaluation after 5 years. It means if the initial estimated useful life was 20 years, and now they are doing the revaluation after 5 years, it means the remaining useful life would have been 15 years, of which it is not the case. The logic is that depreciation you computed, it was just an estimate. By the time they do the revaluation, they will also estimate that the asset may last for more years. So in any exam, don't be tempted to use the remaining, to just deduct and you take the 15. No, we take what they have given us as the remaining useful life. Please take note of that. You only do that maybe when in the question they have not given you the remaining useful life. They may tell you that we'll do the revaluation after 5 years. And they keep quiet and they don't tell you anything. Then from there you can deduct and say, if you do them from 15 after 15 years, and you've seen the 15 years have passed, you can less off and you go with the 15. But if the question gives you the remaining useful life, even if it is less than the remaining, please take what they have given you. So to get the depreciation is now going to be the revalued amount, which is 60 million. With less, of course, the scrap value is not there. They have not given us, so we just divide by the remaining useful life. And the remaining useful life, they told us it is 16 years. And this will give us 3.75 million. So that's the remaining, that's the annual depreciation for 1 year, meaning even in 2018, this depreciation is supposed to be taken to the profit and loss. Then now we can compute the carrying amount. The carrying amount, which will be equaling to the 60 million, which is now the revalued amount, minus the 3.75, which is the depreciation for that 1 year. This will give us 56.25 million. And this 56.25 million is the amount that is going to be taken to the balance sheet as the value for PPE. And that's basically what they wanted us to do in this question. So we can proceed and make these short statements. These are just extracts. Please, when you're told to give extract, don't put the whole balance sheet or the whole income statement like the way it's supposed to be flowing. This one, you just pick what is relevant. For this, we are going to be having, first of all, we have the depreciation. We go to the expenses. We have depreciation. Depreciation, now we are taking this 3.75 million. 3.75 million. Then we also look at, we had this revaluation again, which is supposed to go to OCI. We said the OCI, we have the revaluation gain, and the revaluation gain was 5.25 million. I can put this one the other side, minimize the space. Then we try to look at the statement of financial position. This statement of financial position, we shall start with the net non-current assets. Non-current assets, and you have our PPE. Remember, these PPE, you combine everything and give them at once. This is going to be carried at 56.25 million. Then the last one, we shall have the equity, where we are going to put our evaluation reserve. This is the valuation reserve, where we have all these figures. And the valuation reserve is going to be shown this 5.25 million. And that's basically what this question wanted us to do. It's 5.25 million. That's basically what we're supposed to do in this question. And we get all those marks as you have seen. I'm trying to remove these. I'm trying to remove these borders, sort of the grid lines. You'll be able to see something that is basically what they wanted us to do. And that's all for these computations of PPE. But maybe to give you a small matter on the disclosure requirements, I've been skipping it, but allow me to talk about some of these. What are the things that disclosure requirements, or what are we supposed to disclose as far as PPE is concerned, IS 16. One, we may disclose the depreciation method we have used. Remember, here we've been talking about cost minus the scrap value over the useful life. What is that? That is straight line method. So when in the disclosure requirement, we are required to disclose the method we are going to be using to depreciate these assets. Remember, as far as standard this IS 16 is concerned, it allows some few methods of depreciation, reducing balance and straight line. Those are the ones that are mostly used. Maybe even number of years, digit, whatever method. It's also been accepted, but these other ones, most of the times we use straight line and reducing balance. Then the other one is the basis, the measurement basis used for determining the carrying amount. Like now here we are using the revalued amount and we are using the evaluation model and the cost model. Those are the measurement bases. We disclose that in our financial statements, when we are valuing items of PPE, we used we use the cost model or a revaluation model. You can't use both, depending on the policy of the organization. And remember, these policies, if you have decided to go by the cost model, you have to be consistent, and you'll be using that for some time, period of time. Then the other one, the useful lives. Remember, we've been saying that the useful life of this asset is going to be changing. You may find that other companies, they are depreciating maybe their computers for 10 years, others are depreciating them, depending on how they are able to estimate the would-be useful life of that asset. Then you can talk about the accumulated depreciation and accumulated impairment losses that are there at the beginning, and the ones we have ended the year with. The depreciation, the accumulated depreciation that we had at the beginning of the year, and the one at the end of the year, so that someone can get to know that if I get this accumulated depreciation at the beginning and the one at the end of the year, I may be able to know that the balance is going to be the depreciation. If at all no assets have been acquired and no evaluations that were there, you may find that the difference may account for the depreciation. So it gives some information to the users on how certain things were done, even when they don't have accounting background. Because most of these things, like you state the method, and you may also illustrate how the method is, that it is cost minus the scrap value over the useful life. Someone can be able to pick and interpret the financial statements. That's basically what we can talk about. The other disclosure requirements, which I have not talked about, you can do some reading on your own, and you have something to add on what you have acquired. Thank you for today. The next one is going to be IS 40, and we are going to be looking at some of the simulations that we had in that, and we shall be able to do some numbers and be able to understand more as we go on. Thank you. Endeavor to subscribe and share to others so that they can also have a benefit. Thank you.
Good evening, viewers. This is CPA Charles Cafe again, and today we are going to resume our series on financial reporting, and today's class is about IS 40 investment property. In the last video we talked about the IS 16, that was PPE, and we really went ahead and discussed most of the non-current assets. We gave a demonstration on how they are all being treated in terms of when you're handling non-current assets. You look at the nature, you look at the purpose, and we classified them into the tangible, non-tangible, intangible assets. Intangible, that was I-38, and these tangible assets, we had the PPE, which went to IS16, and we have the IS40, that is investment property. The difference between the investment property and PPE is on the side of the use, because all of them are tangible assets. But PPE, they are used within the organization to generate revenue in the production or supply of goods and services for the organization, or for rental to others to a smaller extent, and or for administrative purposes. But this investment property is mainly focusing on those assets. They are tangible in nature, they are owned by the organization, and they are only responsible for generating rental income, mainly generating rental income. Secondly, they are set aside for capital appreciation. We said capital appreciation was all about leaving the asset there to accumulate its for its value to accumulate. If you buy 10 million, in 10 years time you may find it is 100 million. So that's what we call the capital accumulation or appreciation, increase in the value of the asset. So basically it is either you are earning rental income or capital appreciation, or both. You may be using the asset to earn rental at the same time capital accumulation. So that's basically how we distinguish. It is on, the distinction is only on the purpose of the asset. These ones are used for rental, mainly rental income, for earning rental income and capital appreciation. The other one, administrative purposes and production for earning revenue for the organization. So that's basically how we can differentiate the two. So when you're looking at IS 40, investment property, first of all we have to determine what is investment property, the definition. Having known that, we can talk about the recognition criteria. How do you know that you have an investment property? Then we go to the measurement basis. How are you recognizing, or how are you incorporating, or which value are you going to assign to that asset? Those are the things we are going to be looking at for now. Without wasting more time, let's kick off and go through our notices, and we see we are saying investment property. This is the property. It must be tangible. This is a tangible asset or a property. In other words, it's land or building or part of the building or both. I said if I talk about part of the building may be earning rental, and the other part is maybe administration. So we are going to look at those scenarios. That's why I'm saying land or building or part of the building or both, that is held by an entity for capital appreciation, or both. I did not put the one for rental income. They are saying these assets, they are used for earning rental income, or they are used for capital appreciation. For capital appreciation, or we can add something here, all for earning rental income. For earning rental income or both. It can be used for earning rental income or both. Either capital appreciation or for earning rental income, or both. And we are saying capital appreciation is just holding the assets for accumulating of income, increasing the income. Those ones we spoke about them. Then let's look at what are some of the examples of investment property. If someone says, I have an investment property, what are some of the examples? One, we have land for long-term capital appreciation. You have bought land, you have not constructed anything there, but you've just bought land and left it somewhere. Or you bought land in a growing environment area, but you have not done anything on it. That's what we call, at that point we say that it is bought for capital appreciation, even if it is not the intention. But that's how it's going to be looked at, or how it's going to be accounted for. Then we have land acquired by an entity, but whose purpose is not yet determined. If you have acquired land, but you have not determined which activity are you going to be using for that land for, then we say that at that point it is held for capital appreciation. It is held to increase income or to increase its value. Then the other one, we can talk about a building that is leased out under operating lease. Operating lease, we shall talk about it when we go to IFRS 16, that is, those are leases, and that's where we will look at the finance lease and the operating lease. But what you need to know from here is that operating lease, those are short-term leases. You lease the asset maybe to, if let's say the useful life of the asset is 10 years, but you lease it for like 3 years, so it's still the owner still has the 7 years of ownership. But this financing lease is the situation whereby you lease the asset as if you have already bought it. Someone leases the asset, the useful life of the asset is 10 years, someone leases it for 9 years. It's like you have bought the asset, because by the time you leave the asset, it is already even old, if it was depreciable asset. So that's basically what we can talk about in terms of the operating leases and the finance leases. But those ones we are going to learn, we have a separate standard for that. That is IFRS 16. So the next one we can talk about is the building that is vacant but will be leased out in the future. You have constructed a house, you have not done anything, but it's still there. But its main intention is to lease it out to earn rental income. Either to earn rental income or to do other things. That's basically, we can talk about that. Those are some of the examples of the assets we can call that they are investment in nature. So the next slide is all about the properties which are not investment properties. We have to look at them so that when you see them, you know that this belongs to another. Remember, I said in the previous videos, I've been saying that any asset that is accounted for under different standard, it cannot be accounted for in another standard at the same time. So take note of that. Then here we are saying that we have properties which are not investment property. When you see them, just know they are not investment property. We have owner-occupied properties. Owner-occupied property, we talked about them as they are under PPE. That is IS 16. Because we said those that are used for the administration of the organization or for the production or supply of goods and services. It's like if you see the school buildings, they are constructed, but it is the school which uses them. So they are PPE. So that's one of the items that don't fall under the category of investment property. Secondly, we have the property that are held for sale. Properties that are held for sale, that is inventory. You can look at the real estate companies. They deal in land. That's what they sell. They buy and they sell land. They buy and they sell building. So that's inventory. That's their inventory. So don't call that, because that's basically the business. That's their stock they deal in. So that's treated under IS 2. That is inventory. Then properties constructed on behalf of third parties. These are also not investment properties. You are a construction company and you've got a contract to construct a building. That building you are constructing is not yours. You are just a construction company. And we account for those ones under IFRS 15, that is revenue. Revenues from contracts with customers. That's where we account for those ones. Properties constructed on behalf of third parties. It's like I've given an example. You're a construction company and you're constructing houses or buildings, different buildings to the customer. Then the last one, we can talk about buildings that are leased out under finance lease. Because remember there we said buildings that are leased out under operating lease, those are the ones that are falling, the short-term one. But the one which are long-term, they are accounted for under IFRS 15. We shall understand these leases when we go to IFRS 15, because this IFRS 15 was reintroduced, was modified, and that operating and finance lease, when you reach there, they are not separated a bit. So we shall learn those ones when we reach there. But just know for now, buildings that are leased out under finance lease are accounted for under IFRS 15, that is leases. So that's basically what we can talk about. Maybe what we need to go into deeper is, this is going to be our story. For every standard, we have to look at what is the standard saying about how to recognize it. We said recognition, those are conditions that are set, or criteria that are set for someone to recognize that you have an investment property. Then when we go to measurement, we are talking about which value. Yes, you have recognized you have an investment property, but which value are you taking? So be able to get those differences. Then we are saying recognition, the recognition criteria for assets, it's more or less the same. It's more or less the same. We are saying that the recognition criteria, we are saying that it's probable that future economic benefits associated with the asset will flow to the entity. Future economic benefits, but if you should also be able to understand this, it's probable. If someone says it's probable, it means at least its percentage is more than 50%. The probability of it to occur. I'm not teaching probability, but the probability of something to occur is more than 50%. That's what we can call that asset, that it is probable that future economic benefits associated with the asset will flow to the entity. Meaning it is beyond doubt, it is more than 50%. You are sure the asset will bring value. Not the thing of saying it is 20% and you say it is probable. We shall see those things when we go to provisions, contingent assets and contingent liabilities. We shall have to see them from there. Then the next one is the cost of the asset can be measured reliably. If you can't determine the cost, then what are you going to be recognizing? You can't recognize something. Remember, in accounting, we only recognize financial transactions or monetary transactions. Then after looking at the recognition criteria or the recognition of the investment property, let's look at the measurement of investment property. We said when you are looking at the measurement, we are trying to look at which values are we going to incorporate in our financial statements. Which figure are we going to put in our statements? One, we said we do the things in two ways. How we can measure an item. One, we do it at initial measurement, when you have just recognized the asset, or when you have just acquired the asset. Which value are you going to assign to that asset? That's what we call the initial measurement. Subsequent measurement is at the reporting date. Yes, you acquired that cost, that investment property at 10 million, but has it reduced the value? Or are you going to still maintain the same cost? Are you going to use the cost model, or you are going to use the fair value model, or you are going to use the revaluation model, or it is a present, whatever? That's basically what we are talking about here. That's why in our first video we spoke about the measurement basis, and we did even some computations, so that to be able to analyze where we are heading. So if you see you are not understanding, please make sure you go back and you rewatch the videos and be able to understand before you progress to the next videos. Okay, we are saying that initially, this is how the standard says. IS 40 says that we initially measure investment property at cost. And we say that cost at cost is very broad. We don't talk about the purchase price. We incorporate in other costs that are directly attributable to the asset. And here now you are seeing there are legal fees, transfer fees, because this is mainly based on land and buildings. They are land and buildings. So when you're buying land, of course, you expect legal fees, transferring of the land titles. Then brokerage. You have to pay brokers who are going to connect you to the real estate agents. So when you are determining this initial measurement, there is something maybe I didn't talk about when I was in IS 16 about the initial measurement when you are measuring at cost. There are certain expenditures, or there are certain costs that we are not supposed to include in the cost of the asset. If, let's say, these assets in the PPE, I did not talk about that item, and I saw it is a bit challenging for students. So we have exclusions in the cost. We have these administrative and general overheads. Those are indirect costs. They are not supposed to be part of. Even here, when you are determining, because they may give you the raw figures, they give you the purchase, they give you other costs, and you are supposed to remember these costs which are not directly attributed to the cost. They are not. If, let's say, we have the pre-production or startup costs, these pre-production costs, I can talk about them. If, let's say, you have acquired a machine and you want that machine to produce goods, first of all, you may do an initial testing, but you have already purchased the item and the item is working. But this initial testing you are doing, the asset is you want to confirm whether the asset can produce the required quality. That cost or pre-production testing we do, we are not supposed to, that cost we are incurring there is not supposed to be capitalized, or is not supposed to be included, because by the time you start production, you have already, the item is already working, so you don't include it. Even there is even scenarios you may sell those items you have produced. Remember, they were in the pre-production. When you sell them, those items you are selling, even if you make a loss on them, by the time you make a loss, you have already produced. So we don't incorporate them. So those are basically the things I wanted you to get to know, what we are supposed to, what are some of the exclusions. We said losses, pre-preparation costs, and administrative overheads. That's basically what even here they may bring it, and they are giving you the cost, the purchase price, the others, like the way we said. So long as something is determined at a cost, we don't look at the purchase price only, we look at the other direct costs that are associated with the asset. Hope we can proceed from there. And we say measurement, subsequent measurement. When we look at the subsequent measurement, we said that is at the reporting date or at the end of the year. Which figure are you going to carry to the bank statement, to the balance sheet? Or which figures are you going to be taking if they are current assets? Which figures are you going to be taking to other incomes if they belong to the financial statement, financial position, financial performance, it is income statement. So that's basically what we are looking at. We are saying there are also two ways, or the measurement bases that we can use subsequently, and one is a cost model, the other one is a fair value model. For investment properties, we don't revalue them. We don't use like the evaluation model. It's only cost, and we can take them at cost, or we take them at their fair value, or the current. We said fair value is the current market price, and this current market price is fair to the extent that there is no even cheating, because you go there and you start bargaining. It is what is prevailing in the market that will determine the cost of that item. It is very fair. That's why we call it fair value. Because you go there, the market forces of demand and supply, they are the ones to determine that at least at this moment and at this time, the item is costing this if you are to sell. And that's it. It's not revaluation, but we are doing exactly what it is now. Remember, with the revaluation, you do some technicalities. You have to look at how long would this asset again stay, if at all it has moved for this. If it goes like this, how are we expecting for that asset to be depreciating? So all those things. But here we are looking at the fair value, what is really existing in the market. So we are saying subsequently we can measure investment property at cost, and we say that the cost is cost less accumulated depreciation and accumulated impairment losses, because we are at the reporting date. We expect that these assets are going to be reducing in value, either if they are not depreciable assets like land, there may be impairment loss. We say that the difference between impairment and devaluation and depreciation. Depreciation is spreading the cost over its useful life, but impairment is that the asset has decreased in value. That's basically how we can define those ones. Then, when we try to look at the fair value model, we are saying that assets are carried at fair value or actual market value. Then there is a scenario that will happen that cost we paid at initial recognition, when you look at what we are actually getting from the market, there is either loss or a gain. These are called changes in fair value. They may be at a loss or at a gain. And we are saying, since this is where I want you guys to get me, this fair value is to the extent that the price is fair, is free and fair. It means that these gains and losses, they are supposed to be taken to the profit and loss, because at the end of the day, they are actually realized. That's what you are going to get in actual sense if you are to sell. If you had an asset and you are to sell it, what they tell you from the market, what they are buying, is actually what they are buying. So it's like they are realized. So that's why they are taken to the profit and loss, not to the OCI. We take them to the profit and loss under other incomes, where we add, at that section where there is gross profit, add the other incomes, we add them. Discount received, then these gains, fair value gains. Hope you've got a difference why we are not taking the revaluation gains there and we are taking these. Hope that helps and it can make you really understand those things. Then let's try to look at, there are some items that we can be looking at. Having seen the recognition, then we want to look at the properties with the dual purpose. Properties with the dual purpose. Dual means two, meaning that item is serving two purposes. They may be different. It may be it is the same item, but that item is an investment property, but it is used for rental and at the same time is used for capital appreciation. This is not what I'm talking about. What I'm only talking about is that the asset is used for rental income or capital appreciation, at the same time it is used for another purpose. That's why I said when you're talking about these non-current assets, the purpose is very, very important. We are saying that a property may be used for production or supply of goods and services or for administrative purposes, and may be used for earning rental income or capital appreciation. Then the gist is, how do we treat those assets that are dual purpose? We use them, we rent them out, and at the same time they are used in the business. We use them for capital appreciation, and at the same time we use them as a head office. Then this is what happens, because there are those apartments. You may find the apartment, one of the apartment upward is in the last floors, they are just renting them, and down one, they are the ones that where we located our head office. So how do we treat those ones? Then we are saying that we have three scenarios. One, we are saying if the asset, actually I should change maybe these ones to, I give them a different bullet. Anyway, may go like that. We are saying if the portion can be separated, and separation we are talking about if it can be rented out separately or sold separately, like these condominium sellings whereby someone can be on the 4th floor and says, I have a title for that, whatever, I bought this floor is mine, this one is not mine, like that. If it can be sold separately, then they will be accounted for under their respective standards. If that thing can be separated, you can identify it separately, and you say this part, this level, if let's say level 3, level 4 on an apartment is mainly for rental, then the downer part is the one we use level 1 maybe, and level 2 they are the ones we use for administrative purposes. Then what we do, we account the level 1 and level 2 under investment property, and we account level 1 and level 2 under PPE because they are used for administrative purposes. Then there is also a scenario whereby these assets you can't differentiate them. Like you may find on level 2 they are all on level 1, but on level 1 there is a portion for rental, there is a portion for administration or a branch, there is a portion for other thing. Then that's where the scenario becomes tough, and we are saying that if the portions are not separable, then the properties will be PPE under IS 16 if, make sure this if is sticking to your head. This if is very important. If an insignificant portion is held for earning rental income or capital appreciation. What does that statement means is that if the whole asset is maybe used for administration, but a small portion, maybe 2 rooms on the last floor, they are used for rental and capital appreciation or rental for earning rental income, then we can say that is insignificant. Insignificant means something is not enough, like it's a small portion. The problem with this standard, it did not specify how can you know that this one is insignificant, but at least you can see. If on the whole building, depending on the scenario in the question, if on the whole building you have, let's say, 2 rooms that are used for rental, but the room has, let's say, 11 floors, you can't really consider that one to be something significant. That's how basically you can tell, but it depends on the scenarios in the question. But when they are given the question, they will tell you exactly what they mean. But it is you to understand that is this really significant or insignificant. Then the other one is is if the insignificant portion is owner occupied. If, let's say, on the whole building the head office has maybe it has only one branch and it is using only one room or two rooms, but all of the other rooms are used for capital appreciation or rental to other people, then you just say that that is supposed to be treated under IS 40, that is investment property, because the other one we take it to be insignificant. Hope that one helps. If you don't understand, please rewatch and you'll be able to grasp these concepts, because they are going to be important. Those are the scenarios that are coming in those questions. So let's proceed to the next one, and we are saying the next one is all about, we are going to be talking about the transfers. There are certain situations which may happen that the land which was initially used for head office, the head office has left, or maybe the head office has constructed another building and now they are leaving this building for capital appreciation or as investment property or to be rented out by others. There is a scenario also whereby the buildings that were being rented by other people, they are now being occupied by the organization itself. Meaning there is that transfer whereby the asset which was used for earning rental income is now being used for office purposes. How do we treat that? If it was an investment property and it is now becoming an inventory, or they are going to sell it in the normal course of business, how do we deal with those items? Those are the things we are going to be looking at. One, we have a transfer from IS 40. When I say IS 40, that is investment property, to IS 16, that is PPE. Transfer from IS 40 to IS 16, how do you recognize that there is a transfer? Of course, if there is a transfer, then the other recognition criteria for PPE, they will come in. Basically, how do you tell that the item has moved from an investment property to PPE? One, you will have to see the purpose, because I said first look at the type of the asset. But remember here, the type of the asset doesn't matter because all of them are non-current assets. Then the second thing, you are supposed to look at the use of the asset or the purpose of the asset. Here we are saying if it is PPE, it has been investment property. It has been used for capital appreciation and rental to others, or for earning rental income, but it is now becoming an owner occupied, or it has been converted into a head office or administrative purposes, or it is being used in the production of income. So we are saying this is evidenced by commencement of owner occupation, and owner occupation brings about the administrative purpose. Actually, what you need to know is that when there is any transfer, first look at what is that item being used for. Is it being put to sell? Has it been put to an office? Has the company occupied that room, or it has been given out? So we are saying transfer from IS 40 to IS 16, this is evidenced by commencement of ownership. That's the first thing you recognize. Evidence must be there. And we are saying that for a purpose, for a transfer from investment property, under that is carried at a fair value. Remember we said within the investment property, Subsequently, we measure these items at fair value. So we transfer them at their fair value. If it is moving from IS 40 to PPE, we transfer them at their fair value to owner occupied. Because what will happen is that if you are transferring the asset now, what will be the cost you are going to assign to that asset where it is going? If it is going to become an item of PPE, then at what value, what will be its measurement? Then this means that its fair value at the date of change will be its value initially. Meaning that for a transfer from investment property under that is carried at a fair value to owner occupied property under IS 16. The property's fair value on the date of change in use will be its cost for subsequent accounting under IS 16. Meaning, by the time you will be reporting that asset, it will be using its fair value at the date of acquisition. That will be the amount you'll be using. Then we have transfer from IS 40 to IS 2. We say the IS 2 is inventory. If the item is moving from IS 2 from investment property to inventory, how do you know that this item has been converted from IS 40 investment property to inventory? Inventory, we are saying that it has been put to sell. So how do you see that this asset is now going to be sold? One, the evidence is that when you're selling assets, you make sure that at least you do some renovations so that the asset can pick a higher value from the market. That's basically what we are talking about here. And we are saying that if you are converting that asset from investment property to inventory, then this is evidenced by the development of the property with the view of selling it. Of course, when you want to sell especially an asset, these non-current assets, you modify them. If it is a tractor, you put some color and whatever, you do some repairs so that if someone does a road checkup, it can be really working good, so that you can be able to maximize the amount you are supposed to get from that asset. So we are saying for a transfer from IS 40 investment property that is carried at fair value. Remember, anything that is coming from IS 40, it is coming at fair value. We don't have revaluation. We pick the estimated market price, and that estimated market price will be the value that we will account for under inventory. How will I account for that transfer? I will transfer that asset. Instead of putting them in non-current assets, I will put them in current assets under the name of inventory or stock. Probably closing stock, because it's the one that goes in the balance sheet. And we are saying that the property's fair value on the date of change in use will be assumed. Actually, it will be the assumed, it will be the assumed cost under IS 2, that is inventory. Meaning the fair value by the time you are converting, or the fair value at that time of conversion, is going to be the same cost for that asset that we are going to be used for subsequent reporting. Hope you can be able to get that. Then the last view is that when you are transferring now, we've been transferring assets from investment property to other standards, but now we are transferring items from PPE to IS 40. Remember, these other reversals, if the asset is coming from inventory to IS 40, you reverse the concept. Because that's what the standard is silent about that. But you reverse the concept. But there are some transfers which have some issues. That's why they are given out. So IS 16 to IS 40, this is evidenced by cessation or ending of owner occupation. Remember, we said in IS 16 PPE that they are used by the owners for generation of revenue. So if they stop using them and they give to others, that's what we call cessation or ending of owner occupation. They are no longer being used by the organization. So we are saying that for a transfer from PPE to IS 40, that is investment property, that will be carried at fair value. The difference between the carrying amount under IS 16 PPE and the fair value on the date of change is the change in use will be accounted for and as a revaluation. What happens, what basically this means is that when you are transferring items of PPE to IS 40, we transfer them at the revalued amount, because the revalued amount is actually the fair, it is reflecting the fair value. More or less it is not actual, but at least it is. That difference is what we call the revaluation. It's like you have revalued, but basically they are transferred at fair value. That's what the standard says. But at least that difference, it will be the revaluation, either gain or loss, and it should be accounted for as a revaluation. So there is a trial question, that is trial number, that is June 2013, question 5C. That one we shall look at it later. Let's first resume and we finalize. I hope we have finalized with this. The rest of the disclosure requirements and all that, those ones you can read on your own, but be able to read them. Basically, me have picked the ones that are giving headache to students. Okay. The next standard is these are grants, but you can stop here for today. I remind you guys to subscribe and share these videos to friends so that they can also be able to learn something. And you can comment, advice, and because we may give an advice of how you want things to be done. Yeah, we listen to that and we'll make changes accordingly. Thank you so much.
Good evening, viewers. This is your tutor CPA ACCA, and today we are going to resume with our series of financial reporting. And as a precursor for what we did last time, we finished IS 16 and we did some computations. And I'm very sure if you try to do some more numbers on that standard, you'll be able to understand more and be able to do more numbers, as you can be seen from the question banks. Now for today, we are going to look at IS 40 and we are going to start with our first computation, and we had a trial number that was May 2017, but it is the same like June. It is June/May 2017.
17, and it's going to be question 3, where we are going to be looking at how we are going to be solving some questions that are in relation to IS 40 investment property. And the reason why I chose this question, it has some aspect of where we are going to be looking at items or properties that are close to IS 16, and if you didn't get more on what we discussed in IS 16, you can use it as a precursor and be able to understand more and more of these standards. We said it is going to be May 2017, and my emphasis here is basically on question 3, part B. So we can try to look at how question 3 says, and we see what we can do from that. This is a whole question paper, and our question 3 starts from there, as you can see from the screen. But my emphasis is mainly on part B, because part A is more or less of what we covered within our theoretical aspects that we handled. We did a first video that was giving theoretical aspect, but here we are now looking at question papers, and we are picking some questions to be able to enhance our understanding the standard. Question 3, without wasting more time, says, question 3 part A says IS 40 investment property defines investment property as property in bracket land or building or part of the building or both, held to earn rentals or for capital appreciation or both. This is basically the definition we gave in our first video or the notes we have, and they continue to say it further specifies the conditions for recognition and measurement of assets classified as investment property. The required says discuss the conditions that should be satisfied for an investment property to be recognized as an asset in the financial statements, and exceptions of the assets that should not be classified under investment property. When you take a look at this question, this is basically some of the things we discussed earlier in the first video, where we tried to look at what are some of the things that are included within the scope of IS 40, or what are the limitations, because when you try to look at the exemptions of assets that shouldn't be classified under investment property, those are the examples we looked at. What are some of the assets that are not falling into the investment property? And we looked over 4 of them, and that's basically what this question wants. And the other item they want is the recognition criteria. How do you know that you have an investment property? That's basically the recognition criteria. We said for any asset, even from the conceptual framework, for any asset we are saying that we should be expecting something from the asset. Those are then we can also be able to to determine the cost of that asset reliably, when we can be able to determine the cost of the asset. The recognition criteria, as we said, it's probable that future economic benefits associated with the asset will flow to the entity. What this means actually, if I may give a clear description of this, is that when you're buying an asset, we are buying assets that we are going to be using as a business to generate revenue. So if you are acquiring any asset, whether long term, whether short term, that asset should be, or must, actually it is not even should, it is a must, that is supposed to be adding something to add value to the organization. If it doesn't add any value to the organization, then you are just holding that asset for nothing, because it's not all that, it's not helping the organization to grow. Then the other one, of course, even the cost, its cost, it should be having a monetary value that you can attach, or that you can record in the books, because when you're preparing financial statements, we always record monetary values. If at all you can't determine the cost of the asset, then it means you can't recognize it as an asset. There are basically two recognition criteria, and if you need more clarity on them, just try to go back and check our first video of IS40. We explained all that is needed as far as the theoretical aspects is concerned. We try to look at what are some of the properties that are not falling into or that can't be classified as investment properties. We try to look at one of them. We say the owner occupied properties, or the properties that are being used by the organization itself to generate income within the organization. And we say those items are accounted for under IS 16, that is property, plant, and equipment. The other item we looked at was the properties that are being used, or that are sold out in the normal course of business. It's not always a must that whenever we are talking about the non-current assets, we are meaning these non-current assets, and you try to say that they are going to be long-term. Some of them you may find that these long-term assets, they are inventories. Certain organizations, if let's say it is a real estate company and they are buying land and building, they buy, they renovate, and they sell. So that's their inventory. So it's not a must that whenever we are talking about the buildings, we are supposed to be talking about the long-term assets. Sometimes we find that those assets are the ones that are being sold in the normal course of business. So if they are sold in the normal course of business, even though they are long-term, we call those ones as the inventory, or they're supposed to be accounted for under IS 2, that is inventory. Then we have also properties constructed on behalf of customers. And these may look at some example, maybe these construction companies. When these construction companies are building certain structures or buildings, it's not that those structures are going to be owned by the construction company. They are just helping or they're just doing that as their normal work they do in a daily, but it doesn't necessarily mean that those assets are going to be theirs. So we treat that one as revenue from contracts with customers under, that is IFRS 15, Then the last one, we looked at these assets that have been leased out under finance lease. We said finance leases, these are basically assets that have been given out, and it's like, if let's say the asset had a useful life of maybe 20 years, you find that the person has leased that asset maybe for 19 years. You find that it's more or less that the owner has given up control of it. So if they are those, then we can't classify those under investment property. So that's basically what they wanted, and we are not going to go deep into that. That's basically just a precursor of what we were supposed to do. But what you have to put in mind as a reminder that whenever we are talking about these assets, these long-term assets, we are basically looking at the purpose. What are they being used for? Is mostly the one of the key item where you can determine that this asset is going to be accounted for under this standard, depending on the purpose or what that asset has been put to. Then you can be able to understand how you're going to be accounting for that asset depending on its use or the purpose of the asset. That's basically what we can talk about. Then question 3B, part B is one which I'm interested in, because for it has some computations, and that's basically what we are going to be looking at for today. Part B says Newman Limited acquired two properties of land one for 100 million on 1st January 2015, and the other on 31st December 2015 for 80 million. Land one was for 100 million. It was acquired in January 2015, and land two was acquired on 31st December 2015 at 80 million. They're saying that during the year ended 31st December 2016, Nyumbani Limited constructed its head offices valued at 120 million on the land whose cost was 80 million, and nothing has yet been decided on what it should use the land that cost shillings 100 million. What this statement means is that the second land that was bought on 31st December 2015, it is that land that they used to construct a head office that valued at 120 million. It means we have three properties. We have land one, we have land two, and we have the head office or the building that was constructed. Then they are saying that the prices of land in Uganda and Kampala in particular are increasing day by day because of high demand and inflation. Experts estimate that the average inflation rate of the prices of land is 15% per annum, meaning every year it is increasing by 15%. What you have to understand in this statement is that These prices are increasing because of the inflation, and inflation is the persistent increase in the general price levels and all that, as you studied it in economics or economic environment. But you have also to understand that it doesn't necessarily mean that every time land is going to be, all these assets are going to be increasing in value. This time around, they have been saying there is an inflation. You may find that in the next question, they may be saying that land has been deflating, because the opposite of inflation is deflation, meaning persistent fall in the general price levels. So you make sure you understand most of these things, and we try to eliminate some of the English problems that make that, because you may find that the standard is a bit tricky, and even some of the things you have not understood them. So if it is a deflation, it means the prices are going to be reducing. So if these prices are going to be increasing, we are expecting that either we are going to be having a gain or a loss. But mainly when these prices are increasing, we are going to be receiving, or we are going to be seeing a gain, especially when the assets are depreciable or are non-depreciable, as we are going to be seeing. They say the inflation is 15% per annum. Then the required part 1, question 3, part B, Roman 1 says discuss the two measurement bases used in ascertaining the value of an investment property in accordance with IS 40. This is something that we looked at. If you remember very well, that those are the things we started with, the measurement bases. And whenever we are talking about these measurement bases, we are talking about these alternative means. These are just the alternative means that we can use to record the asset or the value of the asset. Are we going to be maintaining the cost model, or we are going to be using, because basically when you are saying are we going to be using the cost model, meaning are we going to be maintaining the initial cost we incurred when we are acquiring these costs. That's what we actually incurred initially, or at the initial measurement. Or we are going to be using a different model, which is the fair value, because we said under IS 40 we are using two measurement bases. We are either keeping these assets at their cost. In other words, we are just using their cost model, or we are using the fair value. And the fair value is the estimated marketing price, meaning it is what we can actually get from the market if at all we are dispose these assets. Because as the word suggests, it is a fair value. It means when it goes in the market, it is an active market and everything is free and fair. So those are basically the things they wanted in that part 1, and you could explain the cost model and the fair value. The cost model, we said we maintain the cost, but we also take into account the accumulated depreciation and accumulated impairment losses when we are determining the carrying amount. Because that's basically, these things you don't need to cram them. You find that if, let's say, you have bought an asset, let's say, of 10 million, and you find that by the end of the year, are we going to be maintaining the cost
of the 10 million that we paid to acquire the asset, or we are going to be adjusting it with its recoverable or its market prices, what we can actually recover if at all we are to sell those assets in the market at that very period. Those are basically the things they wanted there, but my interest is in this Roman 2, which says, given that the two properties of land are located in Kampala and that Nyumbani Limited uses fair value measurement in valuing its land, this is actually giving even the answers, because what Nyumbani Limited uses is a fair value model, which was actually the answer that you are supposed to put in the first Roman 1. So that's basically what they are saying. They are saying we are going to be using the fair value, meaning we are going to be using the estimated marketing prices. We are not going to be maintaining the cost of the asset. And they are continuing to say that and depreciates its building at a rate of 5% annually on a straight line basis. Then they are saying show how the above transactions will be recognized in the financial statements for the year ended 31st December 2016, giving extracts for the financial statements. Having looked at that question, and we have actually, if you try to analyze what are some of the things that you may take out from this question, and they have given it 13 marks. What you have to understand within this asset, for any non-current asset that you are going to be working on, the first thing you have to understand is what is the purpose of the asset. Because if you understand what the asset does or what the company is using that asset for, you can be able to understand which standard are you going to be using to account for that asset. So before we think of any values that we are going to record, we need to first know the standard we are going to be using to account for those assets. And the only way we can do that is first knowing what is the purpose of those assets that have been given in the question. And when you try to look at the question in detail, this part being Nyumbani Limited, you will see that they are saying Nyumbani Limited acquired two properties of land. One for 100 million on 1st January 2015, and another land 2 on 31st December 2015 for 80 million. You will see that even during the year, because they are saying during the year ended 31st December 2016, they also constructed a building, or they constructed a head office. It means that this head office, actually they are constructing an office premises where they are going to be operating. It is their head office. It means it is now turning from being an investment property to PPE, that is property, plant and equipment, because we said in the property, plant and equipment, that's where we have the owner occupation. It means that this organization is going to be using this building they are constructing. It means that since they are constructing this building and they are going to be using that building as a head office, it means even the land is going to be occupied by the head office, which means that this land where they constructed this building, both of them, we are going to be accounting for them under IS 16. And the reason is simple, because they are all of it is going to be used as head office, or they are going to be constructing an administrative block that which brings a very nice property of IS 16, that is PPE. Because we said under IS 40 investment property that these the assets that are falling in that category, for them they are going to be used for earning rental income, and they are going to be used for capital appreciation, or they are going to be used for both. So if it is not one of those three criteria, we can't categorize them under IS 40. So now we can say that the land which costed the 80 million, because it is that land that costed 80 million where they used it to construct the head office. We have confirmed that we are going to be accounting for that building they constructed the head office under IS 16 PPE. And also the land itself is going to be accounted for under IS 16 PPE, because it is going to be used for administrative purposes or owner occupation. Then we try to look at this land one, the remaining land one. This land one, we are seeing that it was acquired on 1st January 2015 at 100 million. But we are seeing that the purpose of this land, because they are saying here that the purpose of this land is not yet decided. So if the purpose is not yet decided, it means it's more or less, or it's assumed that that land is going to be used for earning, for capital appreciation. Of course, for capital appreciation, those are you buy land, you leave it there. Actually, you don't even know what you are going to be doing. And in that sense, it means by the time you realize what you are going to be doing with that asset, it has accumulated value, or its value has now increased. So that's basically what we mean by capital appreciation. Since the purpose wasn't known, you can't classify that under PPE, because for PPE we are very sure that the assets that are going to be there are going to be used for administration, or they are going to be used in the production or supply of goods and services. But here the purpose is not known, so it is now going to be assumed that that asset was bought for it to increase in value. Then when you try to look at this in this Roman 2, they gave us the measurement basis they used. They said they are going to be using fair value. But I want you to understand something. They have told us that they are going to be using fair value as the measurement base. But we have to understand that under IS 16 PPE, because we have agreed that the other land that was costing 80 million and the building, they are going to be accounted for under IS 16 PPE. So we have to know that what are the measurement bases that are there in IS 16 PPE, or property, plant and equipment. When you try to look at the models that are going to be used under IS 16, you don't see there any fair value model. We only use the cost model and the revaluation model under IAS 16 PPE. So it means that we are going to look at those two models that are used under IAS 16. Which one represents the market value? Because we say the fair value is more or less the estimated market value or the market prices. So we are going to be using now the revaluation, because the revaluation is more or less, is almost the same as the fair value, because all of them, they try to look at what they can actually get after revaluing. And whenever they are doing these revaluations, most of the times they consider factors that are within the market whenever they are doing the revaluation. So here, if you are to use the cost model, you are going to be off. This one, we are going to be using the revaluation model when you're accounting for the other assets that are going to be falling under under property, plant, and equipment. But for these items that are going to be under investment property, we are going to account for them using the fair value model as they have suggested. And we've seen that it is only land one that is going to be falling into that. So basically, that's how we do the analysis. After doing that analysis and you have analyzed everything, then you can try to go ahead and start calculating these numbers. We said one of the things you look at is the purpose. The second item you look at the model that has been used, or the model that has been adapted by the organization to account for those assets. And the other one, we also look at the time, of course, the period they have acquired the asset, and the cost, or the money they have paid. Those are the things we consider. So one of the emphasis, or one of the things I want to emphasize here, is that this paper is more or less theoretic. Actually, it is. It's not all that you are going to be computing, that whenever we are talking about accounting, you are going to be doing computations only. Because for this number, if you are to do only the computation, you couldn't get all these 13 marks, because you can't compute these figures and you start saying you will be able to earn these 13 marks. What you have to first give is you explain what we've been explaining, and don't be too wordy. Make sure you write something that is precise and concise. Of course, you write something that is not too much, but at least it is making a point. And the things we are going to be writing, they are going to be the purpose, and where it is going to be accounted for, and why is it accounted for there. Those are the things you put. If you find that you are answering those 3 questions, it means you have done it in the right way. We said first you talk about the purpose of the asset. The second one, we try to look at the model that you are going to be using, and which standard is going to be used to account for that, and why. Those are the things you're supposed, actually the key items you're supposed to be following whenever you are answering some of these questions, especially on non-current assets. So let's try to look at the Excel. We go to the Excel and we try to do the computations, and we see what we can do. Having read through what we actually have analyzed, I'm going to first make a summary of what we have actually discussed, and we'll see what we can do. This is the same question. I just copied it, but it is the same question. Can I go to the other slide, and we'll try to look at what we can do. We'll go to the next one, and we'll try to see what we can do. The sheet, then another sheet, and we try to see what we can be doing from this. Okay, we try to look at the summary. We said the land one, we first make summary. The land one, we start with the land one. We said this land one was acquired on 1st January 2015 at the value. We said the value was 100 million. Permit me to use M. Okay, let me put it here. These values are going to be in millions. They are in UGX, but you can put any currency sign you want, but they are in UGX or Ugandan shillings. We said now we'll go to the purpose. What is the purpose of the asset? And the purpose was not yet decided. And we agreed that this is going to be accounted for, not yet decided. We agreed that this is going to be accounted for under IS 40, investment property. Then we try to look at the model. The model they used, they told us the model is fair value model. That is the estimated market price. Try to zoom in and be able to see what we are writing. Then they have told us that we have even the inflation. The inflation was 15%. But as I said, you make sure you understand what we are writing, because in the other questions you may find that they have given you a deflation, which means there was a fall in the value. So you'll be able to understand that. Okay, so when you have done that, this actually is 15% per annum. It's per annum, meaning every year the values are going to be increasing by 15%. But when you try to look at this question, the question says we are looking for the financial statements that are for the year ended 31st December 2016. When you try to look at this, you see that this asset was bought on 1st January 2015. It means we are reporting the reporting date. We are reporting for 31st December 2016. It means if we have these figures, since it is land, we are not going to depreciate it. But take note, if it was a depreciable asset, you first compute the depreciation, because they had given us in the question there is a depreciation. They have given us that actually it is only the building that is depreciated for 5%. Actually, I will explain more when we reach the building. But if this, take note here, if this has been a depreciable asset, if it wasn't land, you first depreciate, you get the carrying amount as at 31st December 2016. It will be that we are going to be taking to the, actually you first compute the depreciation before you adjust the values, the inflation, but you add after that you compute the depreciation that is going to be taken to the income statement, because they have also told us to prepare the extracts extracts for financial statements, we said in the previous videos that these extracts, these extracts actually they just want only the financial statement of financial position and the balance sheet. Actually, it is a balance sheet and the income statement. So, having done that, then we try to answer the question. Of course, we said this is going to be a mixture of computation and theoretical aspects. So here for land one, we have to start explaining how are we going to be accounting for this. We are saying that land one will be accounted for under IS 40 investment property. Then you put a reason why is it going to be accounted for under investment property, since nothing has been decided, nothing had yet been decided regarding its purpose. Therefore, or thus, it's deemed, or it's assumed that at that point it was being held for capital appreciation. Stop. That's enough. Just one line or two lines is enough to explain what is needed. Actually, maybe you can add that the land, we add the model that is going to be used. The land will be measured at fair value, because that's what actually, even if this one you don't put it, because that's what actually they have given us in the question, because they said Nyumban Limited is using a fair value measurement base. So if you are going to be using the fair value, then we need to know what is going to be the fair value, because this asset was acquired on 1st January 2015. Then at the end of the year, that is as at 31st December 2015, what is the fair value of that asset? That's basically what we are going to be looking for. Then we look for the fair value as at 31st December 2015. We first look for 2015, because they have told us the inflation rate is 15% per annum. It means from 1st January to 2015 to 31st December 2015, that's 1 year. It means the asset is going to increase in value by 15%. So the value is going to be 100 million plus we add 15% multiply by the 100 million, which will give us 115 million. This is going to be the value of the asset as at 31st December 2015. If at all we had depreciation, if at all this was a depreciable asset, we first depreciate this asset. But since it wasn't a depreciable asset, then we just take that. It means if at all in the question we are asked for 2 years, we could record this figure and also record the one as 31st, if at all we are asked for 2 years. But since we were asked for only 1 year, which is which ended 31st December 2016, this figure is useless. We are not going to put these figures in our financials, because the financials we are going to be preparing, they are for the year ended 31st December 2016, meaning that if the year is ending 31st December 2016, it must have started 1st January 2016. So that's basically what we have. If this is going to be the value of the asset as at 31st December 2015, then we have also to look at what are we going to be accounting for in that year as far as those figures are concerned. We have to look for the changes in the value. Another person here could say that this will be equal sign, it will be 100 million, then you just multiply by 1.15, which is the same as 100 plus 15, that is 115 over 100. If you multiply by that, you'll be getting the same answer as that. So that's that, and so that is it. Can now go to, because when you try to remove this, you'll be getting the same answer as we got this. So basically, when you try to look at, we said we have to get, since it is now going to be an increase, since we said it is going to be inflated, meaning we have to compute for the increase in the value of the asset. And how are we going to be getting? We get the cost, the new cost, or the fair value, which is the 115 million minus the 100 million. This will give us 15 million, and this 15 million will be a debit. We are debiting the asset, which is the land. Can just say investment property, which is the land 1 with 15 million, and we credit our profit or loss account. This is going to be in the names of other incomes, or the gain. Got a gain in the asset. The reason why this is going to be going to the profit and loss is because this fair value, these changes in the fair value is realized. Realized means that if at all you are to go to the market, that's the exact amount you are going to be receiving. You bought the asset at 10 million, but if you are to sell it, you are going to get actually 15 million. But if we are using a revaluation model, we could be taking that one as, we could be taking that revaluation gain to the OCI, or statement of other comprehensive income, which comes after the net profit. So we are going to look at how we can be able to account those ones when we try to look at the IS 16 PPE. So that's basically for this, for that year 1 EE. So now we try to look at what are the figures that we are going to be having, the fair value for the year. Now we are looking for the fair value, because this fair value we have is for 2015, but we need the fair value as at 31st December 2016. This fair value as at that date is going to be, now we are starting with the figure we had. This figure, if at all we are computing for 2015, this one is the one we could take to the balance sheet. So we are starting with that figure, which is 115 million times the 15%. They said the inflation, it is this plus 115 million. This one is in the bracket. There we are going to be getting these figures. We are going to be getting 132.25 million. That's going to be the value as at 31st December 2016. So it is this figure that we are going to be taking into the balance sheet of this debt. But again, here we have also to compute the increase in the price or in the value of the asset. That increase in the value of the asset, we said we are going to be getting the amount we've got, which is 132.25 million. We less the 115, which is the previous figure of, because this value we have here, 31st December 2015, is going to be the same figure as at 1st January 2016. That's why we are lessing to get the balance. So when you do that, you'll be having 17.25 million. And this one is going to be a debit. It's going to be a debit to the investment property, 17.25 million. Then a credit to the profit or loss account in the names of gain or other incomes, meaning this one is going to come after you've computed the gross profit. We are going to be adding a change or a gain, a fair value gain. This one is going to be taken to the income statement, and this figure will be taken to the balance sheet. So we can now go to land 2 and you try to compute the land 2. We've done land 1, and for now we can go to land 2. This land 2, and land 2 said it's going to be accounted for under PPE because it was used as head office. You can make summary. It was acquired when? It was acquired on 31st. It was acquired on 31st December 20. It was acquired on 31st December 2015. The price was 80 million. Then we try to look at what is the purpose. What was the purpose of that asset? The purpose was head office. Meaning, if it was head office, it is the same. The same we could say it was used for own occupation or administrative. Then the model, of course, the model here they are going to be using is the model. They said it is a fair value, but since we don't have a fair value in IAS 16, we are going to be using revaluation model. I explained that the reason why we are going to be using the revaluation model. Then we can do some small explanation because we said this is a combination of computation and theory. We are saying land 2 will be accounted for under IAS 16 PPE. Permit me to use that since it was used for construction of the head office building. Here you can put owner occupation. That is the reason why it's going to be accounted for. And then you can also add that it will be measured in the measurement. It will be measured at market value. That's the fair value. The market value, of course, the market value in this term is called the revalued amount. You say the revalued amount is the amount you get after the asset has been revalued, or the estimated market price. So now we need to compute the revalued amount. The revalued amount is going to be inflated because the inflation is there. When you try to look at the revalued amount is going to be equaling to, the cost was 80 million. Now this revalued amount is going to be as at, since this asset was bought on 31st December 2015, it means the revalued amount as, so let me add as at 31st December 2016 is going to be 80 million, is 80 million plus the 15%. And when you do that, we are going to be getting 92 million. This one will give us 92 million. Having gotten that, then we have to look for another item that we are going to be accounting for in this IS 16 PPE, which we call either a revaluation gain or a revaluation loss. But since these items have been inflated, then we are going to be having a revaluation gain. And this revaluation gain, revaluation gain is going to be equaling to the 92 million minus the 80 million, which will give us 12 million. And that 12 million, how is it going to be accounted for? It's going to be a debit this time around. It's not an investment property, it is a PPE. Let me to use PPE. In terms of land 2, I'll put land 2. Then 12 million, then a credit. This time around, we are not taking it to profit and loss because this 12 million is not actually realized. It is just a revaluation. We said whenever we get a revaluation, it's not actually an income that we can actually get it, but it is just an estimate that if we go on the market, we may get this item at this price. So this one is going to be taken to the OCI, or other comprehensive income. And this other comprehensive income is coming as is an item that comes after you've actually got the net profit. When you have computed the net profit, it's something that comes next. So it means this revaluation gain will be taken to the balance sheet and equity component. It's an equity component that will come there as a revaluation in the balance sheet for 2016. So that's basically what we wanted from that. And we can try to look at maybe this one. I can add things. This one is coming as a valuation gain. What I don't want you guys to get confused is the market value, or the fair value, and the valuation. They are more or less estimated market prices. So you don't get confused from there. So we try now to look at the third property, which was buildings. Third property, which is buildings, the building they constructed. This one we don't need to explain anything because we've actually given a highlight. I've given you a highlight of what's supposed to be done. Because if the land one is accounted for under, if the land two is accounted for under PPE, it means even the building is going to be accounted for under PPE because this building is on that land. It is already accounted for under. So there is no need for that one to explain. You just take the cost, its cost. The cost one was 120 million. And we are seeing that the purpose, of course, even the purpose was for head office. Purpose was head office. And you have also the depreciation. Here, this one is a depreciable asset, so we need to depreciate it. The depreciation, they told us, is 5% in the question. So the depreciation was 5%. Then this one, even if you don't write, but if you want, you could write something and you say the building will be accounted for under IS 16 because it is going to be used as a head office. So let's try to compute the depreciation first. The depreciation, permit me to abbreviate it like that. The depreciation is going to be 5% multiplied by the 120 million. This will give us depreciation expense of 6 million. And this depreciation expense of 6 million will be taken to the income statement as an operating expense. Then we get the carrying amount. Since this one did not increase in value, so we have to get the carrying amount. And we said the carrying amount is going to be the cost minus the depreciation. Our cost was 120 million minus the 6 million. This will give us a figure of 114 million, 114 million. This is what we are going to be taking to the balance sheet as the carrying amount for the building. Actually, this brings to our conclusion, and we are trying to look at now, let's try to develop the extracts as they wanted them. The extracts, now we start with the extract of statement of financial position. Permit me to use an abbreviation. Statement of profit. Profit or loss. And other comprehensive income. This is what I've been calling OCI, comprehensive income. This is for the year ended 31st December 2016. Then we have the other incomes. Other incomes after gross profit. We have the other fair value. The fair value gain that we got from the investment property, that is land 1. The figure was 17.25 million. Then we look also for the expenses. Have to look for the expenses. These expenses will have depreciation. This depreciation we have just computed. The depreciation we computed of 6 million. And from there we go to the OCI after getting the gross profit. Of course, we go to the OCI and we put the revaluation gain. The revaluation gain that was land 2. Which was 12 million. And that's what they wanted for. That was the extract they wanted. Then we also make the extract for the balance sheet. Extract of statement of financial position. Permit me to use SFP as at 31st December 2016. We have We may start with the PPE, property, plant and equipment. Within the PPE, we have two items. One, we have the land. We have this land too. Land 1292 million. And the building. The building, which is 114 million. Then we go to the other item, which is the investment property. On the investment property, we had on the that land 1. This was land 1. And the carrying amount of that land 1 was 132.25 million. Then there is one item that is missing, which is the equity section. Can we go to financed by? Have equity. And under equity, we have evaluation gain or surplus. They call it evaluation surplus of 12 million. And that's basically what they wanted us to do for that number. And when you have done all that, be able to get all the marks. That's what basically we were supposed to do. And that's what we were supposed to do for that number. So that's it. Till we meet again. Of course, the next one is going to be on how these assets, how are they going to be changing if at all the purpose of the asset is changing. And we had an investment property today. and we are converting that asset maybe to owner occupation, or we are converting the asset to being inventory. So those are the items we are going to be looking at in the next video. So if at all this video has been useful to you, make sure you subscribe, share to others. They also have a benefit, because what we are doing here is a step-by-step understanding of some of the complicated aspects of accounting, and we are breaking them slowly, so that you can be able to achieve, match, and pass CPA with your first trial. So thank you for watching, and let's meet in the next video. It's bye for now. Good evening, viewers. Today we are going to resume our series on financial reporting, and today we are going to finalize with our IS 40, that is investment property. And yesterday we looked at the first computation and we did some calculations, but today our main focus is going to be on the transfers. If we have transfers which are going to be either from investment property to other properties, or they are going to be from other properties to investment property. Meaning, the question we are going to be looking at is a small matter that is going to wind up our standard IS 40, and these are going to be the transfers to and from investment properties. And basically, when we are trying to look at some of these transfers, either they are going to be from investment property or they are going to be to investment property from other assets. And how this comes into existence is in the sense that they are going to be a change in the use of the asset. If the purpose of the asset is going to be changing, how are we going to be accounting for those changes? If maybe the asset has been used for capital appreciation, and this time around you find that the company is going to occupy that asset by itself, or they are going to be selling the asset that has been there for capital appreciation or for earning rental income, and now they are going to sell it in the normal course of business, and they are coming in to be inventory. If let's say it was an item of PPE, and now it's going to be converted from owner occupation to earning rental income or for capital appreciation. Those are basically the things we are going to be looking at here. And having understood what we are going to be looking at as far as the question we are going to be handling today is concerned, just have to have something in mind that whenever we are talking about these transfers, the main challenge is going to be when these assets are moving from investment property. Because when these assets are moving from investment properties, we've seen that when we are handling investment properties, we are using these measurement bases, the cost model and the fair value model. And most of the assets, they have a difference in the model that has been, or that is going to be adapted by the organization of how they're going to be accounting for such assets. Because if you try to look at the investment properties, we are going to be using the cost model and the fair value model. But when you try to look at the PPE, you find that is IS 16, you find that we are going to be using cost model and the valuation model. So I want to look at a scenario whereby, because now if the asset is going to be carried at cost or using the cost model, that one will not bring more problems. But what will happen is that if let's say an asset is going to be transferred from investment property to IS 16, that is PPE, and that asset is now, instead of being carried at cost model, is now being carried using the fair value model. Because by all means, whenever they use the fair value model, it means it's going to create a difference. Because when you try to look at the IS 16, we don't have the fair value model being used there to accounting for those items. So our main challenge of what we are supposed to be learning from this video is how are we going to be accounting for these items that have been transferred using the fair value model, because that's the model that is different as far as other standards are concerned. Because when assets are going to be carried using cost model or using their initial cost, there it gives no problem because the treatment are going to be the same. But now we want to look at a scenario whereby if let's say it has been an investment property and it is now going to be carried at fair value, maybe to IS 16 PPE. So how are we going to be treating that item? Which values are we going to be assigning to that asset when it reaches the PPE? Actually, that's the major outcome of what we are going to be learning from this tutorial. So, without wasting more time, today I selected to handle question. It's a question from 2013 June, and it's going to be question 5 part C. When I analyzed this question, I looked at it in the sense it is a very short number, but it has some broad aspects that we can look at, and they will be able to cover the standard as a whole, because it has some element of derecognition, whereby how do we derecognize an item of investment property or an item of IS 40. That's basically what we are going to also add from what we are going to be getting from this. It's not all about giving solutions for these numbers, but it's all about understanding, because whenever I give you something, I make sure that it will help you add something on what you have been knowing. So let's try to dive in the question and try to see what you can have from this question. That's the question 5. Part A is all about IS 23, that is borrowing cost. Of course, today we are not going to look at that. And even part B is about the borrowing cost. That one we shall handle it in the due course. But for now, let's try to concentrate on this the part C of question 5, which is a bit brief, but it will give us something. It was a 5-mark question, but when you try to look at what we are going to be learning from it, it's worth attempting. So it says that JRK Limited has 3 investment properties in Masaka town, codenamed 1, 2, and 3. Those are the codes they have, 1, 2, and 3. And the company's policy is to carry its investment property at fair value. That's the model that they are going to be using to account for those 3 investment properties. And they are saying that during the year ended 31st May 2013, the company developed property 1 with a view of selling it by 30th June 2013. Then they are saying property 2 was to be disposed of without development, while property 3 was reoccupied by the company's new branch opened in Masaka on 5th April 2013. Then the required says discuss with reference to IS 40 investment property how the 3 properties should be presented, recognized, and measured in the financials of JRK Limited for the year ended 31st May 2013. 5 marks. When you try to look at what they are asking and try to analyze, here we see that what they want us to explain is these 3 items: the presentation, and whenever you're talking about presentation, we are looking at the financial statements. And mainly these financial statements are going to be balance sheet and the income statement. Then the other one is the recognition. How do we know that we have an item of a given nature? Then the last one is the measurement. Which mode or which alternative means is going to be used to account for those items as they are going to be converted or transferred to wherever they are going to be transferred. So that's basically what we are going to be looking at for today. And you can go to the Excel and try to see what we can do. But that's basically what the question wants us to do. It says, because we've seen that the company JRK Limited had 3 investment property, meaning all these assets were investment assets, or initially they were accounted for under IS 40 investment property. But during the year, we are seeing that some of these assets are being converted. Property 1 is to be sold. Property 2 was disposed of. Then we are seeing that property 3 is being reoccupied, or it has been taken over by the company where it used that same property as its own branches. So that's basically what we are going to be looking at. And as we discussed yesterday, that when you're looking at this financial reporting, most of the things we are going to be doing is not only giving computations, but because now when you try to look at this question has nothing like any figures in it. So it means you explain according what the statement or what the standard says. This is going to be like Bible, where you say this verse, this and this and this, because that's how it was written and that's how it is going to be. Because now when you try to look at the required, they are saying discuss with the reference to IS 40. It means whatever you're going to be doing or whichever explanation you are giving, make sure that it is in line with what the IS 40 investment property says. So before we do anything, of course, we have analyzed the question and we've actually seen what they want us to do. We've seen the scenarios and we want to look at how are those properties in the scenarios they have presented them. Okay, this is the same question. I just copied it from there, pasted it here, but can try to go to this sheet and we'll be able to see what we can do. We said we are going to be having different properties, and we start with the property 1. Property 1, and we've seen that if you try to go back to the question, we are seeing that they have said that property 1 during the year ended 31st May 2013, the company developed property 1 with the view of selling it by 30th June 2013. Actually, when we try to look at the theoretical aspects we first gave in the first video about the IS 40, we discussed that whenever there is a transfer from, because now we are seeing that this property is now being developed with the view of selling it by the end of 30th June 2013. So if they are going to be selling that asset, it means since all these assets were investment property, it will be a transfer from IS 40 investment property to IS 2, that is inventory. Because they have told us that they are going to the company developed property 1 with the view of selling it. So if they are going to sell it in the normal course of business, then we write it off from the investment properties and we include it in our inventory. So basically, this is going to be a transfer from IS 40 to IS 2. And what we said about these transfers, we said that whenever we have a transfer from investment property to IS 2, we try to look at, we said we look at, whenever we are looking at these assets, we try to look at the purpose of the asset. Now this asset is going to be sold in the normal course of business. And how do we tell that they are going to be selling this asset? Because they have told us that the company is developing these assets with the view of selling them. What this means is that whenever you are making a sale, if let's say you had a building and whenever you want to sell a given asset, you have to renovate that asset to make sure that at least it can fetch something from the market. Because when you see that the company is now developing the asset, or it is trying to modify the asset, the extent that it can convince the buyers to pay a large lump sum of money, which means that we've seen actually the evidence. The evidence is there that they are going to sell this asset because they are developing it with the view of selling it by the end of 30th June 2013. So whenever you are explaining this, you try to look at where is the asset coming from and where is it going. Having looked at that, then you have also to have an evidence that at least something is occurring, because they have actually told us what they are doing and what they expect by the end of 30th June. So that's the evidence. And we said then one of the things that is very important whenever these transfers are happening is that what amount or which amount are we going to use to record these assets? If at all they have been transferred, which amount are we going to be carrying to where they are going? If let's say the asset, but now here they have told us the model, it is the company's policy to carry all investment property at fair value. So if they are carried at fair value, we said for a transfer from investment property to IS2 inventory that is carried at fair value, then that fair value or that amount at the date of change in use is going to be its assumed cost under IS2 inventory for subsequent accounting or subsequent measurement. So what does this mean is that it gives us that at the value of the asset, or what we can actually get from the market at the point of change when we are transferring that asset, it is that same price that we are going to be using to account for that asset when it has been turned into inventory. So that's basically what we could do, and those are the things we are going to be writing. So we may go the other side and we'll try to write exactly what we've said. We are saying that this, now we are on this property 1. We are saying this will be because here they are saying, remember here, what we are accounting for is for the year ended 31st May 2013. But this asset, this property 1, will be sold 30th June. It means this asset, they have not yet actually sold it, meaning this asset is still within the other limits. But here we are supposed to say that this asset will be accounted for. The reason why we are saying it will be accounted for because they have not actually sold the asset yet. So that's basically what we are supposed to be writing. And we are saying that this asset will be accounted for as as a transfer from IS 40 investment property, IS 40 investment property IS 40 investment property to IS2 inventory. Then we have to put the evidence. Evidenced by development of the property, with the view of selling it by 30th. It is 30th June 2013. And try to zoom in. A bit. By 30th June 2013. Then we can also add that, remember they have told us to give the recognition, we give the presentation, and we give the measurement. Let's now try to look at how is it going to be measured. It's going to be measured, we say it will be measured at the fair value, because that's the model the company adapted. To the fair value on the date of change. The date of change in use. Then we try to look at now the presentation. How is it going to be presented? And we say this presentation is all about what figures we are going to be putting in our financials. And we are saying that this will be presented under current assets. Remember inventory, those are current assets on inventory. Inventory in the balance sheet. The balance sheet as at 31st May 2013. And that's basically what they wanted us to write about that property one. Then maybe we try to look at this property 2 and we see what we can do for it. Then we'll go to the property 2. Property 2. Remember, they told us this property 2, they go to the question, and they are saying that property 2 was to be disposed of without development, meaning it was also not yet disposed, but they were going to dispose of by the end of the year, of course. So it means that we are going also to look at how are we going to be accounting for this item, because we said that whenever this asset, for it is not going to be developed anyhow. It means it is not going to be falling under inventory. What this means is that this asset, they are going to sell it, whether it is in scrap form, they are going to sell it the way it is. So for it is going to be derecognized. We are just going to remove it from our investment properties, because for it, they are not showing that they are going to develop it to turn it into inventory or to be sold in the normal course of business, but they are selling it the way it is. It may be in a scrap form, it may be in any way it is. So it means here we are only going to derecognize or remove it from our investment properties. So having understood that here we are going to be derecognizing an investment property, it means this asset is not going to be transferred anywhere. It is going to be sold like the way they do the normal selling. And whenever an asset has been disposed of, or whenever an asset has been sold, we compute a gain. Either we are going to be having a gain or a loss on disposal, which are going to be taken to the profit and loss. So in our explanation, we have to look at those gains and losses that may arise after the disposal of these assets. And if at all we are given figures, you try to compute and see whether you will be having a gain or loss as you got it from your financial accounting, on how you can be able to determine your gains and losses. So having seen that, then we have to look at what will be the condition that shows that this asset is going to be derecognized. Of course, when you are buying these assets, we expect that we are going to be getting future benefits. As we stay with the asset is going to be used in the business to earn some income to the company. So if at all these benefit or the recognition criteria are not going to be met, because when you're selling off these assets, it means we are no longer going to be receiving the benefits from the asset. So it means if at all we are no longer receiving the benefits, it means we have to derecognize. It means we have actually derecognized the asset, since it is no longer meeting the recognition criteria. So that's basically the things we are going to be doing, and we try to maybe to write something on what we actually discussed. We are saying that this company, it's called JRK Limited. This JRK Limited will continue presenting. Let's start with the presentation. we'll continue presenting this asset, or we'll continue presenting it as an investment property. Investment property under non-current assets. Non-current assets. And I want you to get this very clear. The difference between property 1 and property 2 is that the other property 1 was renovated and they wanted to sell it in the normal course of business. That's why it was taken to inventory. But this property 2, for it was sold without any development. It means that this asset, before they sold it, it was still an investment. They sold it as an investment property. So it means for this one, we are just going to be recognizing it. It's not a transfer nor whatever. It is just the asset has been sold like any way they can sell maybe a scrapped car or that. So having known how this is going to be presented, then we'll be knowing which values are we going to be assigning to that. And knowing these values, we are going to be using the cost model, because that's the model that were adapted by this company, JRK Limited. Then we can also add and say, and it will be measured. It will be measured at fair value. At fair value when it's or when it is disposed of. Disposed of in the future, because they haven't yet sold it. Then maybe the last one, it will be derecognized. And the entity will determine a gain or loss on disposal, which will be taken to the income statement or profit and loss. Profit or loss account. If it is a gain, it will be taken as an income. It will be taken as an income because for it is realized, since we are using the fair value. Remember, we said these fair value gains goes to the profit and loss. So that's basically what we could talk about as far as So that's what we could talk about as far as property 2 is concerned. So let's try to look at our property 3. Try to look at the property 3. Now this property 3, they told us that the property 3 was reoccupied by the company's new branch opened in Masaka on 5th April 2013. If this property was occupied by the company, it means it's now going to be converted from investment property to PPE. Because we said with PPE, those are the assets that are going to be used by the administration or that are going to be used by the organization itself, the production and supply of goods and services. So if it is so, then we are going to look at a transfer from investment property to PPE. So we can try to write something here, and we say that this will be accounted for as a transfer from investment is from IS 40 investment property to IS 16 PPE for property, plant and equipment. Then we have also to put the evidence and evidenced by reoccupation. Reoccupation by the company's new branch opened in Masaka on 5th April 2013. Then we try to look at how is it going to be measured. It will be measured at fair value on the date of change in use Then we can try to talk about the presentation, and will be presented as PPE, the balance sheet. Balance sheet as at 31st May 2013. So that's basically what they had asked, but you can add on, because we expect that since this asset is going to be carried at fair value, there are going to be a scenario whereby this asset is going to come in as a PPE. But remember, in the PPE, we don't have a fair value. So what that means, it means that the change in the prices between the carrying amount of the asset under investment property and the fair value or the actual price they have paid to acquire the asset, that one is going to be accounted for as a revaluation, and that revaluation will be taken to the OCI as in terms of the valuation gain, and if it is a loss, then it will be taken to the profit and loss account as an expense. So that's basically, you can add on the change in the value, change in the fair value, the change in the value will be accounted for as a revaluation. Because we said this one is going to be treated as a revaluation, because it's like we've not actually realized it, because within the PPE we only have a revaluation. So when it becomes a PPE, we will take it as if the asset has been revalued, and if the asset has been revalued, we do it in the normal way we've been doing the revaluation under IAS 16 PPE. So that's basically what I wanted you guys to have, and this brings to the conclusion of the standard, and I guess you've learned so many things, and you can be able to handle most of the challenging questions that are going to be coming from this according to what I've given you, because I believe in what I've given you is something that can be able to create a momentum for you to be able to handle any question from this standard. So with that, we are going to, in the next video, we are going to start computing or starting calculation on IAS 20, that is accounting for government grants and disclosure of government assistance. So when you start on that, then you can see what we can do and be able to understand, or will enhance our learning and be able to understand more and more of how we can do certain things within financial reporting. I urge you guys to subscribe to the channel and click the notification bell icon so that you can be able to be notified whenever I upload new videos on our series. As we started them, I call them series because we are going a step by step and we are learning from we are able to pick knowledge freely from the start to the end. And if you join me, we are going to be having something that is going to be productive, and you'll be able to learn, improve your understanding, even if you're not going to be doing exams, but at least these are the things people do in their daily work as far as accounting profession is concerned. So with that, I wish you the best, and it's a bye for now.
Good evening, viewers. This is your tutor again, CPA ACCA, and today we are going to talk about IS 20, that is accounting for government grants and disclosure of government assistance. Before I go any further about the standard, when you are talking about that standard, it is IS 20, accounting for government grants and disclosure of government assistance. There are two items here that are key, and we need to look at them before we proceed to anything else. We have to account for grants first, then we disclose the government assistance. Accounting for grants, the reason why we account for grants is that grants are basically they can be quantified in monetary terms. And the reason why we can't account for government assistance is because government assistance can't be quantified, or there are so many types of assistances that the government can give to the organization, which can't be turned into a monetary value. That's why we just disclose them. You may find that there are laws which are being passed by the government and they are helping the organization. These government assistances, you may find that they are in form of tax holidays. Government assistance may be in terms of giving them free zones and whatever to operate. So there are so many things. So most of the things you can't attach value on them. That's why we just disclose them in the notices to the financial statements. So that's basically the two items that are there. The grant is part of the government assistance, but for it is in terms of, it can be quantified in terms of monetary terms. And that's why in accounting, we only account for something that can be quantified. The one which cannot be quantified, we just disclose it, or we just mention it in the notes to financial statements. Those ones we'll learn about them when we start the income statement preparations. So, maybe to give you some terminologies that are being used within the standard, it is accounting for government grants and disclosure of government assistance. The government is, it's the whole of the word, it's everywhere. So when you're talking about the government is not only the nation of any country, or it's not like the state of any country. No, it's the government, as per this standard, it is incorporating other. It can be an international organization, it can be government agencies, they can be local authorities. So long as they have an impact to the organization, they are termed as government. So it's not only the government. We know that it's the one that's supposed to be transferring the assistance. It may be from an international organization, international agencies and all that. It may be from government agencies like URA, they are giving you tax holidays and all that. So the government is a broad item which consists of those items as per this standard. So when you talk about this government assistance, it is where we may be getting from the internal government, we may be getting from the government agencies, we may be getting them from the local authorities, we may be getting them from the international agencies. So that's basically what we can look at in terms of the scope of the government as far as the IS 20 is concerned. So when you try to look at, I can basically try to explain what are some of those terminologies, the government grants, government assistance. But since I said that government grant is also a government assistance, so let me start with the government assistance, because the other one is just like a subset of this one. It is inclusive. The only difference is that the other one is quantified, these others can't be quantified. And we are saying that government assistance, these are just actions by the government designed to provide economic benefit to the entity or entities under a certain criteria. When you look at the government assistance, there are certain things which we talk about. We have the actions of the government. Second thing is that they are supposed to provide economic benefit. This is economic benefit. Then they are under a certain criteria, or there are certain conditions that are attached to it. So when you try to look at what are some of the actions that the government can do to benefit the organization, there may be tax laws. They amend some tax laws. Maybe they are giving tax holidays at a condition. Maybe if the company is going to employ some Ugandans, some certain percentage of Ugandan labor force, so that to fight the unemployment. It may be the government giving even free land. You may find that, because we are talking about government assistance, it may be in terms of money, land, or it may be in these other laws, giving tax holidays and other laws that are going to be set by the state. These actions are basically, they may be in terms of present or past event. They may give you the assistance in terms of the expenses you incurred long time. They may give you things that you are going to do in the future. So it may be passive or not. So it may be a past event and they are just compensating. So whichever way, so long as there is an economic benefits coming to the entity, we call it a government assistance. But if it is that assistance can be quantified in terms of money, or they are giving you assets, then those ones, they are the ones we call grants. They only become grants if at all they are going to be transferred. There is a transfer of resources from the government to the entity in return for past or future compliance. These definitions, they are very, very important. One, it must be a transfer. Then that transfer must be from the government to the entity, and that entity must comply to the conditions that are attached to that grant. Basically, that's what we can talk about in terms of the government assistance and all that. But what you need to know is that a government grant is an assistance by the government in the form of transfer of resources to an entity in return for past, present, or future compliance with the conditions relating to the operating activities. They can give you the money. Let's say they are giving you money or assets, but they are telling you that if you are to qualify for this money, you are supposed to do this and this and this, or in the line of the activity you are doing, you are supposed to be doing this, and it is of a benefit to the organization, to the state and the organization. One, they may say we are giving you money, and that money, you should use that money to add on the maybe to expand the factory so that you can be able to employ more people. By doing so, the government is benefiting in the scenario of chasing unemployment or fighting unemployment, and also the company is benefiting by getting the money. So that's how basically it is. So if there is a physical transfer of the item from the government to the entity, it means that's a grant. Whether it is in terms of assets or it is income, it's a grant. So what we can only talk about in terms the recognition criteria. How do you tell, or how do you incorporate the things within our statements? When do you recognize that I have received a grant? There are also certain recognition criteria you're supposed to follow when you are accounting for them. One, the entity will comply with the conditions attached to the grant. Because if at all you are not going to comply to the conditions attached to the grant, then you are not supposed to receive the grant. Because if the government says, we are going to give you this money, but you should employ this and this number of people in that area, and you are not willing to do so, then you are not supposed to be accounting for that grant. Or it's not even going to be given to you, because there is a condition for that. Secondly, the entity will actually receive the grant. You know certain agencies, they promise that we are going to be giving you grants, or we are going to give you this and this amount of money, but they actually not give them. We recognize the grant not necessarily when we have received it, but when it is probable that we are going to receive it. Because being probable means it is more than 50%. You are sure you will get it. That's as per the accounting, the accrual concept, that not recognizing that when you have actually received it, but at least this one we are sure it will be coming. That's when you recognize that there are two conditions only. One, the entity will comply with the conditions attached to the grant. Secondly, the entity will actually receive the grant. So there are forms of grants. These are basically what we are going to be focusing. We are focusing on grant because we said we can't quantify the other assistance, but not forgetting that a grant is part of the assistance. Okay. We are saying that there are types of grants. One, we have grants that are related to assets, as I've been communicating, and there is a grant related to income. There is when they are giving you assets, they may be giving you the physical asset which they have acquired, or they may be giving you money to construct the asset, or it might be just money not for constructing asset but for others. According to the standard defines the grant related to income as these are grants where the entity qualify for, or where the entity qualifying for them must acquire or construct a non-current asset. If it is money that's supposed to be used for construction of an asset, it must be constructed. or must be purchased. Then there is also grant related to incomes. The funny bit of it is that the standard doesn't like specify that it is income, but for it says these are grants other than those related to incomes, to assets. Whichever grant that is not related to asset, then it is called grant related to income. That's how it is, but it can't fail us to proceed with. So there, as we said, we are going to be focusing on accounting for the grant. So how do we going to account for these grants? How are we going to account for these government grants? But remember, this accounting for government grant is in general, the general accounting for the grant. One, there are two methods. One, actually there are two methods, but it's only one that is allowed by the standard, that is IS 20. That is income approach. The capital approach is not allowed, so we are going to just talk about it, but we should not like focus much about it because it's not allowed. One, we are allowed to treat the grant as an income. That's what is allowed as per the standard. And they have also the advantages why they chose income approach than the capital approach. And we are saying here the grant is recorded in the income statement on a systematic basis over the relevant period of time. And we are saying that that income we are going to be recording in the income statement, we must also record it as its related costs. The way we record it is the same way we are going to be, or the way we record the costs we've incurred on that is the same way we record the grant. In other words, we keep apportioning the grant year by year, depending on which costs we've incurred, depending on the amount we've actually used. That's basically how we are going to be doing that. And we have arguments why they chose that, because one of the approach is income approach, the second one is capital approach. Capital approach, for it says that we recognize the grant in the balance sheet as a financing device under equity. That for its grant, since it is coming to the organization, we put it under the equity section of the balance sheet. But the approach is, it has been criticized that this amount, we are not supposed to include it in the balance sheet because that money is not a financing component from the shareholders. It is just money that has been contributed by the government. The government is not the shareholder. So why are we recording that money into the capital, the equity component? Because we know from the balance sheet, the equity has the elements that are within from the shareholders, the retained earnings and all that. But grants is not part of that. So that's why it is criticized, and it is here, down here I'm saying NB IS 20 does not permit the use of capital approach in accounting for government grant. What you have to not to forget that this is general accounting for grant. I'm not talking about accounting for the one that is related to asset or income. No, this is a general one. There is a different way we treat the one that is related to income, the one that is related to asset. But basically, a grant is supposed to be recognized in the income statement as just income received. But we don't recognize it all. We recognize the portion that we are going to be using. if we receive a grant of 10 million and we incur expenses, if it was for construction of let's say the building, and so far we have constructed the year ended and we've only, on that grant we've used only 20, let's say 2 million. It's only that 2 million that is going to be taken in the income statement as its related income and expenses. The way we treat the other one is the same way. So we are going to see how we will do that. But let's first look at the arguments in support for the income approach, or the advantages of using income approach over capital approach. We are saying that the entity earns the grant by complying with the conditions attached to the grant. Because one of the criteria, we said that the entity should comply to the conditions that have been assigned to the grant. So by doing so, it is implied that it's like, by complying to the conditions, it's like someone has earned the money, because they have given you the money and they have given you the terms. If you do the terms well, then it's like you have worked for the money. That's basically the reason why they chose income approach to be included in the income statement, because by complying, by the entity, since the entity is going to be complying to the conditions or requirements, it's like it is earning it. Then the second thing is that the grant should be recorded in the income statement as part of the fiscal policy, just like taxation of profits appearing in the income statement. Do you know how we include the income statement? Because in the income statement we include there the taxes. After getting the profit, then we less the taxes. We get the profit after tax. That's also one of the reasons that it should be, since it is also, because even the tax is going to the government, even this one should be included as the fiscal policy. So the third one is that the grant should not be recorded in the balance sheet. They should not be recorded in the balance sheet under equity section, since it is not funding from shareholders. That one I spoke about it. So can proceed to the next one, and we try to look at the non-monetary grant. Let's first look at the non-monetary grant before we got the presentation. We are saying that when the government transfer the non-monetary asset to an entity, like a piece of land, the fair value of such asset will be used to account for both asset and the grant. So we have scenarios. You may be given land, but land will be treated under different standard, that is IS what? IS 16, because the reason why it is going to be treated under IS 16, it is that it is going to be used in the production of income. That's why it is going in IS 16, not investment property. Hope you can be able to get the difference. And the grant, because if they give you land, the money you can get the fair value of the land. If let's say they have given the land, and the land, it can cost, let's say 15 million. It will be that 15 million that we shall use as part of accounting for the asset we have acquired, and also the grant, because it's a grant, because we have not yet issued any money to buy that land. Remember, for you to acquire an asset, you must pay for it. So since you are given it for free, we treat it as income, even if it is not given for free, because you have to comply with to the requirements. It's like you've worked and you've earned it. So that's how basically we do that. If it is a non-monetary grant, we make sure that the asset, if it is land, we make sure we recognize them into PPE. Most of the times we are going to be recognizing them into PPE, because we are going to be using them in the operation of the business from the definition of the grant. We are complying to the conditions in the operation of the business. So they are going to be treated in IS 16, that is PPE. Then the grant will be accounted for under IS 20. Then how are we going to be treating the if let's say the grant is related to the asset in the income statement? There are also two approaches. One, we've already known that we were supposed to treat that in the income statement. That one we know it is the general thing. Then, if it is income that is related to, if it is grant that is related to an asset, you've been given an asset, what we do, one, we may set the grant as a deferred income. Deferred income means it's like unearned income. You have got the money, but you have not yet earned it. It means we are going to be recognizing the portions that we are earning. So what happens is that if that grant, remember it came as an asset, but that asset has a useful life. The same way we are going to be depreciating that asset is the same way we are going to be earning the rental income. It is going to be spread over its useful life. Even the grant income is going to be spread over its useful life. Even at the point if it is time apportioned, like if let's say they give you the grant in the middle of the year, you are not supposed to recognize all the income for the whole year. You're supposed to apportion it, time apportion it. You time apportion the depreciation, and you also time apportion the income you have received. The real reason is that if you time apportion this grant you've received as in terms of income, and you are charging, because this income you are charging an expense, a related expense, which is depreciation. Depreciation is like we are reducing the excess depreciation that you would have charged to the entity. Basically, when you do a practical question, you'll be able to understand this very well. But here we are saying the grant is recognized in the income statement over a relevant period that the entity will be incurring the related costs. We treat it as a deferred income, and we recognize a portion as the way we recognize the related expenses. The reason is very simple: to offset those expenses. And we are going to be seeing how to do that. Then the second way is the easiest, to just reduce the grant from the carrying amount of the asset. Remember, they may give it to you, they may not give you a new asset. They give you an asset which has been somewhere. So you get the carrying amount, not the cost, the carrying amount, and you reduce the what? The grant you've received, and then you compute the depreciation. You compute the depreciation on a reduced value, because after getting the grant, if let's say the carrying amount of the asset that was given to you at the time when it was given to you, let's say it was 10 million, but you were given a grant, let's say you may be even given a grant which is more than the value of the asset. But if let's say you are given a grant of, let's say, 8 million, you less those 8 million first, then the 2 million that remains there is where you will compute the depreciation. I will show you how to reconcile these, the 1 and 2. You'll be able to see how you can reconcile everything, and you see that it will give out the same result. The figures may be different, but the result will be the same. So we can look at, I think we have a question. Let's look at the presentation of the grant that is related to the income. Presentation of the grant that is related to the income is that here we are recognizing income. It is income coming in. The grant is coming as an income, not as an asset. We are saying that we present as a separate item in the income statement under other incomes. We put it because we recognize them as income using the income approach. We recognize them as income and we put them in the. But there is also a scenario whereby there are some expenditure that we have incurred on that asset. Sorry, on the income we have received. We have got the income, but we had incurred certain expenses. Then you less those expenses and you take that value or the net value. We have a note here. It says when a grant is received to meet past costs, the grant income will be recognized in the profit and loss immediately. When you receive, because we say the grant may come to offset the activities which you have already constructed. If let's say they are saying you had constructed this asset, but the government comes and gives you support after you have already constructed, then when that money comes, just put them in the income statement, because it is just to compensate the expenses you have incurred. And we are saying when the grant is received to compensate costs incurred in the current or future periods, then the grant will be recorded in the profit and loss in the same period as the costs are incurred. This is what I've been explained, that if the costs, if it is given now, you treat it as a deferred income and you be receiving it annually or in the period you are incurring the related expenses. We have a trial number. It is August 2016, question 4B. Can try to maybe to look at it, or we can look at it in I think next time we do it and make sure we'll be able to get everything right. That's basically what we are going to be looking at. We shall look at this question and we shall be able to understand some of how those concepts are going to be handled. The next one will be intangible assets. That's what I told you, that the non-current assets, there are many and they are treated using different standards. So when we link up on the next video, we are going to be talking about that after doing these computations, and we'll be able to understand something. Thank you for watching. Please subscribe to the channel, share, comment, and like our videos. You can also advise if there is something you need to say in our comment section, and we'll be able to respond to you very fast. Thank you.
Good evening to everyone. This is your tutor Charles again, and today we are going to start our series on a new standard. Last time we did a theoretical aspect, and today we are starting the computation bit of it, and you want to use this question that has been gotten from past paper That is August 2018. And we are going to look at the new standard as we discussed earlier, that we are going to be starting with IS 20, that is accounting for government grants and disclosure of government assistance. As a precursor of what we did last time, in the theoretical aspect, we tried to explain some of the terminologies that have been used in the standard in terms of the government grant, government assistance. We also define the government, but as a precursor, we may also try to get something, especially for those who were unable to understand this from the first video, so you can be able to add something in extra. What we discussed last time was basically trying to look at the government, and in this sense we said that the government is not only the government, the parastatal we know, or the state we know, but it may be a local authority, may be an international organization, it might be a donor agency, it may be any organization that can provide a grant or can provide assistance to the organization. And that assistance should also be able to help the organization go somewhere. And that assistance may be in form of cash, in the form of transfer of resources, and these resources they may be financial resources, or they are going to be as maybe policies that are going to help the organization grow. So that's basically what we try to look at here. And when we try to look at the government grant, we tried to look at it as an assistance by the government in the form of transfer of resources to an entity in return for past or future compliance with the conditions relating to the operating activities of an entity. Here, basically, what we have to emphasize in this definition was the transfer of resources. If something is going to be a grant, it means we are going to be looking at what we can get in terms of the resources that are going to be transferred from the government, as we discussed it, and we try to look at, if at all those guys are going to give us those grants, then what are the conditions that are going to be attached to those grants? Of course, when we know these conditions that are going to be attached, it affects our operations in one way or the other. In terms of, because these conditions, they may be in terms of how we are going to be operating, how employees are going to be employed, how, depending on the reason why someone is going to give you a grant. Because if conditions they are there, that gives us a basis of whether we are going to accept the grant or we are going to reject it. Because one of the recognition criteria is that we recognize this grant actually when the organization can accept the conditions that attach to that grant, and it can also receive the grant itself, because there are so many organizations that promise mainly financial assistance, and you find that they cannot deliver their promises. So for us to recognize that we have a grant, we must at least be having, maybe we have a binding contract, or we have actually received the products already, or the money is already in our accounts, if at all it's going to be in monetary terms. So that's basically what I can talk about as far as the government grants are concerned. And the other one is government assistance. Government assistance, for it helps the organization, it brings a benefit to the organization. But in this time around, it's not going to be in terms of transferring resources to the organization. It may be because the government, you may find that the government is going to be having different projects for its country or for its people. And you find that they are going to be having different ideas that are going to be helping the organizations within the country to grow. So some of them, they're not going to be directly transferring resources to the organization, but in the return, they are going to help the organization benefit or grow. So those are the things. And basically, since this government assistance, they are not involving transfer of resources to an entity, that's why we are just disclosing them in our notes to financial statements. Then these government grants, for them, since they involve transfer of physical resources, then it means we have to account for them. And the reason why we are accounting for them is that we don't want, because if someone gives you a grant, it's like a boost. You use it within the organization to make sure that you at least boost your profitability or boost what your aims are. So if they have given us those grants, the reason why we account for them is that we want to show what we are doing, and we see that we are not going to be having a higher profit which came as a result of employing the grants they gave to us. So it serves as a solution or a remedy to these unclear computations of how these profits are going to be arising as far as the grants we got are concerned. So that's basically what I can give you. If at all you've not understood, you can try to rewatch the video, or you can go back to our first video where we did a thorough analysis of all the theoretical aspects that someone could need for that person to be able to pass this examination of financial reporting. So having understood those ones, today it's not going to be a theoretical aspect. We are going to pick a practical question, and we chose August 2016, and we are going to be doing question 4, part B. So the question is already displayed. Screen, let's try to look at for that number 4. Okay, we've seen the question. Let's try to go through into this question together and see what we can be able to get from the question. I said my approach to these questions, we first of all go through the question together, we try to analyze, and then we give a solution. So with that approach, I'm very convinced that everyone is going to be able to learn and they'll be able to understand these computations, because we first explain to these people before we actually give the solutions to those questions. Okay. As we said, this is August 2016, question 4, part B. My emphasis is on part B, but I want to give you something that when we are doing this financial reporting, it's more or less trying to test the level of competence. So we are trying to look at some of the things, the key terms. We try to understand these key terms. So when you're reading, don't ignore some of these definitions all the key terminologies that are within different standards because they are examinable. When you try to look at the question 4, part A, it says IS 20, that is accounting for government grants and disclosure of government assistance, was formulated to remedy or to solve instances where entities would increase their profit or their profits using the grant received without disclosure. Actually, this is basically what I've been explaining. I said, if at all these grants we are not accounting for them, we could have a challenge whereby the organization will earn more profit as a result of employing the grants they have got. Since they have not paid for those grants, if let's say the grants were in terms of money, and they have received money, they have invested money in the business, and they have made more profits, you may find that they will earn more profits, but at the end of the day, they will not disclose how they were able to get that. So it was introduced so that we can reduce those instances where the organizations, they can report higher profits, but they are not disclosing the grants they have actually received. So that's basically what I was explaining. When you try to look at the required, they are saying distinguish between government grants and the government assistance as laid out in IS 16. One of the key items you have to understand whenever you are trying to define some of these key terms is that when someone says according to the standard, please make sure you try to at least bring what the standard says than what you think it means, because some words have different meanings, and if you don't bring actually what the standard says about it, you may end up losing it. So for that part one, I know I've answered it when I did my precursor of what we actually covered. But if you have not got it right, you may try to watch our first video on IS 20. You will be able to understand each and everything, because there we explained so many terminologies that are used within different standards. So my emphasis for today was on part B, which says that ABC Limited, a company operating in the agribusiness sector, acquired equipment for shillings 96 million, paying by check on 1st October 2015. This company, ABC Limited, bought an equipment for 96 million and it paid by bank or by check on 1st October 2015. And they are saying that and received a government grant of 19.2 million towards the cost of the equipment. What happened was the government tried to help or to give a subsidy to this person by giving the company a grant of 19.2 million to offset at least the 96 million they spent when they were acquiring that equipment. They are continuing to say that the company's policy is to treat grant as deferred income. Treating the grant as deferred income, those are some of the approaches or the schools of thoughts of how certain things are going to be handled as far as accounting for government grants and disclosure of government assistance is concerned. One of them is treating the grant as a deferred income. Then the other one is reducing the cost of reducing the grant from the cost of the asset. Those are the two approaches we have whenever we are trying to look at how we can account for a grant that is related to assets. So basically, if you want to understand more about the grants that are related to the assets, make sure you watch the first video on IS 16. That is the theoretical aspect where we explained all that and why we are bringing this on board. So having understood that the policy they use or the approach they used is a deferred, treating the grant as a deferred income, they are continuing to say that the useful life of the equipment is 10 years. Whenever you hear about a question talking about the useful life, and it is talking about an equipment or an asset, it means they are trying to give you more lights that you need to calculate the depreciation and other expenses that are related to the assets. So they are continuing to say that the company time apportions depreciation where applicable. There is a time apportionment. I hope you know what time apportionment means. It's a kind of looking at the timing of when the asset was acquired, and you try to look at the date you are reporting. Because if the asset was acquired during the period, not at the start of the period, it means you can't give the whole depreciation for the whole year and you give it to that asset. You must look at the depreciation from the time the asset was acquired. Like for this instance, we are seeing that the asset was acquired on 1st October 2015. So our question is going to be, when are we going to be reporting? After understanding when we are reporting, then we can be able to know how we are going to be time apportioning this equipment. If we may try to look at what they want, when you try to look at this question, it says it is talking about 31st December 2015. It means if the asset was bought on 1st October 2015 and we are reporting as at 31st December 2015, it means this asset wasn't there for the full year. It was there for some months. Actually, that's what they are trying to give you a hint on what you should be able to analyze from the question. So we try to look at the required. We said we are going to be handling part B. This part C is on a different topic, so we are going to be looking for this on this part B, where we can be able to answer these three Romans that are here. The required part B, Roman number 1, says show the Roman 1 accounting entries to record equipment and the receipt of government grant on 1st October 2015. This 1st October 2015, we saw it as the date when the asset was acquired. When we discussed in the first episode of this IS 20, we tried to look at how we treat these assets, the approaches we use, and we tried to look at that if at all you are given the grant, but this grant is in relation to the asset, we try to look at what are the things we are going to be looking for in terms of recognizing the grant and also the asset at the date when they are given out. So basically, when we try to look at this question, the Roman number 2 says accounting entries to record the depreciation of the equipment and the recognition of the incomes of the grant income as at 31st December 2015. Then the Roman number 3 says extracts for the statement of profit or loss and statement of financial position to indicate the disclosure for the assets and the grant upon acquiring the asset as at 31st December 2015. So this is what the question wants us to do. Then we can also try to analyze, because we've seen what the question wants us to do. So we try to analyze what we can do. One of the things I'm seeing from the question, we are seeing that the entity acquired an asset for 96 million, but in the due course, they received a grant of 19.2 to cover part of the cost of the equipment. That's what that first line says. And we are seeing that the company has a policy of treating the grant as a deferred income. But remember, we said that we have two approaches for accounting for grants that are related to assets. Either we are going to set up the grant as a deferred income, where we are going to be recognizing a portion of the income over the period of years in the future. Because now we are seeing that the asset has a useful life of 10 years. It means if you are going to be treating the grant as a deferred income, we are going to recognize each income that we are going to be receiving for every year. It's like we are going to spread the deferred income or the grant for 10 years, and we try to be receiving each portion that we are going to be using for every year. We'll be accounting for that grant. That's basically what that treating the grant as a deferred income. Deferred income is money that you've actually received it, but you have not yet earned it. It's both a current liability and a non-current liability, because a current liability comes in a sense that part of the money is going to be recovered in 1 year, and the other money is going to be recovered in the remaining years. That's why it is both a deferred, it's both a current and a non-current liability. It's a deferred income. It's money you've received, but you have not yet earned it. It's like unearned income. We've received it, but we have not yet earned it. You know, with the accrual concept, whenever we are the only possibilities where we are going to be recognizing the money or revenue is that when we've actually satisfied the performance obligation, or when we have actually delivered the goods and services. When we deliver these goods and services, whether we are paid or we are not paid, we recognize revenue. But we don't recognize revenue when we have not done, or when we have not performed the performance obligation. We have not delivered the goods and services to the customers. So this one is like you've received money, but you have not actually worked for it. So it's like it's a liability. They are still demanding you because you haven't offered the service for the money you have received. So that's one of the approach, and the other one was was to reduce the value of the grant from the value of the asset. But when we try to look into this question, they have specified what they want us to be using, where we are going to be treating the grant as a deferred income. So if you are going to be using this, it means we are going to be recognizing a portion of the grant income each year, whereby we are going to be spreading the grant over the estimated useful life of asset. Because to give you some kind of how this deferred income works, it's like in a non-profit making organization. I know everyone did financial accounting and you did non-profit making organizations, and it's like when those guys are paying for these members of those companies are paying for their life subscriptions, whereby in those cases you try to recognize the money. You are not going to recognize the whole amount, because when it is a subscription, if it is a 5-year subscription, someone pays a lump sum amount of money for the whole 5 years. But when you are recognizing them in the books, you recognize each year. You are not going to recognize all of it because part of it is not yet actually, and so that's basically what I can highlight on that. Because if you try to look at even the question, we are seeing that the asset had a useful life of 10 years. In the question here, the asset had the equipment has a useful life of 10 years. And if you're trying to look at that, it means if the asset is going to be there for 10 years and they are saying the depreciation is time apportioned, it means we are going to be using the cost, because we have the cost of the equipment and we have the useful life. So we can use that information to get the depreciation charge for the year. But this means that we are going to look at we get the cost over the useful life to get the depreciation, but we try to time apportion it from the time the asset was acquired to the time we are reporting. And in that same sense, or in that same way, we are going to be doing that, or in the same way we are going to be computing the depreciation expense, is the same way we are going to be recognizing the grant income for each year. We recognize the grant income as its related expenditure, and these related expenditure in this term, since they are depreciable assets, it's going to be the depreciation. If the asset was a non-depreciable, that one I'll give you a highlight on how you can go about it if the asset is at all a non-depreciable one. Because a non-depreciable asset like land, it doesn't have a limited useful life, meaning even if they have given you the grant as land, they have given you land as a grant, it means you can't depreciate that because we don't know its useful life. So basically, what we are trying to do here in this treating the grant as a deferred income is like we are trying to match the revenue we are going to be receiving every year, and we match it with the expenses or the related expenses in terms of the grant for the same year. So that's how we are going to be treating that. And that's basically the analysis I can give you for now. Let's go into the Excel and try to see what we can do and be able to increase our understanding. Maybe you can try to zoom in a little bit. So from there, we can be able to see all the figures very well. So we can now go to our question. I try to put it here. It is the same. I just copied it from there and I pasted it here so that you can be able to have a reference. So we try to look at this part one. Part one was saying show the accounting entries to record the equipment and the receipt of the government grant. Here there are two things. One is how are we going to be recording the equipment, and the second one, how are we going to be recording the grant, the government grant that we received as at the beginning. We are saying that these are just the accounting entries as at 31st December, sorry, October 2015. That's when the asset was acquired. So if it's when they have actually acquired the asset, because it is that same date when they acquired the asset. And in the first paragraph here, they are saying that the company acquired equipment for 96 million paying by check. It means that since they have actually paid out the money they had on their accounts, what we are going to be doing is that since the money was spent out and we've actually received the equipment, it means our assets are going to be increasing in value as our cash is reducing, because we are using the money in the bank to offset. So what we are going to be doing is that we are going to debit the equipment and we credit our bank because money is moving out. That's actually the double entry. These ones we are going to write them at a later date because these are just the level one work. Then maybe the receipt of the government grant. This government grant, since they are saying that we actually received a government grant of 19.2 million, what is the cost of the equipment? It means here we have two scenarios. If at all this question they had not given us the policy or the approach the company is using, if the question was silent, we could either do this one, we could take it as a deferred, or we could go the other way of reducing the grant from the value of the asset, so that we calculate the depreciation on a reduced figure. But here, since they have specified, so it means what we are going to we are just going to recognize the money we've received. And how are we going to be getting that? Is that the money is coming in, 19.2 is coming into our bank account. So what is going to happen is that we are going to be receiving cash into our bank. So what we are going to do is we are debiting our bank account by that money we received, the 19.2 million, and we credit our deferred grant income. And the reason why we are calling it the deferred grant income, why we are crediting it is that this is the lump sum money we've received, but we have not actually worked for it. So it's going to be a non-current, both the non-current and the current liability, as I'm going to explain that when we are doing the extracts. It's a non-current but I know in level 1 you used to take it as a non-current asset, but for now we are going to get a very nice way how we can treat that. So that's basically what we recognize. We debit our bank since money is coming in, and we credit our deferred grant income. Okay, having understood that, then let's try to look at the part B, because that was what they wanted. Those were 2 marks. Then we try to look at the Roman number 2 says accounting entries to record the depreciation of the equipment and recognition of grant income as at 31st December 2015. The other 1st October 2015 was at the initial recognition, when you have just received the money. But this one, now we are looking at the reporting date, or at the end of the year, which figures are we going to be getting. So this needs some computations, and we are going to see which figures are we going to be put into our accounting entries as they're asking. But before you think of passing any accounting entry, we need to know the depreciation for the year first, because depreciation was time apportioned. So we need to first calculate the depreciation, and we see what we can do. So let's try to go to our solutions. Maybe we may start with our Roman 1. And we said our Roman 1 is going to be on Roman 1 is on we try to put the Roman 1, and because we said we are going to be debiting our equipment, we are going to be debiting our equipment with 96 million. Then we credit our bank, bank account with 96 million. That was the first one. And the other one was, this was to recognize the asset. So now let's try to recognize the grant income. For the grant income, we are going to be debiting our bank account with the 19.2 million which we received, and then we credit our deferred grant income account with 19.2 million. That's basically what we were supposed to do for Roman 1. So we'll try to look at Roman 2. Roman 2, we needed to first know the depreciation. The depreciation for the year. The depreciation for the year and we have the cost, so we can use the information we have. We have the cost of 96 million. Then the second thing we have the useful life. The useful life was for 10 years. So we can get the depreciation. Of course, we know it that the depreciation, permit me to use that. The depreciation is going to be our cost over, because we don't have the scrap value. It would have been cost minus scrap value over the useful life. So here we are just going to use the useful life, which will give us a figure of 96 million divided by 10 years. This will give us 9.6 million. So this will give us 9.6. This will give us 9.6 million. But remember, we had time apportionment. The asset was acquired on 1st October 2015. So from 1st October 2015 to 31st, that's when we are reporting December 2015. We count we count October because it was at the start. October, November, then December. Those are 3 months, meaning this one has a period of 3 months. So since it is 3 months, this is equating to 3 months. 3 months. So we are going to be getting this 96, this 9.6 million. We multiply by 3 months over 12. So that we'll be able to get 2.4 million, meaning the depreciation for those 3 months or for that year, because the asset was there in the year of 2015, it was there for only 3 months. So the depreciation for that year is going to be 2.4 million. The same way we've done the depreciation is the same way we are going to be handling the grant income, because we are recognizing them as deferred income. So the same way we did depreciation is the same way we are going to be calculating the deferred income. So let's try to look at the grant income. Now here we are looking at the grant income we are going to be using for that year, or we are going to be recognizing, or we are going to be taking to our financials in that year 2015. Grant income be recognized for the year. So we are going also to take the same amount, which was 19.2, which is the value of the grant. We divide by the useful life, which is 10 years. And the answer we get we are going to multiply it by 3 over 12. That's what we call treating the grant as the way we've treated its related expense, and this will give us 0.48 million or 400,000. That 400,000 is the money that we are going to be recognizing, or that we are going to be removing from the 19.2 million we received, and that 0.48 million is going to be the money that we are going to recognize for the year ended 31st December 2015. So now what are we going to be recording as our double entries? Because this one, the depreciation expense, is the one we are going to be taking to the profit and loss account. So here, the double entry for the depreciation is going to be, we are debiting the depreciation expense, we are debiting the depreciation by 2.4 million, and here we are going to be crediting our accumulated depreciation. $2.4 million, and that's what is going to be the double entry for that. Then for this one, for the grant income, since here we are going to be, this is now the money that we have actually earned. We've now earned 0.48 million out of the 19.2 million that was given to us as a grant. So we try now to look at what we are going to be using as our double entries. Since now this money is now realized, or we've actually worked for it, we are now going to recognize it in our profit and loss. How are we going to be recognizing the profit and loss? We are going to debit the deferred income the deferred grant income by 0.48 million or 400,000. Then we'll credit our profit or loss account. Permit me to use P/L, profit and loss account, by that figure. Actually, it is going to be coming in terms of other incomes, because now this money actually earned it. Other incomes of 0.48 million. So that's basically what they wanted us to do in that Roman number 2. So from here, basically what we've been doing is that we've been recognizing the grant income as its related costs or expenses. But now we want to look at a situation whereby the item we have, or the asset we have, is not a depreciable asset, because this was a depreciable asset and we used its related expense as depreciation. But what happens, or what if the government gives us land which can't be subjected to depreciation because we don't have its useful life? What are we going to be doing in that scenario? So that's basically what we are going to be. Maybe you can put a note here that what happens, this is a note, And the note says, what if the grant is in form of non-depreciable asset like land? What do we do? And this, we are saying that we are going to be recognizing all the grant income at once. We recognize all of it in the profit and loss, because we don't spread that grant income over its useful life, because we don't know the useful life of land, since land has unlimited useful life. So what we did upwards here, it was basically, we tried to look at the portion for the year, and we are getting that portion of the grant income by spreading the grant over the useful life of 10 years. But still, after considering that, or after spreading that grant over the useful life, we tried to recognize it in the same way we recognize the related expense, by taking into consideration the timing, or by time apportioning the grant also in the same way we time apportion the depreciation as the related expense. So that's basically what we were supposed to do. And I've given you a scenario whereby we have a grant that is going to be related to land that is not depreciable. We are saying that the grant income will be entirely recorded as an income in the profit. Let me use P/L, profit and loss account. The profit and loss account, since it doesn't have a limited useful life that we can divide it with, That's basically what we do. And the double entry here will be, we will be just debiting, maybe we call it land, debit it with any figure there, then we credit profit or loss with that whole figure of income. So that's basically what we should be doing. So that's basically what they wanted in that Roman 2. So we try to look at the extracts. These extracts, they are very easy because you don't need to draw everything. We need just a few things. And let's try to go down here. You try to do now the extracts. Here we are going to be looking at the extracts. Remember the extracts, we said they are going to be either statement of profit or loss, then for the year ended 31st December 2015. This is statement of profit or loss and other comprehensive income. Then we can start with our other income. Of course, we started that with that portion of other income because this comes after you've got the gross profit. We are going to put in a grant income. Grant income. And we recognized only 0.48 million. Then we go to the expenses. And we put the depreciation for the year. This is depreciation. Depreciation for the year was 2.4 from the first working we did. That's basically what we are required to do as far as the extract of statement of profit and loss is concerned. So we try now to do the extract for the balance sheet. Now let's do the extracts. Now here, instead of stating the profit and loss, we are going to put statement of financial position. Statement of financial position for the year ended that. So we start with our non-current assets. Non-current assets, of course, we recorded that asset we have. And we are starting with the equipment. It had a value. Of course, we have to adjust with the depreciation. The cost was 96 million. We less the depreciation charge for the year, which was 2.4 million. That's the accumulated depreciation for that year. And we get a figure of 93.6 million. Then we try to go to the other non-current assets. The non-current liabilities. Let me put a space and I put also the current liabilities. There's something I want to explain here. Current liabilities. All of it, we are going to be having the deferred income. Deferred grant income. And even this one is a deferred grant income. In level 1, you could just put it at once and you mix it. But for level 2, let's try to have the competence, or we show the competence that is needed, that we at least have ideas of what we are supposed to be doing. So this is what I want you guys to understand. We say that this deferred income will be both a current and long-term asset. Sorry, long-term liability. Since one portion is going to be realized or is going to be received in 1 year's time. Remember, we said current liabilities, those are the ones that are not going to stay for more than 1 year. So in the next year's time, that is 2016, we are going to recognize another portion from, because our grant income, actually, let me put here as a working. So we had our grant income, the total grant income that we had, the grant income was 19.2 million. But we realized, or the recognized grant income was 0.48 million. That's what we got from that year. It means if we try to less off these figures, you will find that we are going to be having the remaining grant income. The remaining grant income is going to be the remaining grant income is going to be 18.72 million. This is what is going to be remaining starting from 2015. Actually, from 2016, January 2016 onwards, we are going to be receiving from this 18.7, because this one we have already recovered it in that year of 2015. So this is what is remaining. What this means is that this money, 18.72 million, it has money for 2016, and 2016 is 1 year. So that money that you are going to be receiving in 1 year's time is going to be a current liability, because current liabilities, we say those are the ones that are going to be there for only 1 year. So for these current liabilities, current liability we computed it in a sense that we are going to be getting the, of course, it is money for only 1 year. If it is money for only 1 year, the total grant was 19.2 million. So when you divide that by 10, that is the useful life of the asset, it will give you 1.92 million. And this 1.92 million is the grant that we are going to be receiving every year. It is just that the year of 2015, we did not receive the whole of it, because the grant was used from 1st October 2015 up to, it was used for only 3 months. But if it was used for the whole year, it was supposed to be this amount, 1.92 million. So it means the one for 2016 is going to be the whole of this. So the one that is going to be long term, the one that is going to be long term, it's what is remaining. This is what is remaining, 19.75. It's 18.75 million that is remaining. We less the amount for that 1 year, 1.92 million. This 1.92 million is the money for 2016, for the whole year of 2016. So the money we are going to be left with is the money that is going to be there for the remaining years up to the 10 years we have. But every year we are going to be receiving 1.92. So that's basically what we are supposed. And when you get the difference, it is 16.8 million. And this 16.8 million is going to be our long-term. This one is going to be our long-term liability. Then this 1.9, it will be our current liability. So when you add this plus this, you must be getting the remaining of 18.72 million after realizing the 0.48. That's basically what I was trying to explain from here. So here we just take the working, we just put our 16.8 million. Then this one is going to be our 1.92 million that we are going to be receiving next year in 2016. And that's it. That's basically what they wanted us to do on this number, and you get all the marks. So I hope you can be able to analyze all that and be able to understand, because some of the things, they are very easy, but they are complicated in a sense that if you have not understood them, try to rewatch these videos and be able to understand this concept, because that's how you are supposed to do it whenever they say we are treating the grant as deferred income. Can try to put in, the question was August 2016. It was question 4. My emphasis was part B. So that's what the question wanted us to do, but maybe to give you a highlight on what you should have done if at all they were not using, or they were not treating the grant as deferred income. If they were not doing so, that one is very easy. Actually, it is one of the easiest to do. Maybe you can put another note here. We say note, and we say that if the grant was not treated as a deferred income, how it would have gone very easy for us, because we said we have two approaches. If they are not using the deferred, treating the grant as a deferred income, then we are supposed to just deduct, or we reduce the grant from the cost of the asset, and we calculate the depreciation on a reduced figure, and we are done. That's what I'm going to do only. We just say the cost of the asset, or the equipment. The equipment was 96 million. So we less the grant income we received. We less the grant income. Actually, we received 19.2 million. So when you try to less that, you remain with, then this is going to be the net asset. Net asset is going to be 76.8 million. So now if you want to get the depreciation for the year, so get the depreciation for the year. Depreciation for the year, you will just get they had given us the useful life of course of the asset. The useful life was 10 years. So we could get this 7.68 million. We divide by 10. Then the answer we get, we time apportion it because it was supposed to be time apportioned. We multiply this by 3/12. And we could get a 1.92 million as the depreciation. So that was going to be our depreciation expense. And you are done. You get the carrying amount. Of course, the carrying amount, you could get this 78 million. You could get this 78 million, you less this, and that figures what you will be taking to the balance sheet, and it will be done just like that. So it was very easy, very easy. You could just only take, for the experts, you could just take this depreciation in the income statement, then you take the carrying amount. Because the carrying amount would be this minus this, and you are done. Very easy. So that's basically what we were supposed to do for today. And if you have not understood, make sure you try to rewatch these videos and be able to understand some of the things. Maybe the other one you can get a trial number of March 2022. That is question 2A. And another question you may try August 2017. It has some kind of when we've received the grant to cater for assets that are in the future. Sorry, for the expenses that we are going to be incurring in the future. And they are very easy because when you receive a grant to handle costs that you incurred in the past, you just recognize it, you recognize the grant as income in the profit and loss, and it will be done. If the costs are going to be incurred in the future, we only recognize them when we've actually incurred the costs. If you receive the money but you have not yet incurred those costs, then you wait until you incur the costs and you start recognizing the grant income. And that's it. That will be the end of that IS 20, and you will be able to tackle any number without any fail. So that's for today. The next video is going to be IS 38, intangible asset, and we try to look at what are some of the questions, what are some of the challenges we may face, and how best can we do that number, because it's also a kind of tricky number depending on the scenarios they bring as far as the question settings are concerned. But just subscribe, share to others so that they can have a benefit, and make sure you hit the notification button so that you'll be able to get notified whenever I upload a new video, because this is something that is going to help everyone understand accounting without taking more time or without incurring more costs. Thank you. It's bye for now.
Good afternoon, viewers. This is CPA ACCA, and today we are resuming our series on financial reporting, and we have a very short standard that is in relation to the non-current assets we've been seeing. In the last two videos we've been looking at the tangible assets, but now it's our turn to look at how the intangible assets are going to be treated as far as the standards are concerned. We said that these intangible assets are accounted for under IAS 38, that is intangible assets. And basically, when you're talking about intangible assets, I told you when you're talking about the non-current assets, we make sure we first know what is the nature of the asset. If it is tangible or intangible, that is as far as the nature is concerned. So this one falls into that category of the nature, not the purpose, because we said when you're looking at non-current assets, make sure you consider the nature and the purpose. But here we are talking about the nature. It's in that first category of the tangible and the intangible. So these are intangible assets. Basically, these are non-monetary assets. In other words, these are assets which doesn't have any physical form. You can't they can neither be nearly cash or converted to cash, and they can not be even you can't feel them when you can't feel their existence. That's basically what I can say in the layman's understanding. But the standard gives us a scope of what is supposed to be included in the non-tangible or the intangible assets. And basically, when you try to look at what are some of the examples that we may be giving as far as when someone says I'm talking about the intangible assets or non-tangible ones. One, we may be having goodwill. That's one of the tangible assets, the intangible assets, because goodwill, it's what the public sees, and it has a value that is attached on that. So if let's say you are selling off your company and someone says they want to buy you off, you find that when they are paying, they may value the assets you have in the organization, and they end up paying more than the value of the asset, meaning the excess will be the value for the goodwill. But that one, I'm not here to talk about only goodwill. I'm just giving you a clear, at least you get something. The other one we can talk about is a patent right, copyright, and all that. Those are just the restrictions that someone can hold a certain brand for a certain period of time and is restricting others to engage in that very same business. So they are also beneficial to the company in the sense that you are out competing, because you remain there, you remain as a monopoly in the market. You know the advantages of being a monopoly in the market. So the other one we can talk about, these companies which are selling antiviruses. Antivirus is an intangible asset. The other one we can talk about, there are so many intangible assets in the music industry. The labels, the rights to a musician. There are so many things. Even in the football, because I will not talk about much. I will not talk about much about the music industry because I'm not familiar with it, but we can talk about the football. Even football has a certain component of intangible asset. We are not, when you're talking about football players, we are not accounting for physical human beings into our financials, but here we are talking about the right of the player. That right over the player, it's, we can take an example. You may find that a certain club is buying a certain player at a certain cost. Let's say 100 million. Let's say Pogba, because I hear they was bought for 100 million. But when that person comes, he signs a contract. That contract has a useful life. Let's say 4 years, 10 years, depending on which agreement they made. So you find that the club which is buying that player, actually the club has a right to even refuse a player to go and play for these international games, because they have a right over that player over that period of time they are supposed to be with the player, as far as the contract is concerned. Meaning, when we are accounting in our books, we account for the right over the player, the right we have over the player. And that amount we have got, we make sure we amortize. This way, we are not depreciating, but here we are amortizing. We spread that contractual amount over the useful life, so that we can be able to get what we can be having for recording in our books, because we make all those recordings in the books for an annual, we make them annually, so we amortize them over the useful life. So when you're talking about these intangible assets, there are certain things you should also understand before even we proceed with the notes you are seeing, is that there are some intangible assets which are there, but they cannot be part of or they can't be accounted for under this standard. The standard has a scope of where it's supposed to end. We are saying when you're talking about the intangible asset, definition-wise, it is an unidentifiable non-monetary asset without a physical form. Actually, the three words which are more important, it is: 1, the asset must be unidentifiable. 2, it must be a non-monetary asset. 3, it shouldn't be having a physical form like these other buildings and all the other tangible assets. So when you're talking about the unidentifiable asset, we are talking about it in the sense that that asset can be sold separately, or it can be rented out separately, or it can function on its own. So if an asset cannot be separated from the other processes, then we can't, even if it is an intangible asset, we can't account for it under this standard. Secondly, it must be a non-monetary. It shouldn't be like a cash or a monetary asset or something nearly related to the monetary attachments. So when you're talking about these items being able to, you can be able to rent them out separately, or they are standalone, they can function on their own. Then we are talking about the items. I can give you an example. If, let's say, someone buys a computer, that computer cannot function without this operating system, the Windows and whatever. They can't function. So even if Windows, they are intangible assets, we can't treat them Like we can't bring them here and we try to account for them under this standard, because those windows, they can't operate on them on their own. Even the computer can't function. The hardware components, they can't function without those operating systems, those windows. So even if the windows are intangible assets, we can't account for them under this standard. But we can account for these accounting packages, because for them, you can sell them on their own, like QuickBooks, Tally, because you're seeing Intuit is saying those QuickBooks very expensively, and people are buying because they can function on their own. When the thing is installed, it can function and helps you do everything. If these, they are antiviruses, they can perform on their own. They don't need any supplement that you do what you do. As long as you are put where they are supposed, they can function on their own, which is not the same with Windows. So when you are talking about this standard, make sure at least you get the concept that even when the examiners are giving these questions, they base on those scenarios. They can bring something, but what you have to first know is that, is it identifiable? Is it a non-monetary asset? Does it have a physical form? Those are the first conditions before even you look at the recognition criteria. How are we going to be recognizing them in the books? But you first identify, really, to first confirm whether they are really intangible assets and they are accounted for under this standard. Because as we've seen, you may find that even these assets, there are other assets which are non-monetary, but they are not accounted within this standard. Like the shares, they are non-monetary assets, but they are accounted for under IFRS 9. That's financial instruments. Those are financial instruments. So you have to be careful when you're analyzing questions that are related to the intangible assets. It is a very short standard, but it's a bit complicated because most of the times they bring scenarios, they bring scenario questions, and you'll be able to interpret basing on what the standard says. We can try to look at, having understood the definition, what we are supposed to incorporate in, then we see how are we going to incorporate those intangible assets in our books. And we are saying, one, those assets, intangible assets are recognized when, one, the entity controls the asset. If the entity can be able to control the asset, or it has a legal right or a contractual right over that asset, then we say it can be recognized as an intangible asset. Secondly, we can talk about assets being identifiable. We said that one, assets can be sold or rented out separately, or they are standalone items. They can function on their own. Thirdly, the assets have a value that can be measured reliably, because basically these two answers, the assets has a value that can be measured reliably, and it's probable that future economic benefits from the asset will flow to the entity. Those basically two recognition criteria, they are everywhere so long as we are talking about assets, those especially non-current assets. Most of the times they are there. You can determine the value of the asset. Then, if you are sure that they will bring economic benefits, we say the probable it's above 15%, 50%. The probability of the asset bringing the economic benefits to the entity. Then we look at, if you have recognized that yes, they are intangible assets, what values are we going to attach in the financials? These intangible assets, we can measure them at cost, That is initial measurement when you have just acquired them. When you acquire assets, that value, purchase price, and other direct costs that are associated with the asset are supposed to be included in determination of the cost. That is the initial measurement. Initially, they are measured at cost. Then subsequently, that's at the reporting date, we have two methods. One is using the cost model, and the other one using the cost model, and the other one is the revaluation model. We said the revaluation model is more or less of the estimated market price. So when you're talking about the cost model, we are saying the intangible assets are carried at cost less accumulated amortization. Here we are not talking about depreciation, but we are amortizing. And impairment losses. How do impairment come in? If someone may say, but how these intangible assets lose value? Yes, if let's say you see, let me talk about the football stuff. If you see now the way Pogba is playing, he was bought expensively, but if you compare how much Man United can get after selling Pogba, you find that it cannot realize what it put in there. They paid over 100 million, but I don't think now they can be able to get 100 million. That's a loss, because they bought the person expensively, but now when the person is not performing well to the expectations, even the other one, you can talk about even Lukaku at Chelsea. They bought that guy expensively, but right now he was even given on a free transfer. He was given to go back on transfer to Inter Milan. So basically, you look at the things that someone can lose value even though something is intangible. Yeah, you see the amount you have acquired, and you see what you can actually get from the market. So that's what we call impairment losses. We are going to look at what are some of the indicators in the next slide. Maybe just talking about briefly, but I never wanted to talk about much impairment losses, because impairment has a standard that regulates it. So we are going to look at that later, but we can proceed to the next one, which is the revaluation model. And we are saying assets are carried at revalued amount less any subsequent accumulated amortization and impairment losses. Those, as I have already explained, this revalued amount is when you do if let's say you can now try to revalue how much Pogba can be sold to any club, you find that the amount you are going to get after selling him, you find that it's not going to be the same, even though you had amortized him by getting the 100 million you had paid, and you divide the useful life over the contract, but you may find that it's not worth what they purchased. That's basically what we can say about it. But more to talk about in this is that what we can only say is that there are certain items of intangible assets that cannot be amortized, or that like if you don't know the useful life of that asset, you can't really know how much to spread the cost, what will be the useful life, so that you can be able to spread the cost. But what we will only do, we test for impairment losses annually. That's basically what we can do. So we can go to the next slide, and we'll try to look at what are some of the things that may lead to someone to lose the value or to do the impairment. We have the indicators of impairment, but this one we shall talk about more of them when we go to the other side of impairment losses, when you are dealing with that standard. We have the external, and these are examinable, so that's why I was forced to put them here, but the time we reach the other side, because we've been talking about impairment. So these are some of the indicators. We have the external sources and the internal sources. We can start with the external sources. We are saying that a significant decline in the asset's market value more than the expected by normal use or passage of time. If let's say you've been with an asset for which had a useful life of 10 years, but now you have removed for, let's say, for 2 years, and you bought that asset, let's say 20 million, but as per now, after 2 years time, you find that they are giving you only 15 million. More or less that you have amortized that asset over the 2 years, but you may find that you are not fetching exactly what you should have gotten from there. That's one of the indicator that the asset has actually lost its value, or there is an impairment. Secondly, a significant adverse change in the technology. Technology may also lead technology, economic and legal environment. It happens if you are seeing if it is more or less in terms of the technology. You may find that if you talk about these computers, we had the Pentiums, we had the i3, iCore 3, i5, now we are on i7, and others are using different. So that advancement in the technology, or the changes that occur in the technology, may lead to an asset to lose value, because if you are to sell a Pentium or iCore 3 laptop today, you can't fetch the same amount that you would have gotten in that period when they were still using those iCore 3. So basically that's what we are talking about. That's one of the indicators that at least the asset has lost value, even if it is still functioning the way it was functioning, even if it is still new. But so long as the software or the system is still on the other old version, people will try to lower the value of the asset. Then we can talk about the internal sources. We have the physical damage or obsolescence. You may find that the asset, it has been there, and the asset, it cannot even function to the expectations. And if you say, what, even if you bought it expensively, but this one can no longer support what we want, but let's reduce its value and we sell it off. The other one, we can talk about the significant change, and this happens in periods or expected in the way that the asset is being used. Assets become idle. Of course, when time goes on, you find that the assets you've been using, you are no longer using them. You just leave them there and you acquire more. If let's say you have an i3 laptop now, and yes, because of the work you were doing, you are unable to use that i3 and you've put it somewhere, you are now using i5 or i7, you may find that the other one, you will be forced to reduce the price and sell it off. Then we have evidence that the asset's economic performance will be worse than expected. If at all you don't expect the item to function well, then you rather sell it even if they give you cheap, but at least you dispose it off. Then loss of key employees. You may be having the let's say certain machines, and those machines you can't get people to operate them, or they are very sophisticated to the extent that even hiring those experts, it is too expensive. You rather sell it even if they give you less, but at least you go away with it, because at the end of the day you are not going to use it. You lack the experts. So those are some of the things we can look at, and we say that at least the asset is going to be impaired. So this is what we were talking about. We said assets with unlimited useful life. Of course, if something you don't know, like the reason why we don't depreciate land is because we don't have, we can't estimate the useful life of land. So there are also other intangible assets where you can't even know the useful life. Leave alone these other ways, the way, because there are other competitions how we do goodwill. But if the company has been in operation, if let's say you talk about Coca-Cola, you don't know how the name of the Coca-Cola can disappear. Leave alone the way that we have other ways of computing goodwills and all that. But if you look at it on using a layman's eye, you might find that it is very hard for sure to trace that the brand for Coca-Cola is going to disappear, or Pepsi, depending on what is prevailing in the market, because people are consuming. Then the last bit we can talk about as far as this standard is concerned is the research and development costs. We are saying that these research costs, when you are doing research, it is just a way of improving things, the way you've been doing things. You find new ways of doing things. If let's say you've been using labor intensive technology and you are now going to the modernized way, the capital intensive, you find that you have to incur certain cost of how are we going to advance from what we have been doing, and to find out whether that thing is going to be productive. So this standard permits that these research costs at whatever level, they should always be expensed. The reason why they are saying that these research costs should be expensed but not capitalized, even if the project you are working on becomes a success in the future, it's because these costs, they are like sunk costs. We already incurred them. They are already historical. We incurred them, and by the time we incurred those costs, we never knew that even this project is going to become a very successful one. So by all means, even if they treat they make the question look like anyhow that that we incurred these research costs, but at the end of the day the project became a success, don't be tempted to capitalize those costs. They are supposed to be expensed. The reason is very simple, is that those costs we incurred them not knowing that the project is going to be a successful one. So they are supposed to be expensed, because even if the project doesn't become successful, you had already incurred the costs. They are more or less like we have wasted. If let's say you look at these people who start up the companies, the one we call the promoters, they start those companies, but the costs they incurred before the registration of the company cannot pay those costs, because you can't be contracting for a company which is not even existing. That's the implication. That if let's say you incurred when you are forming up the company, and you want those costs which you incurred before even the existence of the company to be paid by the company, it's really not being serious, because you incurred those costs without even the company being incorporated already. So that's basically what I can highlight as far as IS 38 is concerned, intangible assets. If you want, you can look at there is a question that is August 2019. It was most actually all about a football player. They were giving you to players, and for them what they wanted is how you are going to account for the right over the player. As I said, we don't account for the player or for the human beings within the standard, but we account the right over the person, if it is a right over the musician and all that. Anyway, I urge you guys to subscribe for the channel so that we'll be able to learn more and more, because more things are coming and we are going to be doing numbers on each topic I finish. I want to be doing at least some good numbers on it. After understanding the concept, then we'll be able to catch up. Thank you. Good morning, members. This is CPA ACCA, and you are welcome to our channel where we present accounting related issues, and we'll be able to learn as we progress into our different careers at different levels of accounting. And today we are proceeding our series on financial reporting, and today basically we are going to look at IS 41, that is agriculture, for those who are engaged in farming, forestry, and all other assets that are incorporated within the standard. We are going to see how we be able to present, how we account, and which figures are we assigning to those assets that are covered within the scope. Today's standard is agriculture, and whenever we are talking about agriculture, there are certain things we are going to be talking about, and when a primary kid hears us talking about them, they may think that we went back for primary, because we are going to be talking about living things and all that. So when certain things are not defined, they are like defining what a living thing is, that one don't expect me to be teaching that. So this standard is basically concerning about the biological assets. Since they are assets, it takes us back to where we started by talking about our non-current assets. And we said one of the things you first know the nature of the asset. Secondly, you determine the purpose of the asset. So basically, you can copy some from there, and here we are basically looking at the nature, which is biological. And we are going to be seeing what are the sum of the assets, the biological assets that are covered within the scope of this standard. So those are some of the things we are going to be seeing. Then we see certain things which are out of the scope of the standard, or which are not covered by IS 41, that's agriculture. But here there are certain things which I want you guys to be familiar with, and maybe to start off with the scope of the standard, what the standard covers. It covers biological assets except bearer plants. We are going to be seeing all these in details, but maybe to give you a brief scenario is that biological assets, so long as they are not bearer plants, or the plants that can bear produce for more than one accounting period. I'll throw more lights about it so that you'll be able to know which are those ones. Then the other one is agricultural produce at the point of harvest. When you are talking about the agricultural produce at the point of harvest, we are meaning if basically, maybe to give you more on what are the biological assets, they are living plants and animals. That's basically what we are going to be talking about. So when they are saying agricultural produce at the point of harvest, it means those items or those plants or animals at the point when they are ready, let's say to be distributed, or to be, like for animals you may find like cows, if the animal reaches at a point where you're going to slaughter it, at that point we account it under agriculture, that is IS 41. But after slaughtering the animal, we no longer consider that as an asset that is part of the IS 41, because by the time you slaughter the animal, it means you are going to start selling meat. It will move from being an animal to inventory or stock, especially those meat pack and those people who are working in the meat pack. You know all the things that by the time you choose that this animal is ready to be slaughtered, at that point we say it is still under IS 41. We account for it from there. But at the point when you have slaughtered the animal, it means it has ceased to be accounted for under IS 41, and it will be accounted for under inventory, because at the end of the day, after slaughtering the cow, you are going to sell the meat. Then if they are produce, if they are like these agricultural plants like avocado, eucalyptus trees and all that, at the point when they are ready, that you say, no, this according to the size I want, this eucalyptus tree is supposed to be ready at this time, then at that point, before you cut it down to sell it or to make timbers or wood, whichever, or charcoal, whichever thing you are going to make to get as the output from that, at that point it will be seen as under IS 41. But after cutting down that tree, it means it's no longer within the scope of the IS 41. It has been now converted either to inventory, because you may find that certain people, they grow those trees to sell them. At the point when they cut them for selling, after cutting them, they are no longer IS 41. They now belonging to IS 2, that is inventory. That's basically what I can talk about the bearer plants. Maybe to give you a more clear idea about the biological asset, let me first define certain terminologies. One, we are going to be seeing the biological assets, and we said biological assets are living plants and animals. Secondly, we have the agricultural produce. Agricultural produce, those are the harvested items of the biological assets. If they are, if you had planted your eucalyptus trees and you are going to make either charcoal, timber, whichever product you are going to get from that is what we call the agricultural produce. Then there is biological transformation. Biological transformation is just a process of growth, degeneration, production and procreation that lead to qualitative and quantitative changes in asset. Actually, this biological transformation, it's like the stages, how those biological assets are going to go through at their stage of whether they are going to be growing, whether they are going to be dying, whether they are going, because we are going to be seeing all that. But let's first see what is covered within the scope. And we said we looked at the biological assets except the bearer plants. Secondly, we are seeing agricultural produce at the point of harvest. Then we have the government grant related to biological assets. If at all the government is giving some grants to people, let's say in terms of they are distributing seedlings for people to plant. If at all they are giving animals, if at all they are, because in Uganda there is that for that government agents that is giving those animals, it's called NADS. It helps those guys to be able to get cows, and they start rearing them so that they can be able to increase their numbers. And at the end of the day, you see how you are going to be accounting for it. So these are they may be in terms of grants which are given to certain people, but they are related to biological assets. And we said biological assets are living plants and animals, whether you are given seedlings, whether you have been given animals themselves. So let's look at what are the items that are out of the scope of the IS 41, that is agriculture. One, we have the land on which the agricultural activities are carried out. Of course, it depends on where you are going to be constructing. If the land you have got if it is going to be falling under IS 16, IS 40, or IFRS 16 leases. If the land it depends on where the land falls or the purpose of the land. But that land, maybe how you acquired it, it may be in terms of you got a lease, and for you are just doing your agriculture there, but at the end of the day the land is supposed to be belonging to someone else. So we are going to be saying that land is land on which those agricultural activities are carried on is excluded from the standard of the IS 41. It is accounted for under different standard. Secondly, we say the agricultural produce after the point of harvest. We said when the animals are slaughtered, they now converted into inventory. They are no longer investment. Sorry, they are no longer agricultural, or they are no longer accounted for under IS 41. That's agriculture. So the agricultural produce after the point of harvest, that is accounted for under IS 2 inventory. The other one, the third one we can talk about is the intangible assets that are that are related to agriculture. Of course, we saw how to account for intangible assets. They may be in terms of license, rights that are being given. There are so many things that can be given in terms of the intangible asset, but they are related to the agricultural activities, which are accounted for under IS 38. That was intangible asset. So if they are intangible assets but they are related to agricultural activities, they are not part of the IS 41. The last one we can talk about, we say the bearer plants, and we say these bearer plants are living plants that are held for production and supply of agricultural produce, and bears produce for more than one accounting period. Of course, if something is they have given some examples of avocado trees, rubber trees, and tea trees. Of course, here I want you to get something. These bearer plants, they are now being accounted for under IS 16 PPE. The reason why they are taken to IS 16 PPE is because those bearer plants, they have certain characteristics, or they have the recognition criteria that are similar to those assets that are belonging to IS 16 PPE. And we said from the IS 16, we said that these assets that are belonging to IS 16, those are assets that can be used in the production or supply of goods and services, or they are used by head office and all that. But if you try to look at these bearer plants, if let's say you are talking about the rubber tree is used in the production of rubber. These tea trees, they are used in the production of tea leaves. These avocado trees, they are trees, but they produce avocados. So it means that the bearer tree itself is going to be accounted for under IS 16. Reason, it is the one that is manufacturing all these items that we are going to be getting, but the end product or the produce we get from that bearer plant, they are accounted for under IS 40. The reason is very simple. Those trees, they produce those items, but it will only be accounted for under IS 41 to the extent that they are ready for harvest. When they are ready for harvest, then they are going to be under IS 41. But when they are not, when we have already harvested them, it means they are now going to be treated under IS 2, that is inventory. So I hope you guys can be able to distinguish some of the things. If you see it is a bit confusing, rewatch and try to get sense out of it. Or you can look at it, you can look at one of these bearer plants and you say, look at this rubber tree, it is used to produce rubber that we get from it. The tree itself, it is like a machine, because it is the one manufacturing those items we are getting, those produces we are getting from there. So if it is producing, and when we are talking about IS 16, we say that those assets that are used in the production or supply of goods and services, they fall under IS 16. That's basically the amendment that was made to this standard. Before, they used to account these bearer plants under IS 41 agriculture, but they are no longer accounting them here because of the reason I gave out. So you'll be able to differentiate those, and because even when the question comes, they just most of the times they are asking what are some of the items that are falling in there. They may give you these items and you think they are belonging there, but in actual sense when they are not. We say the items that are belonging there, there are only 3. The rest you just look at how the question is phrased, and you'll be able to understand how you're going to be either including them or ignoring them. You can go to the next slide and try to look at it. Maybe to talk more about the biological transformation. We said the biological transformation, actually we say they are just stages of how these biological assets are going to be moving or growing, or how they are going to be for their lifespan. There are certain criteria that you may find someone is let's say rearing some animals. You buy them when they are still young and you start rearing them for maybe for sale, or you are just grazing them for reproducing more animals, so that you can increase the number of those animals you are going to be having. Other, they plant those eucalyptus trees that at the point when they are planting them, they plant them with the aim of selling them after they have grown up. So how are they going to be moving from the time they were planting them at the time they were going to be sold? Because we said that IS 41 stops at the point of when they are ready for harvest. So that's basically the biological, that transformation. How are they transformed from the point they were acquired up to the point they are now converted into the produces we are talking about, which are going to be accounted for under inventory. So let's try to look at what are some of the outcomes of the biological transformation. What happens if let's say an animal is growing from the time you have acquired it up to the time it is ready to be slaughtered? Or what happens if we are planting certain seedlings of a given tree species, and at the point when they are ready for their intended use? But you also have to understand that there are certain items the owner may decide and they say that me, I'm going to be selling these items before even they mature. Someone says me, I'm selling these eucalyptus trees when they are maybe if at the point when they are making 1 year, I sell them off, meaning those ones are going to be accounted for as IS 41, meaning they will be belonging to that standard, but they will be current assets because they are going to be there for only 1 year, and after 1 year they are going to be selling them at the point when that person is going to sell them. Even it may happen that these people who are rearing cattle, they rear that cattle for, let's say they may decide that me, I'm going to rear these animals for 1 year, then I sell them off, whether they are mature, whether they have done what, me, I'm selling them after 1 year or before 1 year, meaning they are going to be accounted for under IS 41, but they are going to be treated in the balance sheet as current assets, because they are there but not under inventory. They are there for short period. Then it will be the other person who has bought those items, maybe to convert, to continue from there and say, I'm also going to do this and this, depending. But if they are produce that someone says, I'm planting these trees, but I'm going to sell them at, let's say, after 3 years, then we treat them as they are biological assets, but they are now belonging to non-current assets. It means since they are going to be there for the whole 3 years, we treat them as. So we are going to see how we are presenting these items, but I wanted you to get a brief idea of how most of the things happens in that agricultural stuff. So when you try to look at the outcomes of the biological transformation, one, their asset changes. And within the asset changes, we have either assets are going to be increasing or they are going to be decreasing. And when these biological assets, remember we are not only talking about the animals, or we are talking about the animals and the plants. We have growth. Of course, if they are increasing, it means they are growing. That's the growth. And we are saying this is the increase in the quantity and the quality of the biological assets. So what are some of the scenarios that may bring to the growth of these, or to the increase in the quantity and the quality of the one? You may plant these let's say trees for 1 year. You may plant those trees and you are suggesting, I'm going to sell them in 5 years time. By the time they reach 5 years, they will not be the same way you planted them, meaning they must have increased. And even increasing doesn't mean that they are all going to grow at the same rate. You may find that some are going to be of low quality, but others are going to be of high quality, because they are growing using the agricultural conditions as you know them. I'm not going to go into agriculture, we're not teaching those things, but at least you should be able to understand what makes those items to be. At least these ones have of good quality, the other ones have of low quality. And even that means that you are not going to be getting the same amount of money in each of those trees, that like you are going to be getting uniform amounts just because you planted those trees at once. That's the implication. Then if they are animals, a one year old animal, it cannot when you buy it when it has just made 1 year, by the time you sell it, maybe in 5 years time, it will not be of the same size like the way you acquired it. Even it will not fetch the same money. So if it is not going to be fetching the same money, we are going to be seeing how we are accounting for that. If there is a growth, how are we going to treat the money? Because we paid certain amount and the animal has now increased in value. How are we going to treat that? We are going to be having scenarios where the asset, let's say the animal is, it has increased in the value of the animal has increased naturally because the prices are increased in the market. And there is also a scenario whereby the price of the animal is going to be high as a result of the animal growing up. That the animal, it has grown up now, it can fetch a lot from the market. So those are the two scenarios. When you are given that difference, what you are going to be fetching from the market, and you compare with what you paid to acquire those animals, you account twice. You account for the increase as a result of the increase in the price, and you also account for the increase as a result of growth. So that's basically what we are going to be seeing, and we are going to see how we do those in the preceding slides. So the next one is degeneration. Within the asset changes, we say it is either increasing or decreasing. Now what leads to the degeneration or the decrease in the quality and the quantity? One, if let's say you are slaughtering the animals, remember these animals are going to be growing at a different rate, and they are going to be ready for their intended use at a given time. So it means that you are going, when you are slaughtering these animals, or when you are cutting some of the trees, you are reducing. That's what we call degeneration. They are reducing in the amount and as well in the quality, because you have harvested them. And we said after harvesting them, then they are no longer treated as IS41. Then we look at another outcome of the biological transformation. There are two. And the other one we can look at is the creation of new animals, new assets, or new biological assets. What happens is that if let's say you are planting banana, when those bananas are growing up, they keep producing. You either do the thinning and the pruning of these young ones which are coming, but when they are coming up, you know that they are now going to be increasing. I planted one, but by the time I harvested the one I planted, there are others which are remaining. So that's what we are talking about. If they are animals, by the time if let's say you have bought a female one, you may find that at the point you are selling the older one, it has already reproduced. Meaning we are going to be having a production, and at the same time we have a procreation. A procreation means you are recreating something. And to distinguish this, procreation is in animals, because you can't say in plants that they are also procreating. It may look the same, but at least this one they are just producing. They are giving more. As I said, in plants, as if you plant one banana like this, you may find that at the end of the day it is producing more. That's what we are calling the production. And the other one is the procreation, is all about when the assets are when the animals or the biological assets in terms of the living animals, they are increasing in the value as a result, because more are being born. So when they are born, we account for there is that increase. We said leave alone the other increase, that it has increased because the animal has grown up, but there are others, the amount is increasing just because the first animal you bought gave birth to another one. So it means you are going to be earning a lot than what you actually spent. Or to the other, if you are buying the one that is in calf, it is about to produce, you find that you are not paying the same amount like someone who is buying something that is not about to produce. So that's basically what we are going to be talking about, and we are going to be seeing how we account for all those scenarios we've been talking about. Then the other one is, maybe the last terminology we can talk about is the agricultural activities. What are we going to do as the people who are owning those things? What we are only doing, we are managing the biological transformation. What are we managing? We are managing the biological transformation. How those animals or how those plants are going to be producing, or how are they going to be reducing. So we are only managing the biological transformation of the biological assets, for either to sell them or for conversion into another. We either manage them in a way that we want them to grow up, like for eucalyptus trees, we make sure that they are growing well, we prune, we do the thinning, so that they grow and they have the quality we want, so that they can be able to fetch a lot when they are taken to the market. Or we manage them so that they can be able to produce more and we'll be able to increase in our numbers. So that's basically what we can talk about. Maybe to conclude with the recognition criteria. How do you tell that you have a biological asset? How do you know that someone has a biological asset? One, the entity controls the asset as a result of past event. We are saying you must have bought it. Even if you are given to it, we say like the way you treat the dividends, the grants. When you are given, because for someone to give you something, it means you have done something. So the person is now appreciating something. So that appreciation is like you've already earned it. So whether they gave it to you, you must have acquired it in the past. Secondly, we said whenever we are talking about assets, it's probable that future economic benefits that are associated with the asset will float the entity. That one is ever there. Those 2 points, the cost can be measured reliably, and the probable of the future economic benefits flowing to the entity. The other one, we are saying that the fair value. The reason why they are saying fair value is because when we look at measurement, we always measure these assets at their fair value, as we are going to see in the measurement basis, what we normally use. Fair value, or the cost of the biological asset, can be measured reliably. So, having known how to recognize the biological asset, then which values are we going to assign on those biological assets so that we incorporate them into our financials? One, we are saying that these biological assets, they are initially and subsequently measured at fair value. The reason why they are measured at fair value is very simple. Is that these most of the times these assets, like the way when you are getting them, the way we get them is more or less determined by the market forces of demand and supply. So they are initially, that's as per the standard, initially and subsequently measured at fair value. But there are also scenarios whereby you can't determine you can't determine the fair value. There are certain items that you can't even determine the fair value, or the fair value cannot be determined easily. Maybe if there are very few on the market and people cannot even determine the amount that can be paid for them, then you measure it at cost, what you actually incurred to get it. That is at the initial recognition. But subsequently, you can't be, even if you have acquired, even if it never had a fair value at the initial stage of acquisition, you can't account for that biological asset at the same cost at the point of reporting. It will never, because we said the asset is going to be transforming, either growing or degenerating. So we are saying that if the fair value cannot be determined on initial recognition, the biological asset will be measured at cost. Then we have any changes in the fair value, that is the fair value measurement at the subsequent recognition. When we try to measure those items, remeasuring them, you purchase them if they never had the fair value at the initial stage of recognition, you measure them at cost, the cost you incurred to acquire them. But at the point when you are reporting in the financials, they must have grown up, because we measure we do the presentation at the end of the year. So by the time it goes for 1 year, it must have either increased in the price, or it must have reduced in price. But here we don't account for depreciation. Most of the times we don't account for depreciation, because we are using the fair value. That's why the standard is very clear. It says that they are measured initially and subsequently at fair value, meaning that difference is going to be, it's like revaluation losses and gain if at all the asset loses value. But I don't think for the reasons I gave you that the asset can even lose the value, because by default when you buy a 1-year-old calf, by the time it reaches to 2 years, it will not be the same. So it means you can't get the same amount, or you can't get something below when it has grown up. Maybe if it dies, then at least we can talk about that loss. So now we are saying any changes in the fair value gain, either gain or loss, when you are remeasuring at subsequent, then we recognize them in the profit and loss account. The reason why we recognize these in the profit and loss is because they are already realized. It's because we are determining the fair value, and we say that the fair value, it is fair because we get those figures from the effective market prices, meaning the market where there is no cheating, everything looks to be fine. That's why we are carrying these figures. They're like the one you can fetch from the market at the point of reporting. That's why we are taking these figures, these changes into, if it is a loss, we less it. If it is a profit, we add it to our other incomes, or we add it to the gross profit. But you have to account for the two things I told you earlier, is that the changes in the fair value may be split between the changes in the fair value due to changes in the market price, whether the market the market prices has just increased on the normal way, because we said in the market you can get any price depending on the prevailing conditions that are there. If there is inflation, if there are so many things which are within the market that can determine the price. So if it is that, then we separate. Then the other thing is that if there is a physical change or growth within the assets, remember there is the asset picking a high value from the market because it has grown up. It was young by the time you bought it, but now it has grown up. So you split. When you are given the whole gain or loss, you split it. Maybe you will be given how it is going to be spread. So maybe the last one we can talk about is the presentation of these biological assets. How do we account for them in our financials? How do we put them? How do we present them? If they have been there for 1 year, we put them under current assets. If they have been there for more than 1 year, we put them under non-current assets, period. And maybe you can look at the trial number November question 2 2017. You may look at that question and be able to understand these questions we are not doing now. We are going to be doing them. So I want you to guys to first analyze the theoretical aspect, so that by the time we go to the computations, at least you can be able to memorize some of the things and we'll be able to understand more. Thank you. I urge you guys to subscribe to the channel so that we can be able to learn more and more as we are improving our learning in this accounting related field. Thank you. The next slide will be about the IS2, that is inventory. Since we've been talking about the after harvesting, so let's look at the inventory, and that's what we are going to be seeing in the next video.
Good evening, viewers. Today we are going to proceed with our series on financial reporting. And today's video was a concern from one of my viewers. Wanted me to have a recorded class on IS 41, that is agriculture. And today I'm responding to that concern. And today I picked a question from November 2017. This is going to be question 2. And as far as the notes we had, or in the previous video we had, we discussed some of the aspects. We looked at some of the terminologies that are within the IS 41 agriculture. And as I told you earlier, that some of these standards you may find that they are going to be asking you to define certain key terms, and they give them, let's say, 4 marks, 2 marks, depending on how many they have posed. You may find that part 1 is more or less definitions, and part B is the one that has some bit of computation. As we discussed earlier, that this paper is mainly combined with theoretical aspect and the computations. So if you are not supposed to concentrate at one, if you try to understand how certain things can be done, you should also be able to master some of the key terms as how the standard describes them. That is very important if at all you want to pass this paper with ease. Some of the things we are handling now, I try to look at this last sitting, which is December. The sitting in December, we found these questions, they were there, found them there. December 2022, these questions were there about IS 41 agriculture, IS 20, which we did last time, and it shows that some of the things, they are not day-to-day things. These are the things you're supposed to understand, and when you understand them, they will help you even in the preparation of financial statements. That's IS 1. So these things are very important. Don't just underlook at them. Pay attention to them and be able to know what you can basically do. So without wasting more time, let's try to look at question 2, November 2017. It's going to be about IAS 41, that is agriculture. So question 2, actually we've reached, this is the question. It came as a whole number. The whole number 2 was all about IS 41. But as I said, when you try to look at question 2, part A, you find that they are requiring you to define some key terms, and they are taking 6 marks. So it means if at all you had not captured, you had concentrated on computations only, you could lose the 6 marks. So let's try to go through the question, and you know how we do these things. We first analyze the question before we give the solutions to those very questions. So question 2 says, under IS 41 agriculture, biological assets are the core income producing assets of agricultural activities held for their transformative capabilities. It says biological transformation leads to various different outcomes. Of course, we know from these biological assets, we say that these biological assets, they are just living plants and animals. That's how the standard defines the biological assets. But when you try to look at the agricultural activity or the management of biological transformation of these biological assets, maybe if you are holding them maybe for sale, or you're going to be converting them into additional more biological asset, we find that they go through a transformation. And when we try to look at the biological transformation, these are the asset changes and the creation of new ones. Of course, under the asset changes, we have growth and degeneration. Then within the creation of new ones, we have production and procreation, as we discussed them in our first video. So if you want to understand, get more lights on what these terminologies are meaning, we made the first video that was giving out all the theoretical aspects that are concerned with IS 41 agriculture. So you may go back and try to check it out and be able to have something as we add on the knowledge we are going to be receiving from this question we are going to be handling. So the required says part essays discuss the various biological transformation outcomes and distinguish between agricultural produce and biological assets, giving examples of each. So this, if you try to go back to the previous video, you'll be seeing what this wanted. But as we discussed in that video, if you try to go back and rewatch that first video about the IS 41, we agreed that these biological transformation outcomes, they are the asset changes, which comprises of growth. And within this growth, we try to look at the increase in the quantity and the quality. Course, increase in quality and quantity of biological assets. Then the degeneration, of course, the degeneration we are looking at when the quality and the quantity, they are reducing. You may find that when maybe we are rearing animals, at some point we may rear these animals to make sure that they are going to increase in numbers. And in the other sense, we may find that we are rearing these animals just to sell them off. And when we are selling them, it means they are going to be slaughtered and we are reducing then their numbers. That's a degeneration. Or even if you are not slaughtering them, take an example. If let's say these cows are going to be dying, you've reared them, but they are dying out of maybe a natural disaster. It means they are degenerating, or the quantity and the quality is reducing. So that's basically the biological asset. It has two outcomes. The biological transformation will have two outcomes. We are either going to have asset changes or the creation of new ones, of the new assets. We are going to be having a procreation, and that is where we are going to be producing more living animals. And the other one is production, where we are going to be producing more non-living assets or products or items. So those are basically the things that are coming out of the biological transformation, and those are the ones they wanted. So the other one was saying we distinguish between the agricultural produce and the biological asset. We said biological assets, these are living plants and animals. That's how the standard defines the biological assets. And the agricultural produce, of course, these are the outcomes, what comes out of all the harvested products of a given distinct biological asset. What comes out of those assets, these biological assets? If it is a cow, what do we get from the cow? Of course, we get beef, we get hides, we get what? All that. Or if let's say it is maybe sheep, we find that you are getting so many things from the sheep. So those are the things they wanted actually. Try to look at, you may say sheep, then of course the agricultural produce is going to be mutton. Then for cows we get beef. Maybe for these for clarity on some of these items whenever they are given, because they wanted you to be giving examples for each. You give a biological asset and you give out its produce or its outcome, what comes out of that given biological asset. We make sure for you to maximize the marks, or to get all the marks. You make sure at least you concentrate on the side of animals, because when you try to look at the side of the plants, you may get confused to the extent that you may even mix up the bearer plants. And you said these bearer plants, for them, they bear produce for long period of time. So those ones, they are excluded from the standard, and they are accounted for under IS 16 PPE because they possess those characteristics or those features that are for production and supply of goods and services. Because if, let's say, you are taking a mango tree, it can be there for a long period of time, and it provides those produce, those mangoes, for a given period of time. It can be there for this year, you harvest it, next year you harvest it. It means it's like it's the one manufacturing those mangoes that we are getting. So it was transferred to PPE because it possesses those features that are belonging to IS 16 PPE, as we discussed in our first video. So these other plants which you can give as examples of the biological assets, of course, you give the ones for short term, maybe the beans, maybe the maize, and what we get from the maize, what we get from the beans. Those are the things they wanted here, and you score all the marks, all the 6 marks that you have given. So I won't put more explanation on that. My concern is on this part B, which is a bit tricky because it has some computations, and that's where I want to focus or to put my emphasis, and we'll be able to understand more and more. If you try to go through the question, it says the director of Majembere Dairy Farm has provided you with the following information for the period ending 30th June 2017. This is the information they have given us. It is within the period. For the period ending 30th June 2017. The first one they have given us, we have the items and we have the amounts in shillings, in million shillings. We have 16 6-year-old animals. That is as at 1st January 2016. The amount was 44.8. Then 7 newborn animals for that is 30th June 2017. Then we have 16 6-year-old animals, but this figure now is as at 30th June 2017. The first one was at 1st July 2016. So the next one was 10 7.5-year-old animals, as of 30th June 2017, and 12 9-year-old animals, 30th June 2017, at 48 million. If you try to look at these IS 41, you find that most of these guys who are engaged in agriculture want to look at how are they going to be accounting for some of the animals or some of the agricultural items they possess. And if you go back to that first video, you will also have items that are not going to be catered for, like the land on which those agricultural produce are taking place. That one doesn't fall under this standard. So you'll be able to look at the scope. You see the limitation of the standard, where the standard says what is supposed to be included and what is not supposed to be included. Those things are very important because they may even ask for them, just to state what is included and what is not included in the standard. So that's why you are seeing here, we are talking about Majembere Dairy Farm. It means we are going to be talking about those assets that are those biological assets that are going to be used in the dairy farm as far as they are being listed. The additional information says that during the year, 10 7.5-year-old animals were purchased at 3 million shillings, 3 million each. Then we have 7 animals were born during the period between November 2016 and March 2017, valued at 720 each. So we have the animals that were purchased, 7-year-old animals. There were 10 of them, each was at 3 million. Then we have the newborn, of course, the one that were produced by the ones that were there. Of course, there are 7, and each was valued at 720. So they are continuing to say that during the year, 1 7-year-old animal fell in a ditch and became incapacitated. So if it fell in a ditch, it means it's more or less that, because if it fell there and it can't like be functioning anymore, then it means it's like they have disposed of. Then they are continuing to say that the management slaughtered it and distributed its beef to the staff. Then they are saying that 2 6-year-old animals were sold during the period at 3.5 million each. There were 2 6-year-old animals were sold during the period at 3.5 million each. Then the carrying value of the sold and slaughtered animals were estimated at 2.320 each. Then they are saying that all the animals above 5 years of age were valued at 4 million each, while those below 5 years of age were valued at 1 million each as of 30th June 2017, as a result of their physical change. We discussed in the first video that when these assets are growing, one of the things that is going to be happening is that some of these assets, these biological assets, are going to be increasing in value. And the increase in value is going to be split into 2. We look at the increase in the value as a result of an increase in the market price, or as a result of a change in the market price. Because when the market forces of demand and supply, they keep on fluctuating, it means even the prices are going to be constantly changing. The change may be attributed to changes in the market price. And there is also a change whereby that these animals are going to be growing. It's supposed to be out of physical change. If, let's say, a 7-year-old animal cannot be sold at the same price like a 10-year-old animal, so there are going to be a difference in the prices depending in the physical changes or growth that the animal has matured, so it has been able to fetch more from the market when you have kept the other factors, of course, constant. So the required is saying that you will prepare we prepare a reconciliation statement of the carrying amounts of the dairy livestock at Majembere Dairy Farm, 14 marks. For those who don't understand what a reconciliation statement is, it's like we are trying to look at, because what they want us to prepare is what are we going to be having as the figure that we are going to be taking to the balance sheet in terms of our livestock that we have. Remember, these livestock during the year, the whole year, you find that some of these animals are going to be growing up, others are going to be sold. So which figures are we going to be having at the end of the year so that we can be able to determine the carrying amount that we are going to be reporting in our financials? So that's basically what they want. And we are saying that the reconciliation statement is more or less of a non-current asset schedule. It's a schedule that is showing the assets we have at the beginning of the period. We add what we've purchased, and in this standard we are looking at purchases as those that the company has actually purchased, and we try to look at even the newborn animals that are going to be, because when they are born, it means it's like we are increasing stock. So those newborns, they are going to be treated as if they were purchased during the year. So those are going to be as our additions. We have the balance we had last year, which will be the opening balance for this year. We add what we purchased plus what was produced. Then we subtract what we disposed of or what we derecognized from our assets. Of course, derecognizing is like we are writing off the carrying amount of those assets that are going to be sold, because we've seen a scenario here when animals are going to be sold and others are going to be slaughtered. So when they are slaughtered or they are sold, it's more or less that we are going to be derecognizing, because we don't expect to receive any future economic benefit, because at the end of the day, if the animal is slaughtered, it will be done and nothing more that we are going to be receiving in the future. So we write it off and we remain with those animals that are still there. And that's basically what we are going to be doing. We get the animals that we have at the beginning of the year, we add what we've purchased plus the new or the newborn animals, then we less what we've disposed of, so that we can be able to remain with the net assets that are available at the end of the year. And that's what we are going to be calculating. That was termed as a reconciliation statement of the carrying amounts of the dairy livestock at Majambere Dairy Farm. So we've actually agreed how we are going to be doing that. So we can try to go ahead and we start making some analysis. We've done the analysis, we've done what we've actually understood what we are going to be doing. So let's go to the Excel sheet and we try to look at what we can do. This is the same question. I just copied it from there, pasted it here, so that we can be able to follow up and we see what we can do. So first write the heading, because whenever we are starting this, start with the heading. And the heading is written with, we first start with the name of the company, that is Majambere Dairy Farm. Then what are we going to be preparing? We are preparing a reconciliation statement for which period we are doing for the year for the year ending, it has not yet ended, ending 30th June 2017. The year has not yet ended because the figures they gave us here, they were for the period ending 30th June. It means everything we have here was during the period. All of these were in the period. So that's what we have to first do. But maybe the other key important, maybe this one you can put it. These figures are going to be in thousands. May add that they are in shillings, and we may put, they are going to be in thousands. So one of the things we need to understand whenever we are doing these numbers, it's not like the way we've been doing financial accounting. Whenever we are doing financial reporting, we do the workings aside, we just bring the solutions. So let's first try to analyze what are we going to be having as in terms of the period. Remember, we are looking for the year ending 30th June 2017. If the year is ending 30th June, it means it must have started in 1st July 2016. That's the only way it can make 12 months, 2016, then to 30th June 2017. That's a 1 year. It means all figures that are going to be having a date of 1st July 2016, they are going to be our opening balances. And all those figures that have a date of 30th June 2017, they are going to be our closing balances. So before you start anything, you need to first analyze the date. When did the year start and when did the year end? Because if you don't understand those ones, then I don't know which figures are you going to be using in terms of looking for the figures for the beginning of the year, that we are going to add the additions so that we can get the total and we less what we've disposed to get the carrying amount. So that's what we are going to be doing. Before you do anything, you first know when did the year start and you know when is it ending. Because if you know that, it means you are going to be having the values at the beginning are going to be our opening balances, and you know the ones at the end, they are going to be our closing balances. So let's try to look at those values and we start our workings. We are going to do the workings aside here. Let me put it here. This is going to be our workings. This is where we're going to do all the workings. Can also put this one under workings. So we can put it as number 1. This is not important. Put it there, but it helps you to understand what you are going to be doing. So we start with the opening balances, and these opening balances, the question may not come in the same way we are seeing how it came here. You may find that they have given you a balance sheet. If they give you the balance sheet, it means you will pick figures from that balance sheet. You will pick the opening balance from there. Because these figures we have as at 1st July 2016, we had 16 6-year-old animals that were bought. That was the balance that we had in the previous year. So it means this is the carrying amount of these 6-year-old animals, the 16 6-year-old animals, which is 44,800. because when you try to look at these figures are for the whole 16 6-year-old animals. But we may look at a scenario whereby we want to find out how much is each animal, the 6-year-old. You'll be getting this figure, we divide by 16 to get the 6-year-old animal, the cost for each item. So we can now go to, we start by looking at the carrying amount or the opening balances. Opening balance, and this is on 1st July 2016. That's where we have those figures. So this one doesn't need any workings because we had a 16, these are 16 6-year-old animals. 16 6-year-old animals, and their cost was may put the cost this side. The cost was 44,800. So if you try to look through the question again, we are seeing all these other animals are having 30th June. It means the whole of these figures are for the year end. So let's try to look at the additions now, because that is the opening balance. We have only one. So we try to look at now the purchases. What did we purchase? And we say that these purchases, we are going to categorize them into what we actually purchased and what was added in as in terms of the newborn animals. Purchases during the year. And when you go back to the question, we are seeing in the additional information that during the year, 10 7-year-old animals were purchased at shillings 3 million each. It means there were 10 7 and 7. They're 7.5. 10 7.5. Seven-and-a-half-year-old a 10 7.5-year-old animals, and their cost, we are seeing that the cost, they purchased one at 3 million. We use 3,000, we multiply by 10 because they were 10, they bought 10. So since they bought 10, we are now taking this multiply 3 million by the 10 that was purchased. And we are getting 30 million. Then the other one, we have the new bond. Here they said seven animals were born during the period of November 2016 and March 2017. They were valued at 700 each. So there were seven newborn animals, and they are saying there were 7 and each was valued at 720. So when we try to get that, it will give us 5,040,000. So those are the ones we actually purchased. We may try to zoom in a little bit to be able to see the question very well. Then they are saying during the year 1.5. Now these are the ones we disposed of. We are not seeing any purchase. Now the other one is just a disposal. We can't record the disposal before we first register the changes in the fair value. Remember, we said we are starting with the opening balance. We adjust what we purchased, all the new acquisitions and the newborn animals. Then we also adjust by the fair value. We said these animals are going to be increasing in value, and the fair value is going to be split into 2. We said the fair value is going to be split into 2. And we are going to look at the changes in the fair value as a result of change in the market price. When the market price is changing, it means even the value or the amount that we can get from selling those, actually from valuing those animals, is going to change. So we account for that. And the other change in value is when there is a physical growth or there is a physical change. The animal, they have been young, but now they have grown old, so the prices are going to be changing. So let's go there and try to look at now the change. We are now registering the change. Change in fair value. But we are going to start with change in fair value as a result of change in market price. Let's start with the easiest, so that we go to the other one at a later date. Now, this one is going to be due to
due to change in market prices. Because as we all know that these market forces of demand and supply, they are the ones determining the prices that are going to be charged for a given asset in the market. And what we have to understand from this point is that we can't be having two things that are going to be happening at the same time. What we do here, we first hold the other factor that may lead to a change in the fair value constant. Because we have two scenarios, the market price and the physical change. So if we are to estimate the changes in the fair value due to changes in the market price, we have to keep the physical changes constant, so that the other one, we don't look at it, we look at what caused the changes in the value of these. The fair value is market price alone. We look at each item separately. We try to compute each of them when we hold or we assume that the other factor is not influencing the one we are calculating at the moment. So that's how it is. Because if you don't do so, then you're not going to be having realistic figures. Because we can't be having this changing and the other one changing at the same time. We hold one constant and we solve the other one. Then we turn to the next one as we go on. So when you are calculating the fair value or the changes in the fair value due to changes in the market price, what we have to first understand is that we have to first look at the items we registered first. When we started this reconciliation statement, we started with our opening balance. And our opening balance, we had a 6-year-old animal. There were 16, and we want to look at how have those 6-year-old animals behaved during the year. We want to look at have their prices gone high or their prices have reduced. So those are the things we need to look at. But even in this sense, when you're looking at the changes, we are looking for these changes in a sense that when the price is going to be increasing, when the prices are going to be changing, they are not going to be changing downwards. They are going to be changing upwards, as we are going to be seeing. But I know by the end of seeing how we compute the changes in the fair value, you'll understand why we say that the prices are going to be increasing. So we have to start with the assets that the assets we started with at the beginning of the year. We see how their prices have changed. So how are we going to be getting these differences, or how are we going to be knowing how the prices have changed? First of all, we have to look at the value of these animals at the beginning of the year. Then we look at what is the value of these animals at the end of the year. We can either consider, because when you try to look at this question, we have these 6-year-old animals, as at 1st July 2016, they were 44,800. But here, in the third
column, we are seeing in this third row, we are seeing that the 16 6-year-old animals as at 30th June 2017, they were 48,000. This 48,000 is at the end of the year, but at the beginning of the year, we had 44,800. So it means the price has gone up. But this price, it has gone up due to the market, not other factors. We've kept other factors constant, and we are saying it's only the market prices that have changed. And when you try to look at the price we had at the beginning of 44,800 and the one we have at the end of the year of 48,000, we are seeing there is an increment. So how are we going to be accounting for that increment from 44,800 48,000? One, we may be having two treatments. We may say that we are going to be taking the difference. We get the 48,000, we deduct the 44,800. You will be getting the same answer with the person who is going to first get the cost of each animal and then divide. Of course, you get the whole lump sum. You divide by the number of animals, you get the cost per unit of each, then you get the difference. And at the end of the day, you multiply by those figures. So let's do all the alternatives to be able to choose which one will be easy for you guys. Okay, we start with the 16 6-year-old animal. So this one, we try to look at the price at the start. The price at the start of the year. Start of the year it is. Then we can first of all use the other approach of getting the cost per unit. We get the 44,800. We divide by the 16 because they are 16 6-year-old. So you'll be getting a figure of 2,800. That is the cost per unit of each animal. Then we try to look at the price at the end. To the end of the year. Of course, this price at the end of the year, we mean the one at 30th June 2017, which was valued at 48,000. Then we divide by, because they are 16, divide by 16 and we'll be able to get be able to get 3,000. So we try to look at now the change, the total change. Total change. Total change is now going to be the 16, that those are the number of animals multiplied by the difference of the 3,000 minus the 2800, and when we multiply what we got, the result, we will be able to get the difference as we'll be able to get the difference as 3200. So that will be the whole cost that is going to be having as that is coming as the difference. So we've finished now the 6-year-old animals. Then we'll try to look at now the ones we purchased during the year. Then we'll try to look at the purchase, the one we purchased during the year, and we see their changes as far as the market prices are concerned. They have given us the price here. From here, they are saying that during the year we bought these 10 7.5-year-old animals. They were purchased at 3 million. So if they were purchased at 3 million, which figures now are we going to be using? Because that's going to be the question. Which figures are we going to be using to account for the change? If at all these assets were bought during the year, it means if we want to know the changes as far as the market prices are concerned, it means we have to look at the values at the end of the year, because the only way we can recognize the change is when the year's ended. So we are supposed to look at the figures at the end of the year. They were bought at 3,000, meaning the purchase price or the price at the start, purchase price, this is during the year, was 3,000. So it was 3,000. Remember, we are chopping off some zeros. Then we have to look at the year-end figures, because a change can only be realized at the end of the year. Year-end price, of course, when you try to look at the year-end price, the year-end price, of course, we got it. When you try to look at this is in here. We have the 10 7-year-old animals at 30th June 2017. It is 34 million. And this 34 million, since this is the price for the whole 10 7-year-old animals, we have to get the cost per unit for each item. It will be the 34,000 we divide by the 10, because they were 10 7.5-year-old. The one we purchased. The one we purchased here, they were during the year we purchased 10 7.5-year-old animals. Those are the ones we purchased. So if it is like that, maybe you try to zoom in a bit. So that's, if you get this and you get the you will see that we are going to be having 3,400. So we try to get the total change. The total change is now going to be there 10. So it will be 10. We multiply by the difference. 34,000 minus the 3,000. And we are going to be having 4,000. That 4,000 is the total change in the value for the items we purchased. But we purchased, there is also this these animals that were born. So these newborn, are we having any value here? We have it here as the second row. It says the 7 newborn animals as the price as at 30th June 2017, it is 5.7 million. So we have also to look at the newborn. Look at the newborn during the year, and there were 7 newborn animals during the year. Then we try to look at their price. The price they told us it was bought for, they were valid for 720. So if it is 720, it means this is 720, but now the price for their end, for the end of year, they gave it to us as 5.740. So this one we divide by, there were 7, so we divide by 7, and we get the price per unit for each. And when we do that, we are seeing that we are getting 820. So now we get the total difference, the total change. We get the 7. We multiply by the difference, which is 820 minus 720. The answer we get is going to be the total figure that we are going to be adding. We are getting 700. So that 700 is the figure that we are recording as a total change. So we try to look at, have we skipped any item that we have not talked about? There is this one at the end of the year. We have 12 9-year-old animals that were valued at 30th June 2017. They were valued at 48 million. So we are seeing this 12 9-year-old animals. But now the question is, did we buy these 9-year-old animals? Did we have these 9-year-old animals at the beginning of the year? The answer is no, because we never had them. Then the second question will be, did we buy these 9-year-old animals during the period? When you try to look at what they bought, we didn't see that was bought. So we can't say that these 9-year-old animals were the newborns, because they were already old. Because when you try to look at, they are already 9-year-old. So it means they are already They are not newborn animals. So it means that was just put there to confuse you. It is not supposed to be recorded in this document because it doesn't give a realistic figure or approach. It's not going to be because they were not carried from the previous period that we had them as our balance for this year, and they were not bought within the year. So if at all you could include them, you will be just wasting time. So that one is not supposed to be left out. Maybe when you have done, maybe to get more marks, you write it, you write about it when we've actually done the whole reconciliation statement. Then that one you can bring it that this is not supposed to be included, and you show them that you knew it, that's why you excluded it. So those are the ones we actually have. So let's try now to look at the changes when it is not due to the market prices. And this time around, it's going to be the changes due to the change in the physical growth or the physical change. If these animals are growing themselves, their growth makes, or it's an automatic thing that is going to lead to the prices of those animals to change, whether they are going to be going downwards, whether they are going to be going upwards. If the animal is growing, we don't even expect the price to go down. We expect the price to be going high, because if at all you are rearing these animals for sale, and whenever they get old, it means for you are earning, there is something that is added on every year in terms of the money you are going to be getting if at all you are to sell those animals, because don't expect a 3-year-old animal to cost the same amount like a 2-year-old animal. So that's basically why we say that these prices are going to be going high than going downwards. Maybe if at all, maybe the animal is sick, maybe it has some problems and you've just sold it at a less price because it is maybe sick, maybe it has physical problems and all that. But if everything was okay, they were healthy, we don't expect animals of different ages to be having the same money, because there now you will not be making any profit as a person who is engaged in that business. So let's try to look at now the change that is going to be as a result of physical growth. So this is change in fair value due to now this one is going to be due to physical change. Physical change or growth. Now we have to look at the animals we had at the beginning. How were they affected by their growth from the 6-year-old they were to where they were at the end of the year? Because if it was 6 years old at the beginning of the year, by the end of the year, it means it will be 7 years because it will add 1 more years. So that's how it is. We are saying that at the beginning of the year, animals had they are going to be adding up a year, then we need to look for that value. What will be the value for that one year the animal has added? That is going to affect, of course, the price to increase from where it was at the beginning of the year, and we'll be having a new figure. So we can try to go into the same procedure that we followed, or the same alignment we followed from the assets we had at the beginning of the year. We go to those ones that we purchased, and when we are done with that, we can try now to look at what we disposed of. Of course, what we disposed of, they are supposed to be derecognized. And when we are derecognizing them, it means we are going to be deducting them from our financials. So the 16 6-year-old the 16 6-year-old animals. Now we try to look at the figures. Which figures are we going to be attaching to them? In the question, they have given us the figures that animals which are above 5 years, they are at a given price. But now the question is, which figures are we going to be comparing them with? First of all, if you are to analyze that critically, you need to first know, when is growth achieved? Growth is only achieved at the end of the year. You can't say that you can determine the growth during the period. You only determine the growth when the year has ended. So if we can determine the growth, whether the animal has grown or not, it means we can only achieve that when the year has ended. So if we achieve that at the end of the year, it means even the figures we are going to be using, or we are going to be comparing with what they have given us in the question, they are going to be those figures at the end of the period. So for the 16 60-year-old animals, we try to look at what are their values at the end of the year. They have given them to us here, and we are looking at, they are saying the 16 6-year-old animals as at 30th June 2017, they're 48,000. So it is this that we are supposed to be using to do our computations. It is 48,000. Then we divide by the 16 because they were 16. And when we do that, we are seeing we divided that one and we got 3,000. Then we try to look at now the price they gave us in the question. When you try to look at here, they are saying all animals above 5 years of age were valued at 4 million. So if this one is 6-year-old, it means it is already above 5 years. So it's going to be valued at 4 million. So the price attached, and this price is attached as a result of physical change. What is there? The one that are 5 years of age were valued at 4 million each, whether those below 5 years of age were valued at 1 million each on 30th June 2017 as a result of physical change. So everything we are doing here is as a result of physical change. They have given to us this figure is 4 million. So we get now the total change. Now this total change is going to be as a result of physical growth or the physical change. They are 16. We multiply by the difference. Multiply by 4,000 minus 3,000. Also, when you do that, we are going to be having a figure which is 16,000. And that one is done for the balance. Then now we try to look at the 10 7-year-old animal. These are the ones we purchased. We try to look at the ones we purchased during the year. Then we go to the purchases. Purchases during the year, we have the 10 7.5-year-old animal. These are 10. Because now we try to look at, they are also 7.5 years. It means they are above 5 years. So they are going to be valued at, these ones are going to be the price attached. The price attached is 4,000. But now we get the fair value at the year end, or the price at the year end, which is 34,000. We divide by 10 because they were 10, they were acquired at, which will give us 3,400. So we get the total change. Total change, which is going to be which are 10, they are 10, so it will be 10. We multiply by 4,000 minus 4,000 minus the 3,400. So when we do that, we are going to be remaining with 6,000. That is the total change in those 10 7.5-year-old animals. Then we also look at the newborn. Of course, we have the newborn. The newborn during the year. Now this newborn, of course, for them, they are below 5 years. Since they are below 5 years, we are going to be considering this, because they said those below 5 years of age were valued at 1 million each. So the price attached is now 1 million instead of the 4 million that is attached due to physical change. So we take the price at year end, because we said we can only determine that by getting the price at year end, and it's going to be 5740. We divide by their 7. This already we computed it, and it gave us 820. So we try to get the total change. The total change, we said it's going to be 7. We multiply 7, multiply by the difference, 1000 minus 8200. It will give us 1260. And that 1260 is now what we actually have as physical change, the total physical change as a result of growth in the newborn that we actually got during the year. So we are now done with accounting for the fair value. The last item we are going to be looking at is the disposal, and then those animals that were slaughtered and the meat was served to the staffs. So before we go into any computations, I want you to understand or to emphasize something, that we said that when these assets are sold off, we are going to derecognize their carrying amount. We are derecognizing, or we are writing off the carrying amount, not the cost, but the carrying amount of those assets that are being sold or that are slaughtered, that were slaughtered. We remove the carrying amount, and when we do that, we are going to be remaining with the carrying amount at the end of the period for the animals that are still there. But I want you to understand something. There's some questions you may find that carrying amount is not given to you. If you find that the carrying amount is not given to you, then the question, you try to look at how the question is phrased. This one, everything they gave us was during the year. So if it was during the year, it means that if they did these disposals and they have not given us the price, then it will be a challenge to us that we will not be able to know which month did they sell and which price was reflecting by that time. So to be clear for these guys, most of the times they will be giving you the carrying amount. If at all the assets if at all these assets are going to be sold during the year, when they have not actually specified the period for you to be able to know which amounts. Because you can't be using the carrying, because someone may say, I could use the amount that is existing at the end of the year. You may be right, but this will bring some, if at all these disposals were done within the year, it doesn't necessarily mean that you will use the figures at the end of the year, just because you see that this period they sold these animals before the period ended. So everything was during the period. So it was a must for them. They were supposed to give you a carrying amount of those assets that were slaughtered. So basically, when you try to look at these animals that they slaughtered, what comes into our minds when we have disposals, we expect that we are going to be looking at gains and losses. Of course, you know how to compute the gains. Of course, you get the money, the consideration they have paid you, you deduct the carrying amount of the asset, and you'll be able to get either a gain or a loss. So when you have done that, then our emphasis here is not all about showing the other gain or loss we made. Our emphasis here is just to make sure we get the carrying amount correct. So without wasting more time, we'll finalize this and we see we are now going to try to check the recognition. So let me call them disposals. Disposals and the one that was slaughtered. They gave us, remember here we are not removing the cost, we are removing the carrying amount. They have given us the carrying amount, that the carrying amount of those that were slaughtered and sold was estimated at 2.32 each. It means, but here they are saying that during the year, one 7-year-old animal fell in a ditch and became incapacitated. The management slaughtered it and distributed its beef to staff. So that one was one. Then they're saying the 2 6-year-old animals were sold off during the period at 3.5 million each. So even this one was, these are 2. So you add these 2 plus this one, those are 3. We multiply by this. The only these figures, we will take these figures when you are computing gains, but here the question never asked for extracts, because if at all they wanted the extracts, then you could be able to show all those whether we had a gain or loss on disposal. So we could just get this, we multiply by 3. It will be, then these disposals, they are going to be, there are 3 in numbers. So multiply by the 2.320, and we remove that figure. I put it here. So let me put it here. Three multiplied by 2.320. Figure is coming here as a negative. We are going to be lessing it, which is 6960. This one is supposed to be less. Let me add it here. With this is disposals. Then what we are going to be getting is the carrying amount, what they want. Carrying amount for the year ended. June 30th, 2017. That figure will be. So I've done some of these computations within our statements, but that's not how it should be. You do the working separate, but I wanted you guys to be following. That's why I didn't separate these, but they're supposed to be separated. So let me remove these grid lines. We're going to be adding all that. Less only this one, the rest are going to be added. You see it is 1040. That's the carrying amount what they wanted, and that's how it's supposed to be done. So that's it, and you'll be getting all the marks having done what we've actually went through. So that's all for the IS 41 agriculture, and next video is going to be different standard. I think we should be starting at least the borrowing cost, that is IS 23, and we will be adding more videos so that people can be able to appreciate what we are doing. We do a lot so that everyone can be able to understand and learn from what we are doing. It's the end for today. Until we meet again, thank you.
Good afternoon, viewers. This is CPA Coffee again. And today we are proceeding with our series of financial reporting. In the last video we talked about the IS 41, that was agriculture, and today we are going to look at something, as I had promised you, that it is IS 21, IS 2, sorry, that is inventory. And this inventory, basically we've been talking about certain scenarios of how we get some of this inventory, because even when we looked at the IS 41, we've seen some items that are going to be treated as inventory, as the agricultural produce after the point of harvest. But before or due to harvest, they are under IS 41. So basically when you are looking at the IS 2, the scope for it is basically handling 3 items, or we have stock is categorized into 3 items. One, we have the finished goods, as we are going to be seeing them. Let me try to increase a bit. As we are going to be seeing them, maybe I put it to 20 so that you can be able to see my screen. Yeah, just this one. Okay, hope you can be able to see. Here we are saying that the inventory is basically subdivided into 3. We have the finished goods, we have the work in progress, that is the unfinished products that are still in the production process. Then we have the raw materials themselves we use in the production. So when you are talking about the inventory, we have two companies. We have the company that is just a startup. It is buying stock, finished produce, and it sells it. Basically it deals in purchases. But there are other companies that are already in the market that are producing their own products. Those are the ones that are called the manufacturing companies. I hope you did those ones in financial accounting, where you are doing the manufacturing accounts and all that. So that's basically what we are going to pick some of the concepts. Hope you can be able to remember those ones. If you don't remember, you can go and check to my video on cost accounting, because I created some of them there. You may find some of the costs we are going to be talking about here. So when we proceed to, that's basically the scope of IS 2, or basically what are we going to be looking at when you're talking about IS 2 inventory. So what are some of the items that are not included within the IS 2? We said one is agricultural produce at the point of harvest. We looked at that one under agriculture, and we said that one, agricultural produce at the point of harvest, or before the harvesting, that is treated under IS 41 agriculture. Then we have a work in progress under long-term contracts. Yes, we may have unfinished work, but if they are in contract, it means that will be accounted for under IFRS 15, that is living from contracts with customers. So we have another one with these financial instruments. Financial instruments, we are talking about the debentures, bonds, shares, and all other traded instruments as you know them. Those are accounted for under IFRS 9, that is financial instruments. So basically what we are going to be looking at when we are talking about the inventory, that's how basically we recognize it. Must be finished goods, must be work in progress, but not the one for long-term contracts. Then it must be raw materials. So having known that, that we have identified them, then which values are we going to attach on those items we have got? That is the measurement of inventory. And we are saying initially we measure inventory at cost, but the word cost is very broad. We spoke about it when we are handling IS 16, that was PPE, because it was also initially measured at cost. Most of the things we've been saying, except the biological assets, we've seen that some of them they accounted for initially at cost, or we use the cost model for initial recognition or for initial measurement. But when we are talking about the cost, the word cost is very broad, to the extent that, as we said, we have a company that is engaged in production of goods and services. There is also a company which is engaged in buying stock and selling it. So they are going to be accounting those items separately. The one which is into buying is going to compute the cost of purchase. And the cost of purchase, we said it doesn't include only the purchase price only. We said it is purchase price with less trade discounts or rebates if they are there. We add the other import duty and other direct taxes that are associated with the asset. Then we also include other relevant costs that are related or that are attributable to the product we are purchasing. So long as they are associated with the asset, and before we incur them, they are inevitable. If you don't incur them, we are not going to be having the stock we want. Whether it is whether we are getting raw materials, whether it is what, even work in progress. If I may talk about the work in progress in the sense that if the production has stopped, but there are some items that are still in the process, and we are supposed to keep those unfinished items, so we are supposed to incur costs, storage costs. We store those items, the unfinished items, before the production resumes. So when the production resumes, at least we pick those items where we stocked them, and we start reproducing them, or we complete the process. So that storage cost we incur on work in progress. I'm not talking about the storage cost we incur in storing raw materials, because that one we are going to see under the costs that are not associated within our stock. Then the other one is, if you're not purchasing, it means you are making your own products. So you will be incurring what we call the cost of conversion. Cost of conversion excludes only the cost of raw material. But conversion costs, those are costs of converting the raw materials into finished goods. All the costs that are directly attributable to the cost, they are supposed to be accumulated at once and added to the cost of the raw materials. So if you are producing your own products, you get any direct and indirect costs that are directly attributed to the production. As you do your manufacturing accounts, you know how to do that. Getting the prime cost, you add other factory costs that are directly attributed to the production, then you'll be able to get the cost of production. That's what we are talking about. By the time you reach the cost of production, that's what we are meaning. So let's look at what are some of the costs that are not part of the inventory. Of course, I made this one big. Let me reduce a bit, because I wanted you to get full picture of it. Seems to be small. When I reduce that, then let me increase only the part we want. Okay, hope you can be able to see them, the costs that do not form part of the cost of inventory. Whether you are selling, whether you are producing, one, we have the selling costs. Of course, by the time you incur the selling cost, you have already determined the cost of the cost of goods you are going to sell, because you can't sell what you have not produced. So by the time you reach the selling price, it means you have already manufactured the products, so we don't include that. Secondly, the abnormal amount of wasted materials and labor. These ones are basically the unexpected things. They were not normal losses or that were incurred in the process, but these were just as a result of maybe misuse or mishandling of the materials, or over staffing, all that. Those costs we incur, they are not supposed to be part. Then we have the storage cost. Storage cost is only relevant to the extent that it is part of the production. That certain items, if the production process has, let's say, 5 departments, and each department works or operates on a certain product to a certain extent, you may find that you need to store some of the produced particles before they go to the next stage. That storage cost is supposed to be included, but the one we incur, the general one, is not. Storage cost is only to the extent that it is part of the production. If you don't incur that, then production cannot exceed or cannot take place. Then the other one are the administrative costs that are not directly attributed to the costs. Selling and distribution, those ones, they are not part of the way you do your manufacturing. So long as you get the cost of production, that's where we stop. We don't go up to the production cost, the total production cost. So I've got some of how we determine the cost. It is here. Leave alone this NRV. We are going to talk about it subsequently when we are reporting. But the cost, we say the cost includes the cost incurred in bringing the inventory to its present working condition and location. Then, meaning this is going to be the transport. Then the cost of the material itself, the labor we are putting in. Of course, when you bring the materials, you need people to operate on. You need direct expenses, like you can hire cranes to lift those raw materials and take them to where they are supposed to be processed from. So all that, you accumulate it, you get the prime cost, then you add other manufacturing overheads. But those manufacturing overheads, they must be based on the normal output, what we have produced out, not these abnormal losses we've incurred. So that's how basically we can determine the cost. Then we try to look at how are we accounting for inventory subsequently at the reporting date. We say that the reporting date, we measure inventory at the lower of the two. Which one and which one? The lower of the cost and the net realizable value. When you're talking about the net realizable value, the formula for it, the general one, it's what I gave here. That to get the net realizable value, you get the selling price less cost of completion and cost of sale. But here, since we are looking at the cost, which cost are we going to attach on the items? This one we exclude it because it's what we are going to be taking. So we only take the expected selling price minus the cost to sell. Any point of sale you've incurred certain costs when you're selling the items, you remove. And maybe to conclude by this one, you can say that this net realizable value, it's like what you're supposed to get from the market less what you have incurred to get that amount you're supposed to get. Then that's what you can really realize. It is the expected selling price minus the cost to sell. When you get that, the lesser of the two, what are we taking to our financials is the lesser of the two. If the cost is less than the net realizable value, we take the cost. If the net realizable value is less than the cost, then we take the net realizable value. But how do we deal with the difference? Then those are the things we are going to be seeing down here. Maybe we'll first look at what are some of the scenarios that may cause, if you're talking that the NRV is going to be less, if let's say it happens and the NRV is less than the cost, what may cause that? What may lead to someone to sell goods at a low cost than what they are actually incurred? One, it may be a marketing tool. You find that the company wants to increase their market. When they are increasing their market, it means they are going to be selling at lower prices to capture the market. Secondly, we can talk about if maybe they made some errors when they are doing their costing. Of course, when you have made an error, it doesn't mean that you are going to shift all the burden to the client, because for you have made an error when you are doing your costing, and maybe you overstated your stock and you can't get that money from the market. Maybe you did not look at some of the factors when you are buying stock, and you bought the stock expensively. But when you got the market and you are getting less money, it doesn't mean that you are supposed to force people to buy expensively because you incurred more costs. You go with the market, and we say that what is in the market is fair. There is no cheating there, because the prices are determined by forces of demand, what people want and what you can supply. The other one is maybe physical deterioration. The item has expired. Of course, something, even if it is not expired, when it is about to expire, you sell it cheaply so that it gets off the market. Maybe these people who are selling like the items which are fresh. You reach at a point things are going to go bad, you just say, you know what, just give me this amount and we shall resume business later. Because at the end of the day, instead of losing all of it, you rather get cheap or small amount, then you compensate when the days are good. Then the other one may be that even the market prices, you may find the market prices, they have increased or they have reduced. You bought the things, it wasn't out of the errors that during your costing you made errors, but as we said, the market conditions, they keep on changing. You can get a higher value or a lower value. So when they have reduced and your costs are high, of course you end up selling what is prevailing in the market. The other one, we can talk about the obsolescence, and we say this is when things are going to be outdated, what there are some technological advancements and people are no longer using some of the items. You end up selling them less than what you actually paid. So those are basically some of the things that may lead to NRV being less than the costs we've incurred. So how do we deal with those things, that difference? If you are selling less than the cost, we treat that loss as an expense in the income statement. We expense it. If let's say you bought stock at 10 million and now what you can only get from the market is 8 million, that difference of 2 million is supposed to be listed as an expense. That's how basically we do it, using the prudence concept. Of course, you can't expect now someone will ask, what if the cost was 20 million, was 10, and got to a low, of course that you've made a profit. But we are now talking about the other worst scenario, when you are selling less than the cost. It is the one which is important. The other one is okay, it's what we want, but this negative idea, that's basically what we are talking about here, the recognition of the expense. How do we recognize inventory as an expense? We recognize inventory as an expense, like the way I said, that inventory, we bought it at 10 million and now we can get only 8 million. It's like our inventory is going to be reducing in value, because that cost is actually the cost of the inventory. It's not about any profit. You have actually sold less than what you are supposed to. It's like the inventory, they are reducing, assets are reducing. And remember, we said when we are recording, we record the lesser of the two. So we were supposed to go with the 8 million, what we got from the market. But what about the 2 million that is there as a difference? You treat it as an expense. Of course, when you treat it as an expense, it means that even your profits are going to be less by that 2 million. So by default, that in the assets, under current assets inventory, we reduced it by 2 million. It will also be compensated in the equity section for the balance sheet to balance, in the equity section, whereby when we are taking our net profit, it will be less by 2 million. That's basically how we do the accounting. So don't tell me that since these items are reducing in value, you know, we said a reduction in assets means a liability, sorry, an expense, and you want to take it to anyway, and the bank statement, shown in the balance sheet. No, you don't take it, it's already reduced by the net profit. Of course, the net profit we shall take there will be less by that, so it will make the balance sheet to balance. So how do we record the other option of recording inventory as an expense? Is one, if let's say you have acquired asset of 10 million, but now you've got a revenue of 15 million, what do you do with the 10 million? We treat that 10 million as if it was an expense. We less it from the money we got. That's basically what we do. When we get our sales and we less cost of sales, that cost of sales becomes an expense because we are lessing it from the sales. There are two ways. One is when the inventory is losing value. Secondly, when the inventory has been sold and we've got the money. That money we've got, we treat the cost of the inventory as an expense and we less it to get our gross profit. Hope you can be able to analyze that and you understand. The trial question, the trial number is, this is the November 2017 question 5. We shall look at that in the due course. Our next video is going to be about the borrowing costs. We want to look at how are we going to be accounting for the loans we get, and we buy assets, or we use them in investments. How do we do that in the next video? So I want you guys to subscribe to the channel and be able to share, comment. You can also advise on things you see that they are not going as the way you want them to be. You can also put them in the comment. We shall be able to interact and have more understanding of these concepts and be able to pass these papers with ease. Thank you. Good afternoon to everyone. Welcome to our tutorials, and today we are proceeding with our series on financial reporting. And basically today we are going to talk about IS 23, that is borrowing cost. And before I go any further, what you should know is that when the business is doing certain activities, if it needs to invest money, if it needs to construct assets, or it needs to buy assets, what it does, it goes for looking for sources where they are going to get the money for investment or for constructing of those assets or buying the assets that are going to be used in the production and all that. So there are certain items that the company may look at and decide whether to go for an internal borrowing by using the internally generated profit, or to go for an external borrowing. And an external borrowing, they may be in terms of long-term loans, they may be using overdrafts, they may be using bonds, debentures, and at the same time they may be using preferential shares, the one that are redeemable. That's what we call the debt. But the one that we get from the shareholders, that one is not supposed to be covered within the scope of this standard. So whenever you see it, just know it's just confusing you. But the one we basically look at is that the money we've got from, let's say, loans, bank loans, we've got from the debentures, bonds, and basically the one for preferential shares, but mainly the one that is redeemable. The one which is irredeemable is shares, so it's also not supposed to be included. So when you get to that, remember when you go for an external borrowing, it means you are going to incur certain amount of money to pay back the interest and the loan amount you have taken, plus other costs. Of course, when you go for an external borrowing, or when you go for borrowing, and you expect that you are going to be incurring interest, that is the main thing. When we talk about borrowing someone, just understand that you are going to be paying interest. But remember, you are not only paying the interest alone. There are other costs that you are going to be paying on top of the loan that are covered within the standard. And some of them you may talk about when you are going, let's say, to borrow money from the bank. They may charge you processing fees. They may charge you like initial deposit, that you first make this amount on our account before we give you this money. They may charge you processing fees and other. If, let's say, you are going for issuing bonds, there is a cost you are incurring, cost of advertisement and all that. For example, when you saw MTN going for borrowing from the public, they incurred some advertisement costs and others. So all that is what we call the borrowing, the costs that are supposed to be capitalized. Then what will happen to the normal way we do the business? The big question will be, how are we going to treat the interest that we are going to be paying for the loans that we have acquired, for, let's say, for construction. If they are going, if at all we've got the money is for construction of, let's say, qualifying asset, that one we are going to look at it. If, let's say, you've got that money and the money is going to be, part of it is going to be for construction and the other one is going to be for used as working capital, how are we going to be treating that interest? Are we going to be capitalizing, or we are going to be expensing it? So that's basically what we are looking at when we are looking at the standard of IS 23. And IS 23 gave us a solution for that, as we are going to be seeing. So what you have to first of all consider is that, what are you going to do with the money you are borrowing? If the money is going to construct a qualifying asset, then that amount of interest that you are going to be paying plus other interest, they are supposed to be capitalized. So let's first know what are borrowing costs. Borrowing cost, we are saying this refers to financial costs or interest incurred in using borrowed funds to construct a qualifying asset. That one shouldn't be missed out. That money should be used to construct or acquire a qualifying asset. And we are saying a qualifying asset is an asset that takes a substantial time to get ready for its intended use or sale. You may be borrowing money to construct houses for resale in terms of inventory. But the issue is, are those buildings you are going to construct, are they going to take a substantial period? Remember, the substantial period is not defined by the standard. But at least when you talk about something that is going to take long, accounting wise, we can say something that exceeds 1 year. We can say that one, at least it is taking a long period. Something that it goes for 2 years, 3 years, and 4 years, we can call it, so long as we are going to acquire something or construct something that is going to take a substantial period of time to get ready for its intended use. If, let's say, someone says, I'm buying a car, is a car a qualifying asset? Of course, when you buy a car, when you pay it, you get it and you start using it. That one you cannot qualify, even if you have used the borrowed funds. It cannot qualify because it is not a qualifying asset. A qualifying asset means that asset is going to take a substantial period, at least more than 1 year, for it to get ready for its intended purpose. So that's basically what we can talk about definition wise and the scope of what we are going to be seeing. But as the definition says, these refers to financial cost or interest. The reason why they are giving these financial costs, it means that financial costs are many. But basically what we know interest, but it's not interest alone. We have certain other costs that are supposed to be capitalized as far as interest is concerned. Even interest is supposed to be capitalized as one of our financial costs that everyone knows. But there are other costs that are supposed to be capitalized in the same way we are going to be doing for interest. One, we have some examples, and we are saying we have interest on short-term and long-term loans. That's our first instance. Of course, that one everyone knows that interest, either interest is on overdraft, short-term, whichever, so long as it's money that we are borrowing and it's not shares, then it's supposed to be included. Second thing, you can talk about the financial costs that are related to leasing transactions. Of course, when you're talking about this leasing transaction, those ones, they are in reference with the IFRS. That's IFRS 15 that handles those leases. So that one we can talk about it maybe in the next slide as we are going to be looking, because we are going to be looking at it as a separate item. But what you should know, that those that are related to that, they are supposed to be part of those that are related to leasing transaction, that is IFRS 16, they are supposed to be part of the borrowing cost, and they are supposed to be capitalized. Then we have other foreign exchange differences. These foreign exchange differences, it happens like if, let's say, you get money from an external or international bank or whatever financial institution you are borrowing the money from, you may find that at the time of paying back the interest, you may find that you borrow when the exchange rates are, let's say, they are low, and by the time you are paying back, the exchange rates have increased. That difference is supposed to be is supposed to be capitalized because it's a loss. We are incurring a loss. Instead of paying less amount, we are paying high amount, but they came as a result of the changes in the exchange rates. So we are supposed also to give that to make sure that we capitalize that, but we take the one that is related to the interest, not to the whole principal. It is interest related. Then the other one we can talk about is we have the discounts. If at all you have been given the let's say a bank loan, and that loan has they have given you some discounts, you may find that those discounts are supposed to be when let's say they give you a discount. Let's say the total loan was the total loan, let's say, was 1 billion, and they are giving you a discount, less of a discount of 10%. But remember, you are supposed to pay an interest on that loan. Let's say the interest was supposed to be 5%, and they are giving you a discount. What you should differentiate is that the loan interest is supposed to be per annum. Whichever, there is no way you can, if let's say they have given you 1 billion and you are supposed to repay it for 5 years, the interest you are paying, the 5%, is supposed to be on an annual basis. Meaning, if you have a discount, this discount is supposed to be on the whole loan amount, whether it is going to be for 10 years, the useful life. Meaning, it is going to be the discount of 10% times the 1 billion, whichever figure you get, is supposed to be for the whole like long-term period, which means that to get for only for 1 year, which we are accounting for, you are supposed to first amortize that installment. If let's say the 10% of the 1 billion, it is, let's say, you can say 100 million, you divide it by its useful life, the useful life of the loan, then you pick that portion for only 1 month. Because when you are given a discount, if you are buying, the discount is given on the whole figure. But remember, the interest is accruing every year. So to get the other discount that is supposed to be less from the interest we are going to be paying, you are supposed to treat it as amortizing that installment, and you get for 1 month for that 1 year, so that you can be able to deduct it from the interest. Then the other one, you may talk about if it was premiums. They may tell you that we are giving you a loan and you are paying interest of 5%, but there are other charges. Let's say you are going to be paying interest of 5%, but you have administrative cost of, let's say, 2% over 1%. It depends on whichever terms that are there. Then that administration cost is going to increase on what? On the amount you are going to be paying back. So that administration cost that you are paying back, they are increasing. So at least for them, when you are looking at those premiums, for them they are supposed to add back. We are supposed to add back on the interest, but they are also supposed to be amortized, because they can say you are going to pay an administrative cost at the end of the period, or it is going to be the administrative cost for that 1 billion you are taking is 6%. You get 6%, you amortize it, the answer you get, you add back to the interest. It will make that gross that is supposed to be capitalized. Hope you can be able to get that. The other one is we are going to be looking at them if at all we get to do a practical question. You'll be able to understand most of the things as we are discussing them. We said that the qualifying asset, you have to make sure that that asset, it takes a substantial period, and we said the standard doesn't define the substantial period, but at least you take it for 1 year, more than 1 year. Something that goes for more than 1 year, at least you can base on that and say, of course, when they are giving you the question, they will give you a period, and you will be able to understand whether it is qualifying asset or it is not. That's basically what we can look at as far as the definition is concerned. But let's also try to look at what are some of the recognition criteria. How do you know that you are supposed to have these borrowing costs? The recognition criteria, and we are saying that an entity will capitalize borrowing costs that are directly attributed to the acquisition or construction of a qualifying asset. We say the principle is that interest is supposed to be directly attributed to the qualifying asset. If at all, let's say you wanted to borrow 1 billion as the amount that you are going to use to construct a qualifying asset, but instead you end up borrowing 1.5 billion, and that the difference, remember the asset needed only 1 billion, but for you ended up borrowing 1.5. It means that 0.5, which is the difference, is not supposed to be capitalized. For it, since it is going to be used as working capital, it's supposed to be expensed. So when you look at the question may come and it is a bit tricky to the extent that they are mixing in the part that is supposed to be related to the qualifying asset and the other is not related to the qualifying asset. So you can be able to assess that. And we are saying that if you have confirmed that the money we are borrowing is directly for construction of a qualifying asset, then that asset we are going to be constructing should be able to give us these. One, we are saying it's probable that future economic benefits will flow to the entity as a result of using the borrowed funds. Of course, when we use the borrowed funds, we expect at least what we have done to give us something in return. That's what we are talking about. And we said something to be probable must be beyond 50%. The other one is that the cost of borrowing can be measured reliably. If at all you can measure the cost, then we recognize that as borrowing cost and we capitalize it. And we have a note here, and we are saying all other borrowings that are not attributable to the acquisition of a qualifying asset must be expensed in the profit and loss. That's what I've been talking about. Can go to the next slide and we try to look at how do you commence, how do you know that I'm supposed to start capitalizing borrowing costs. The standard gave us 3 main points that we are supposed to consider. One, we are saying that the entity will capitalize borrowing costs when it incurs expenditures on the qualifying asset. Of course, when you start incurring the expenditures, you automatically start capitalizing, because if you don't do so, then where are you going to put them? Are you going to expense them? The other one, when he actually incurs the borrowing costs, the same thing. When you incur the borrowing costs, capitalize them, because you have no choice. There is no way you're supposed to put them, so long as they are related to what? To the qualifying asset. Then the third one, this third one is very, very, very important, and it is very confusing. We are saying that when the entity undertakes activities necessary to prepare the asset for its intended use. Actually, what happens is that for you to recognize those borrowing costs, it doesn't necessarily mean that you are supposed to first start the production or to start the construction and you begin recognizing them. At one point, since this money is coming and it is coming to do something that is going to take a long time, it means that there are certain procedures or there are certain steps you go through. If, let's say, you wanted to construct a building, you are supposed to first of all get the plan approved by either the district or the council, whichever is there to approve the plan. When you've got that plan approved, then you can proceed. In that period, when you have acquired the money but you have not yet started the actual the actual construction, but you have already gotten the money, you start capitalizing, because those activities we are doing at that time, they lead to, because there is no way you can start construction when you have not got the plan approved. Those are basically the things we are talking about. We are saying obtaining permits. Permits, we can talk about them, like getting the plan approved and all that is needed before you start the construction. So it doesn't mean that you are supposed to consider this borrowing cost when you have actually started the production. You are supposed to consider them so long as these activities, they lead to the construction of that qualifying asset, or the acquisition of that qualifying asset. We capitalize. Then let's look at what are some of the scenarios whereby you can reach at a point and you say, I'm suspending capitalizing borrowing costs. It may happen. And we are saying that the standard says the entity suspends capitalizing borrowing costs during the time when no active development of the asset is taking place for an extended period of time. But what you have also to know is that the extended period of time is never defined by the standard. So, and if the extended period of time is not defined, don't just assume that even for the shortest period, that it may be you are waiting for materials to come, then you some suspending. Because if let's say you are just waiting for some materials for a few days, maybe people have not turned up, the workers have not come for one day, and you are saying you are stopping capitalizing for that one day. Doesn't make sense. Meaning that the period we at least consider, there is maybe a time for the COVID suspensions. Of course, we had everyone was supposed to be in the house, they were not working, and everything was not going like the way it was used to be. Then you say, at least since it is COVID period and the government said we are supposed to stay at our places, then you just know that at least for that period, the reason is genuine. You can base on that, and you say because they have suspended any movements and all that, even the construction, then for a certain period of time, at least you can base on that, and you say, for this period, I'm going to be expensing these costs. Suspending doesn't mean that you are going to ignore them completely. You will be expensing. One of the things that you will be benefiting when you are when they are expensing them for that period, it means you are going to be paying less tax. Because when you expense them, remember they are huge. When you expense them, it means they are going to be reducing your net profit. As the net profit is reduced, it means even the tax is going to be less. So for that time, so long as the period and the reason is very genuine, you can be able to suspend and say, I'll resume capitalizing those costs when we also resume working, or we resume on the operations. When we are talking about capitalizing, what we basically mean is to add back. We add this amount of interest to the cost so that it becomes part of the cost of the asset. So when we say that the entity suspends capitalizing borrowing cost during the time when no active development of the property, we are not doing anything, especially, for example, during COVID suspension days. Then the other one is, we have a note and we are saying the entity does not suspend capitalizing borrowing cost during times of temporary delays. This is what I've been talking about. Temporary delays, we don't, like, you're just waiting for materials to come. The materials are done. Even when we are taking technical and administrative work, that one we talked about it. If you are obtaining permits, you don't suspend. Even if obtaining permits takes a long period, even 1 year, you keep capitalizing, because before you get those permits, you can't start the operation. And we are saying another note is that borrowing costs are considered when the money is obtained. Borrowing costs, we are saying that borrowing costs are considered when the money is obtained, not necessarily when the production or the acquisition is incurred. This is basically what I've been explaining, that when you look at when you get the money, because the first thing is that when you start incurring the borrowing cost, or when you incur the expenditure. But when you get the money like this, you start capitalizing, even though the actual production has not yet started. So we can basically look at another scenario whereby that there is a situation where you are going to be suspended.
Today we are going to resume with our series of financial reporting, and basically today we are going to look at IAS 23 borrowing costs. And as we discussed in our first video about the standard IAS 23 borrowing cost, we try to look at some of the things that are within the standard, what the standard suggests, and some of the key terms that are very important as far as IAS 23 is concerned. One of the things we try to look at the definition of the borrowing costs. We try to know what are they. Then we see the recognition criteria for borrowing costs. Then we try to look at the commencement. When do we start to capitalize borrowing costs? Then the other one we looked at, when do we suspend capitalizing borrowing costs? And the last one, the cessation, or when do we stop to capitalize borrowing costs? Then we try to look at the measurement of borrowing costs that are eligible for capitalization. Those are the things now we are going to be looking at the computations, what we can be able to pick depending on the different questions that we are going to be following. And today I picked a question from November 2019, and that's going to be question 3, November 2019. So as a precursor of what we actually discussed from the previous video of IAS 23, we tried to look at the definition of the borrowing costs, and we said these borrowing costs, we are mainly focusing on the interest. I know there are so many items as we discussed in the first video, but here our emphasis is going to be on the interest component that is capitalized, because we all know the interest that is expensed in the normal course of business, but this interest is the one that we are going to be capitalizing or adding back to the cost of the qualifying asset or the cost of the asset that has been purchased or constructed. And when you try to look at that, we are bringing in issues of qualifying assets. And basically, qualifying asset is mainly the asset that will take a substantial period of time to get ready for its intended use or sale. And that's basically what a qualifying asset means as far as IS 23 borrowing cost is concerned. Then we spoke about the recognition criteria. And these criteria, we are looking at the conditions that are supposed to be met for someone to start capitalizing borrowing costs. Then the other item is trying to look at the commencement. When are we going to be starting to capitalize our borrowing costs? And mainly we had conditions that are supposed to be met, and we looked at when the company incurs the expenditure on the asset, when we incur the borrowing costs, and when the company is undertaking activities that are necessary to prepare the asset for its intended use or sale. That's basically what we tried to look at in the previous video. We looked at the suspension, that we suspend borrowing costs. We suspend capitalizing borrowing costs as when the company was doing the activities that are necessary for the construction to begin. So it means for that period, the capitalizing borrowing cost should be done because the entity was still embarking on activities that are necessary for the construction of the factory. So that's basically what we can get from that. I hope those who didn't understand what we provided in the first video of this IS 23 will be able to pick something that is in extra of what they actually learned from there. But then let's try to go to the Excel and we try to make some summary. We analyze the information in terms of the figures that we have. We do the computations and we see what we can do. So when you try to go to the Excel, this is the same question. I just analyzed it. I just copied it and pasted it here. So we try to go to, it is November 2019 question 3. Maybe we can try to zoom a little bit to be able to see what we are doing. Okay, can now proceed. And we want to get some small summary of what we are going to be analyzing. Summary. What we have, we are seeing that we got a loan. We have a loan that we acquired on 2018. It was 2 billion. It's 2 billion, 123. Yeah, those are 2 billion. Then we are seeing they have given us that money, but at an interest rate. The interest rate is 10%. Interest rate, they said it is 10%. Then we have we try to look at before the commencement, the prior to construction. Prior to construction, we are trying to look at the key terms that are really important. We've seen that we had an approval. We are waiting for approval of the plan by the government. Then the second item, of course, we had We had even an investment. Before we started the investment of 10%, actually it was 10% of the loan. Those are the items that we had. So that's what we have. But maybe to add you something that is in excess of what we actually discussed, someone may be wondering, how do the investment comes in? What happens with these construction works? Since we say they are going to be taking a very substantial period of time or a long period, because most of the time with this standard, they don't specify what a substantial period of time is, but at least something that is exceeding 2 years or 1 year. It's something that is a bit long term. So when you are doing these investments, and these invest a lot of time for them to get done, it means when we borrow this money, before we start the construction, because we are not going to use the whole amount as we borrowed, like the whole 2 billion as we used it, and we use them at once. This money is going to be used progressively. We just use it, maybe we can say for this first month, we buy materials, we buy this, we buy this, we buy this. We keep reducing the money, but we use that money in portion. So part of the money may be invested, and the other you are paying 10 million, but the supplier gives you a discount. This discount will reduce the cost of the asset, and we earn some interest, of which that interest we've earned will reduce on the amount we are going to be paying back as interest. So that's the logic there. So we have the interest income. This is now the interest income we are going to be earning. 5% of the 10% of the loan. So that's the summary of what we have. So back to the question. The question says, advise the management of PAR Limited on how they can account for the above transactions for the year ended 31st March 2019, clearly showing the extracts. So when we try to look at this information we have, this is what actually we need for the question to get done. But since the question says we are supposed to advise, as we discussed earlier, that these questions of this magnitude, questions that start by saying advise, what it means is that these questions needs us to advise the company, the advice from the standard by first explaining about what the standard says, to the extent that even the person who doesn't have accounting background, when that person has been explained that, or when that person has actually got what the standard says, can be able to make an informed judgment. So that's basically the question. They are requesting us to do more on theoretical aspect, because we first explain what the standard says, then we do the computations. Of course, we add in the figures, but not doing only the computations as we're making these advices. So we get the solution. Since we are advising, we said, so first, and we are saying that we just say according. Now we are basing on what the standard says. According to IS 23 borrowing costs, let me put it in bold figure so that you can be able to see. An entity, or you can say PAR Limited, will commence, because we said it's going to be, we are looking for it. The question is testing, commence capitalizing borrowing costs when it incurs expenditure on the asset. Now these we are now giving the conditions: incurs the borrowing costs, and finally when it undertakes activities necessary to prepare the asset for its intended use or sale. So now we say PAR Limited will commence capitalizing borrowing costs on 1st April 2018. 1st April 2018. 1st April 2018 when they obtained the loan, because between April and July they were acquiring requiring approval of the plan from the government, which is necessary for the actual construction to take place. You can even stop there. That's something that explains that at least you understood something, because that's what the standard says. At least we've actually explained what is needed before we actually begin the computations. So having done that, then we try to look at now the borrowing cost. What is the amount of the borrowing cost that we are going to be capitalizing, the actual borrowing costs actually we incurred. So we need to understand now the movements that occurred in terms of the period when we got the money and when we are reporting. Remember, they told us in the question that they got the money on 1st April 2018, but we are reporting as of 31st March 2019, and we say that is a 1 year. So if it is a 1 year, then there is no need for us to be time apportioning that borrowing cost or the interest that we are going to be capitalizing. But if, let's say, the loan was gotten maybe in March, and how are we going to be calculating the actual interest that has been incurred? The 10%, which was the interest. So that's basically how we are going to be getting the borrowing cost. The borrowing cost is more or less the cost, the interest, even though it has some other aspects, but here we are concentrating on the interest alone. So we are going to be getting the 10% to multiply by the 2 billion. 3 into 3, 3 into 3. So that shillings 200 million, that's going to be the interest. But remember, the interest we are not going to be time apportioning it. But we had the other portion that before they started the construction, we had approval of the plan, but in the same sense, we had an investment. So we are seeing when we invest some of the money, we earned some interest from that investment, and the amount earned is supposed to be deducted from the borrowing cost that we actually going to be paying to the organization or to the bank that gave us the money. And we are seeing that from the above information, the other summary we made, we are seeing that amount income is 5%. We multiply by, it's now the 10% of the 2 billion. In other words, it is just the 5% of this 200 million. So this will give us 2.5. That is it will give us, but this, the actual investment started in July, from 1st April to 1st July 2018. That's when it started. So this is a period of three months. So this one is supposed to be multiply this figure by 3/12. The whole answer we get from this. So multiply by 3, and we'll be getting that 2.5. So that's it for the interest income. And we try now to compute the net borrowing cost that is supposed to be capitalized. So our borrowing cost, the borrowing cost that we are going to be paying, equals to 400 million less 2.5. This will give us 500. So this is now the amount that is going to be capitalized. It's the amount we are going to be capitalizing, because the double entry we are going to be debiting the asset account, or that factory we are constructing. Since we are adding back, this one is supposed to be added to the cost of the asset, the cost that we actually so far spent. Because when you are doing this building is not yet complete. So part of the cost, the total cost we have actually put in there, then we will add back this half, because the asset is still in progress. Remember, it's supposed to go for different years. It is not yet complete. It is still at a given. We will add this 197,500 to which will give us the total cost of the work completed to date. So even in the income statement extract, we don't need to actually present it to the income statement. The factory itself, the cost that we have so far. We said we debit the asset, that's the factory. This factory, it may be falling under PPE, or it may be falling under investment income, depending on what this factory will be used for making. So we may put PPE because the purpose is already known in the question. So we are adding that figure 197,500. Then we also credit. Now what we are crediting here is going to be the interest. This interest is not supposed to be taken to what? To the profit and loss. So if this interest was paid, it will be interest payable, meaning we still have a liability of 197,500 because they didn't tell us that they actually paid it. But if they had paid it, then we could put here bank, because we could use the bank to offset that interest. So that's basically what this question wanted us to do. Non-current assets, you put PPE, you put the costs that we've actually so far, but even in the question, they have not given us the cost that we have actually so far incurred. We add this, we put this interest payable. It is in current assets because this interest is going to be paid in 1 year. So that's why it is for only 1 year. That's why it is presented in what? In current liabilities, not assets. So that's basically what we are required to do in that question. And that brings to the end, be able to learn more and more as. So that's it for today. Situations where we've got money from different sources and they have different interest rates, and that's what will make that will be summarizing the IS 23, and you shall be looking at the other one because the other one is more or less straightforward. We just use these weighted things as you did them in Chuti, so they are going to be very easy. Just getting the weighted averages, and we'll be able to get the single rate that we are going to be using to multiply with the costs that we have actually incurred so far to be able to get an end to this. So I'll see you guys in the next episode as we try to tackle the general, because this has been the specific. So we'll try to look at now the general borrowing, and we'll see how we can be able to do that. Thank you.